Welcome back to the Deep Dive, your shortcut to getting well-informed, cutting through all that noise, and getting straight to the insights you really need. Our mission, like always, is to take a whole stack of sources, articles, research, our own notes, and just pull out the most important bits of knowledge. Hopefully with some surprising facts, maybe a bit of humor, just enough to keep you hooked. So today we're diving deep into the CFA Level I 2025 Fixed Income Volume 6 course. And specifically, we're zeroing in on Module 11, Yield-Based Bond Duration Measures and Properties. Now, if you're navigating, the complex world of fixed income investments or maybe getting ready for that big CFA exam, this deep dive is, well, it's absolutely essential for your toolkit.
That's exactly right. Understanding duration, it's not just some academic exercise. It's truly fundamental for anyone dealing with bonds. Think of duration as your main radar, really, for detecting interest rate risk. And we know interest rate risk is probably the biggest single factor in bond investing.
Right. Rates go up, prices go down.
Precisely. When interest rates rise, bond prices fall. That's your classic price risk. But on the flip side, when rates fall, the income you generate from reinvesting your coupon payments, that also goes down. That's reinvestment risk.
Ah, the two sides of the coin.
Exactly. These two forces are often, working against each other. And duration helps us quantify and critically manage that delicate balance.
Okay. So by the end of this deep dive, you won't just know the definitions. You should have a really crystal clear understanding of the different duration measures. And maybe most importantly, how specific bond features fundamentally change a bond's overall interest rate risk. We're going to approach this, systematically. Start with the basics, move to practical applications, and sprinkle in real-world examples from both the Indian bond market and the big U.S. market.
Absolutely. And as we wrap up today's session, we'll give you a little sneak peek into what's coming next in your CFA journey, Module 12. We'll build right on this foundation, exploring yield-based bond convexity and portfolio properties. That adds another really crucial layer of sophistication to your fixed income risk management toolkit.
Okay, let's unpack this then. We constantly hear about interest rate risk. When people talk about bonds, it gets thrown around a lot, in the news analysis. But what exactly are we measuring here, and how do we even start to quantify this risk in a way that's, meaningful and actually useful for an investor?
That's exactly where duration steps in. At its core, duration is a quantitative measure of interest rate risk. It gives you a numerical estimate of how sensitive a bond's price is to changes in interest rates. Now, it's important we distinguish between two broad categories of duration measures first. The first one, and our main focus for today's deep dive, is yield duration. This specifically measures a bond's price sensitivity to changes in its own yield to maturity.
Its own yield. Okay.
Right. And a key assumption here is that the bond's cash flows are certain. So for these calculations, we're not really worrying about default risk or anything like that.
Got it. Yield duration is about the bond's individual sensitivity to its own yield. What was the other category you mentioned?
The other category is curve duration. Now, this is a bit more nuanced. Curve duration measures a bond's price sensitivity to shifts in a broader benchmark yield curve. It's particularly useful when you're dealing with more complex instruments, maybe where cash flows are less certain, perhaps because of embedded options like call or put features, or for bonds facing actual default risk.
Okay, so that's for later then.
Exactly. We'll save curve duration for a later module in the CFA program, where we really dig into those complexities. For today, we're laser focused on yield duration. And we'll get you familiar with the essential tools: Macaulay duration, modified duration, money duration, and the price value of a basis point, or PVBP. These are the workhorses you'll be using constantly.
All right, first up then. Modified duration, or mod-dur, as you said. Sounds technical, but sounds like it's incredibly powerful too. What is it and why is it so critical for us?
Absolutely. Think of modified duration, MODR, as like the speedometer for your bond's price.
Okay, a speedometer. I like that.
Yeah, just like a speedometer tells you how fast your car's going, modified duration tells you, in percentage terms, how quickly and how significantly your bond's price will change if its yield to maturity moves. Technically speaking, it's defined as the slope, or you could say the first derivative, of the bond's price with respect to its yield to maturity, but then scaled by the bond's price itself.
So like plotting price versus yield. It's the steepness of that line.
Essentially, yes. Imagine plotting bond price on the y-axis and yield on the x-axis. Mod-DER quantifies the steepness of that price yield curve at any given point. So a higher modified duration means a steeper slope, and therefore a greater percentage price sensitivity to yield changes. It's like your early warning system for how your investment will react.
So the key takeaway here is that modified duration isn't just some number. It's my immediate gauge of how volatile my bond is when interest rates shift. If, say, the central bank hints at a rate hike, knowing my portfolio's mod-DER gives me a powerful approximation of the percentage hit or gain, letting me think about adjustments quickly. That seems really practical.
Precisely. It allows for quick, informed decisions. Now let's get slightly more into the mechanics, intuitively breaking down the formula. Remember, a bond's price, its present value, PEV, is basically the sum of the present values of all its future cash flows, those regular coupon payments, PMT, and the final face value, FV at maturity.
Right, discounted back using the yield.
Exactly. All discounted back using the bond's yield to maturity. Conceptually, if you think about how that present value changes for a tiny, tiny change in yield, that's what the derivative dP/dt represents. To normalize that change and express it as a percentage of the bond's current price, we just divide by PV.
And this is where Macaulay duration, which we covered before, connects back in, isn't it?
You got it. The math works out quite elegantly. It connects modified duration directly to Macaulay duration, McDor. What you find is that the percentage change in price with respect to yield is approximately -1 divided by 1 plus the yield per period multiplied by Macaulay duration. And that leads us right to the core formula. Mod-DER equals McDor, 1 plus R, where R is that yield per period.
Per period. Okay. Important distinction.
Very important. And the negative sign, just as a quick reminder, simply reflects that inverse relationship we know exists between price and yield. Yields go up, prices go down, and vice versa. And just like Macaulay duration, to make modified duration truly comparable across bonds, you usually annualize it by dividing by the number of coupon periods per year.
That breakdown helps a lot. Okay,
Yeah.
let's put it into practice. If I want to estimate the percentage price change for a bond, how do I use this annualized modified duration?
We use a really straightforward approximation. Percent PV fall and mod-DER X and yield.
Simple multiplication, basically.
Basically, yes. Let's illustrate. If a bond's annualized modified duration is, say, 5, and there's a 100 basis point increase in its yield, that's 1% or 0.01, then the estimated price change for that bond would be roughly a net 5% decrease.
-5 times 0.01. Yeah, -5%.
So it's a powerful, quick and dirty kind of rule of thumb for immediate market assessments.
That's incredibly helpful for quick estimates. Can we walk through some actual examples, maybe one from the US and one from the Indian market, really cement this?
Absolutely. Let's consider a hypothetical Apple Inc. corporate bond in the U.S. market. Imagine it's a 5-year bond, pays a 3.2% coupon semi-annually, and it's currently yielding 3.2%. Through, detailed calculation, we might find its Macaulay duration at issuance is around 9.3203 coupon periods.
Okay.
Applying our formula, its modified duration would be about 9.17351 periods. To annualize that, we divide by 2 for semi-annual, giving an annualized modified duration of, let's say, 4.58676.
Got it, 4.58676.
Now, let's say the yield on this Apple bond suddenly jumped by 80 basis points, moving from 3.2% up to 4.00%. That's a yield of 0.0000 day. Using our approximation, the estimated percentage price change would be -4.58676 times 0.00000.
Which comes out to approximately -3.67%.
So for like a $1,000 bond, that's about a $36.70 drop.
Exactly. An estimated decrease of USD 36.70.
And for our listeners thinking about the Indian bond market, how does it apply there?
For the Indian context, let's take a hypothetical Reliance Industries LTD bond with very similar characteristics. 5-year maturity, 3.2% semi-annual coupon, yielding 3.2%. Its Macaulay duration and, consequently, its annualized modified duration would be the same as our Apple example, 4.58676.
Makes sense? Same inputs.
Right. So if the yield on this Reliance bond also instantaneously increased by those 80 basis points, the estimated price change would again be -3.67%. Now, if you held a bond with a par value of, say, INR 1,000, that -3.67% translates to an estimated price decrease of approximately INR 3,670.
Okay, so the calculation works the same way, just different currency and context. Precisely. But a critical insight here, and I really want to emphasize this, remember, this calculation is an approximation.
Right. You mentioned that earlier. It's not perfectly linear.
Exactly. The actual relationship between a bond's price and its yield isn't a straight line. It's curved. We call this characteristic convexity, and we'll dive deep into that in Module 12. This approximation we just used implies that our initial estimate shows, sort of, equal absolute price changes for equal yield increases or decreases.
Meaning a 1% rise causes the same price drop as a 1% fall causes a price rise.
That's what the approximation suggests, yes. But in reality, because of that curve, the price increase for a given yield decrease is usually slightly greater than the price decrease for an equal yield increase.
Ah, an asymmetry. Good to know.
It's a subtle but important asymmetry that sophisticated investors always keep in the back of their minds. Duration gives you the first, most important estimate, but convexity refines it.
That makes perfect sense for a standard plain vanilla bond. But, the real world of fixed income is full of more complex stuff. Callable bonds, puttable bonds, bonds with default risk making cash flows uncertain. Does our standard Macaulay or modified duration still work then? Or do we need a different approach for those more tricky scenarios?
That's an excellent, really pertinent question. You've hit on a common challenge. For bonds with complex features like embedded options, say a callable bond the issuer can redeem early, or instruments where default risk makes future cash flows less than certain, calculating that analytical Macaulay duration can be, well, incredibly difficult, sometimes impossible with standard formulas.
So you can't just plug numbers into Madura-McDura 1 plus R.
Not directly, because you can't easily calculate McDura analytically in the first place. This is exactly why we need the concept of approximate modified duration. This method gives us a very practical way to assess interest rate risk, even for these complex real-world bonds. It effectively estimates the slope of that price-yield curve without needing the analytical McDura.
Okay, so how does this approximation work? Is there a specific formula or a way we approach it?
Yes, there's a very powerful and widely used formula for approximate annualized modified duration. It looks like this. An mod dur, PV plus 2 AIC, PV.
Whoa. Okay, let's break that down. PV0, PV plus PV.
Right. Let's break down those terms. PV0 is simply the bond's current full price, the starting point. PV plus is the bond's estimated price if its yield increases by a small defined amount. We call that A yield. PV is the bond's estimated price if its yield decreases by that same small amount. Yield.
So you nudge the yield up a bit, see the price, nudge it down a bit, see the price, and use those changes.
Exactly. Conceptually, what we're doing is taking 2 points on either side of the current yield on the price yield curve. We then calculate the change in price between those 2 points, PV minus TV plus. We divide that price change by the total change in yield, which is 2 times A yield because we went up and down, and then normalize it by the starting price, PV0, to get the percentage sensitivity.
It's like finding the slope of a tiny line segment that hugs the actual curve.
That's a great way to put it. It approximates the tangent to the curve. And this sandwich approach, using both an up and down shift, actually helps to partially account for that convexity we mentioned earlier, making it a pretty robust estimate.
That makes a lot of sense. So it's about seeing how the price reacts to small nudges up and down. Can we walk through an example? Maybe revisit our Apple and Reliance bonds using this approximation method, see how close it gets?
Of course. Let's revisit that Apple Inc. bond 5-year, 3.2% semi-annual coupon yielding 3.2%. Let's say its current full price, PV0, is exactly 100.000 per 100 of par.
Okay, PD0 is 100.
Now, we need to choose a small change in yield. Let's pick an annual yield change of 5 basis points, so yield Q0.0005. If the yield goes up by 5 DPs from 3.20% to 3.25%, we'd calculate the new price. Let's say that price, PV plus, comes out to 99.771. Conversely, if the annual yield decreases by 5 DPs from 3.20% down to 3.15%, we calculate that price, PV. Let's say it's 100.230.
Got it. PV is 100.230, PV plus is 99.771.
Right. Now plug these into our approximation formula. An mod dur, PV plus, 2 AIL PV0. An mod dur A, 100.230, 99.771, 2 AIL 0.00055500.
Okay, so the top is 0.459, and the bottom is 2 times 0.005 times 100, which is 0.10.
Exactly. So N mod dur 0.459, 0.10. It's incredibly close for an approximation.
It really is. This level of accuracy means we can rely on this method even when that analytical calculation isn't practical or possible.
That's really useful. And for the Indian market where you might see bonds with maybe call features or step-up coupons more often, how does it play out there? For an Indian corporate bond, like our hypothetical Reliance Industries LTD bond, the process is absolutely identical. You'd use the same current price, apply the same small 5 basis point increases and decreases in yield, calculate the resulting PV plus and PV, and plug them into the formula. You'd arrive at a very similar approximate annual modified duration, around 4.59. This technique is particularly valuable in the Indian market. Think about corporate bonds that might have embedded call features, or maybe step-up coupons where the rate changes over time, or even certain NCDs, non-convertible debentures, with unusual structures.
Right, things where a simple Macaulay formula gets complicated fast.
Exactly. For those, a simple Macaulay calculation can be much harder, if not impossible. This approximation provides portfolio managers in India a crucial and practical tool to reliably gauge interest rate sensitivity, even for these unique market instruments. And it's worth noting, once you have this approximate modified duration, you can actually work backwards to approximate Macaulay duration if you need it. You just rearrange the original relationship slightly. And Mador X 1 plus ERK, where R is the annual yield and K is the number of periods per year. Or, if using periodic values, Mador X 1 plus a period. It shows the flexibility one can often be derived from the other, giving you a nice analytical framework.
That's good to know. Okay, so modified duration gives us the percentage change. Very useful for comparing relative risk. But as you said, for a portfolio manager, or even me looking at my own investments, percentages don't really pay the bills, do they? What if I need to know the actual dollar amount or the rupee amount I might gain or lose on my specific holding? That's where money duration comes in, right? Sounds like it translates percentage risk into actual cash.
You've absolutely hit the nail on the head there. Money duration, often called dollar duration in the US, or you could think of it as rupee duration in India, is a direct measure of price change expressed in currency units. It basically takes that percentage sensitivity from modified duration and scales it up to reflect the actual size, the market value of your bond position.
So it goes from relative risk to absolute currency-specific risk.
Exactly, which is vital for portfolio managers needing to understand their exact financial exposure in real terms. It's the difference between knowing your speed as a percentage of the limit and knowing you're doing 65 miles per hour.
How's it calculated then? What's the link to Madhur?
It's a very straightforward extension. The formula is simply money dur and Madur's PV full. Here, PV full is the full price, the market value of your entire bond position in currency terms, not just per 100 par, but the total value.
Okay, Madhur times the total market value.
Correct. And once you have that money duration, you can estimate the change in your bond position's value in currency units using this formula. APV full, A10 money dur X yield. This lets you quantify potential gains or losses directly in dollars or rupees or whatever your currency is.
Can you give us a tangible example, maybe for a big institutional investor managing a lot of capital?
Sure. Let's use our Apple Inc. bond again. Imagine a large institutional investor holds a significant position, say a par value of USD $100,000 of this 5-year, 3.2% semi-annual coupon bond yielding 3.2%. Let's say the full price per 100 par is 100.504, making the current market value, PV full, of their entire holding USD $100,503,921.
Okay, $100 million position, basically.
Roughly, yes. Now, if the annualized modified duration we calculated was, let's use a slightly different but realistic figure like 4.43092, maybe due to a different settlement date calculation in this scenario, principal holds, we calculate the money duration for this huge position. Money dur 4.43092 at USD 100,503,921. That gives us an approximate money duration of USD 445,324,719.
Wow, it's extremely actionable. It means that if the yield to maturity on this Apple bond were to rise by 100 basis points, that's 1.00%, or 0.011, the estimated loss for this investor would be approximately money dur X yield, so no DR XD, 445,324,719.010, which results in an estimated loss of around USD 4,453,247. Nearly $4.5 million lost for a 1% rise in yield on that position. Okay, that's a very clear risk number.
It gives portfolio managers a very clear, tangible figure for their risk reports, for hedging decisions, everything.
And how would a similar scenario play out for an Indian institution, maybe managing a large portfolio of SBI bonds or GSECs?
For an institutional investor in India, let's imagine they hold a big position in, say, a State Bank of India, SBI bond with similar characteristics. 5-year, 3.2% semi-annual coupon, 3.2% yield. Suppose they hold INR 1,000 values, that's 100 crore rupees par value. The market value PV full might be around INR 1,050,1,210
So like 100 crore rupees.
Using the same annualized modified duration of 4.43092, the money duration for this position would be 4.43092 million RIR, 1,050 million 39,210.
Which comes out to roughly INR 4,045 pound and 32,047,190.
445 crore rupee duration. Exactly. So an increase in YTM of 100 basis points, 0.01, would imply an estimated loss of approximately INR 4,045,032,472. That's over 4.45 crore rupees. This directly informs their risk exposure in the Indian bond market, letting them manage those hundreds of crores effectively.
So money duration gives the big picture impact in currency terms. What about smaller moves?
Good question. Closely related to money duration and offering an even finer-grained view is the price value of a basis point, PVBP. You'll also hear it called PV01, or very commonly in the U.S., DV01, dollar value of 1 basis point.
DV01, right. Heard that one.
It's an estimate of the change in the full price of a bond for a tiny single basis point change in its yield to maturity. That's 0.0001 or 0.01%.
So even more granular than money duration for a 100 BP change, just the impact of one tiny tick up or down in yield.
Precisely. It gives you a really precise understanding of the smallest practical impact. Extremely useful for traders and portfolio managers making fine adjustments.
How do we calculate PVBP then?
It's elegantly simple using the same logic as our approximate duration calculation. PVBP, PV plus 2. Here, PV is the bond's full price if its yield decreases by just 1 basis point, and PV plus is its full price if its yield increases by just 1 basis point.
So similar idea to the approximation formula, but focused only on a 1 basis point shift and without dividing by yield or price.
Exactly. You're just finding the average price change for that tiny up-down move. This measure is particularly useful for bonds with uncertain cash flows, like callable bonds or mortgage-backed securities, where a precise analytical duration might be tricky. PVBP gives practitioners a robust, market-observable way to assess sensitivity.
Let's take our Apple bond again. What would its PVBP be, and what does that tell us?
Okay, for our Apple Inc. bond, with a current full price of, say, 100.504 per 100 of par, we'd calculate its price if the YTM increases by just 1 BP to 3.21%. Let's say that gives us PV plus equals 100.45940. Then its price if the YTM decreases by 1 BP to 3.19%. Let's say that gives PV equals 100.548465. Plugging these into the PVBP formula, 100.084846 100.445940 equals 0.0445325. Let's call it 0.04453.
So 0.04453, what unit is that in?
That's the currency change per 100 of par value. So for every single basis point change in yield, this Apple bond's price is estimated to change by approximately USD 0.04453 per 100 of par value. Very precise.
Okay, and for the SBI bond in the Indian market, same logic.
Precisely the same methodology for an SBI bond. You'd calculate its prices for a 1 basis point increase and decrease around its current yield. The resulting PVBP would give you the estimated price change in rupees for that tiny 1 BP shift per 100 rupees of par value. This granular measure is incredibly significant for portfolio managers in India, enabling them to fine-tune their interest rate risk management. It tells them the impact of even minute yield changes, allowing for extremely precise hedging or position adjustments.
So they all connect. Modified duration, money duration, PVBP.
They're all interconnected. You can actually think of PVBP or DV01 as being approximately equal to money duration multiplied by 0.0001, since 0.00001 is 1 basis point. So while they seem like different concepts, they're really just different ways of quantifying the same underlying interest rate sensitivity, just expressed in different units or focusing on different magnitudes of yield change. It gives you a full spectrum of risk measurement tools.
Right, this is where it gets really interesting for me.
Yeah.
We've got the tools defined now, Modur, Moneydur, PVBP. But what's truly fascinating is understanding the levers that actually affect the bond's duration.
Sure.
How do things like, its maturity, its coupon rate, even the prevailing yield level itself, how do these characteristics change its sensitivity? Because duration isn't static, is it? It's constantly influenced by these things.
Absolutely. It's a dynamic measure, and understanding these influences is really key to being a savvy bond investor. You're right, Macaulay and modified duration are primarily functions of several key bond features. Its time to maturity, its coupon rate, its yield to maturity, and even the exact fraction of the current coupon period that has passed. Grasping these relationships lets you predict how a bond's interest rate risk might behave, often without even needing a complex calculation. We can summarize these as fundamental inverse and direct relationships.
Okay, lay them out for us. What's first?
First, let's tackle the coupon rate, C. This has a distinct inverse relationship with duration.
Inverse, so higher coupon, lower duration.
Exactly. All else being equal, A bond with a lower coupon rate will have a higher duration, meaning it carries more interest rate risk compared to an otherwise identical bond with a higher coupon rate.
That seems a bit counterintuitive. Why is that?
It's because a larger proportion of the lower coupon bond's total value comes from that single large principal payment way out at maturity. Those smaller, earlier coupons contribute less to its overall present value. This effectively pushes the bond's average time to cash flow further out into the future. And the longer that average time, the more sensitive the bond's price is to changes in the discount rate, the yield.
So don't be fooled by a small coupon. It often means greater volatility.
Precisely. It's a critical insight. Let's compare. Imagine a U.S. Treasury bond with a 2% coupon versus another one with a 5% coupon. Both mature in 10 years. Both currently yield 4%. The 2% coupon bond will have a higher duration.
Because more of its value is tied up in that final payment 10 years out.
Exactly. Similarly, in the Indian context, compare a low-coupon Indian GSEC, government security, to a higher coupon GSEC with the same maturity and yield. Those low-coupon GSECs, often issued at a discount, will consistently show significantly higher interest rate sensitivity. It's a fundamental principle.
Okay, coupon rate. Inverse relationship. What's next?
Next up is the yield to maturity itself. This also generally exhibits an inverse relationship with duration.
Wait, lower yield means higher duration. That sounds backward too.
It does seem counterintuitive at first, but think about it. When yields are low, those future cash flows are discounted less heavily.
Right, the present value of distant payments is higher when discount rates are low.
Exactly. This makes those distant payments relatively more impactful on the bond's total present value, effectively stretching out that average time to receive cash flows again. An earlier self-assessment question in the CFA curriculum actually confirms this directly. An increase in YTM consistently leads to a decrease in modified duration.
So in a low-rate environment, bonds are actually more sensitive to rate changes, not less.
Correct. It's a crucial point. For instance, if a Tesla corporate bond is yielding 3% versus an identical Tesla bond yielding 6%, the bond yielding 3% will have the higher duration and thus greater price volatility for any given change in rates. Same in the Indian market. An Infosys bond yielding 4% would have a higher duration than the same Infosys bond yielding 7%. The lower discount rate at 4% pushes more weight towards later cash flows, making it more exposed to rate shifts.
That explains why periods of historically low interest rates often seem to coincide with higher bond market volatility.
It's a major contributing factor. Okay, next, time to maturity, T. This one is more intuitive. It generally has a direct relationship with duration.
Longer maturity, higher duration. It makes sense.
Right. Longer times to maturity typically correspond to higher duration, meaning more interest rate risk. This holds true pretty consistently for most bonds, especially those trading at par or at a premium. You can often see this if you look at price yield curves in textbooks or analytical systems. The curve for a 30-year bond is typically much steeper than for a 1-year bond, visually showing its greater sensitivity.
Yeah, a longer-term bond just has more time for interest rate changes to impact its value. Seems logical it would be riskier.
Precisely. Think of a 30-year U.S. Treasury bond compared to a 1-year U.S. Treasury bill. The 30-year bond will have a significantly higher duration, all else being equal. Its cash flows stretch much further out. Similarly, in the Indian context, a long-dated Indian GSEC, say a 30-year bond issued by the RBI, will naturally have a much higher duration and thus more interest rate risk than a short-term GSEC, like a 5-year one. That's why those long-term GSECs jump around so much more when rates change. Now, there's a little theoretical quirk here for deep discount bonds with very low coupons. Their duration can actually peak and then slightly decrease at extremely long maturities. But for practical purposes, especially at level I, just remember, longer maturity generally means higher duration.
Okay, good qualifier. What's the last factor?
The last one is a bit more subtle. The fraction of the current coupon period that has elapsed, TD and TT. This also has an inverse relationship with Macaulay duration.
Inverse. So as time passes between coupons, duration goes down.
Exactly. What this means is that Macaulay duration decreases smoothly as time passes between coupon payments.
Why would that happen?
Think about it. As time ticks by between coupon dates, the time until the next cash flow naturally gets shorter. Day by day, the average time until you receive your payments slightly decreases.
Ah, okay. The clock is ticking down to the next payment.
Right. Then, on the actual coupon payment date itself, when the coupon gets paid and a whole new period begins, the Macaulay duration suddenly jumps back up slightly.
Like resetting the clock.
Exactly, because the time to next cash flow suddenly resets to the full length of the new coupon period. This creates what we often call a sawtooth pattern if you were to graph Macaulay duration over time.
A sawtooth pattern. Interesting.
Yes. Exhibit 6 in the curriculum reading shows this visually. For an investor holding, say, a bond in the Indian corporate bond market, maybe from HDFC Bank, they'd observe its duration gradually decreasing day by day as the next coupon date approaches. Then, boom, right after the payment, it jumps back up. It reflects the bond aging between payments.
Subtle, but makes sense. Okay, that covers the main influences on duration for typical bonds. But what about those quirky bonds we mentioned? The ones that don't quite fit the standard coupon-paying mold, like zero-coupon bonds or those theoretical perpetual bonds or floating rate notes. Do the same general rules apply, or do they have their own special duration characteristics we need to know?
That's a fantastic point. While the core principles of duration are universal, it's always about sensitivity to yield. Changes these specific instrument types have quite distinct duration behaviors because their cash flow structures are so different. Investors definitely need to be aware of these.
Okay, let's start with the simplest. Zero-coupon bonds.
Right. Zeros are the simplest in terms of cash flows. No periodic interest, just one single payment at the face value at maturity. Because there's only one cash flow at the very end, the present valuated average time to receive cash flows is, well, it's just the time until that single payment.
So the Macaulay duration of a zero-coupon bond is just its time to maturity.
Exactly. No complex weighting needed. The Macaulay duration is precisely its time to maturity. Its modified duration would then just be that time to maturity divided by 1 plus yield per period.
That's incredibly straightforward. So a 5-year zero, McDure is 5 years?
Precisely. For a U.S. Treasury strips, separate trading of registered interest and principal securities, with a 5-year maturity priced to yield 3%, its Macaulay duration is exactly 5 years. Its modified duration would be slightly less, 5 divided by 1 plus 0.03, which is about 4.85 years. This tells you zeros are highly sensitive over their whole life.
And in India, do they have similar instruments?
They're less common than U.S. strips, but if an Indian zero-coupon GSEC were issued with a 5-year maturity, its Macaulay duration would likewise be 5 years. Very transparent risk profile.
Okay, zeros are simple. What about the opposite extreme perpetual bonds?
Perpetual bonds or perpetuities. These are theoretical bonds that never mature. They pay fixed coupons forever.
Forever. Do those actually exist?
Extremely rare in practice nowadays, though some old ones still trade. Mostly, they're important theoretical constructs for understanding duration's limits because they never mature, their cash flows stretch out indefinitely. The Macaulay duration formula for perpetuity is actually quite simple. McDure, 1 plus R.
Time plus yield divided by yield. Okay,
Yeah.
so if I had a hypothetical perpetuity yielding, say, 6%.
For a theoretical perpetuity yielding 6% or 0.06, its Macaulay duration would be 1 plus 0.06, 0.06, 0.06, 0.06, which comes out to about 17.667 years.
17.6 years. That's a high duration.
Incredibly high. It indicates extreme interest rate risk, precisely because those cash flows are spread out indefinitely. It gives us a kind of theoretical upper bound for duration.
Got it. Zeros are maturity, perpetuals are 1 plus R. What about floated rate notes, FRNs?
Right. Floating rate notes, FRNs, and loans. These are specifically designed so their interest payments vary with some market reference rate, like SOFR in the US or maybe the repo rate in India, plus a fixed quoted margin. Crucially, these coupons reset at predetermined dates, often quarterly or semi-annually.
So the coupon payment itself changes.
Yes, it adjusts based on where the reference rate is at the reset date. And the key takeaway here is that interest rate risk only really arises between these reset dates. At each reset, the coupon adjusts to the new market rate, which effectively reprices the bond back towards par value.
Ah. So if the coupon keeps adjusting to market rates, their interest rate risk must be really limited then. Sounds like a way to minimize duration.
Precisely. You've hit on a core strategic use of FRNs. Because the coupon adjusts, the effective interest rate risk is mainly confined to the very short period until the next reset date. Beyond that reset date, the bond effectively reprices itself. Therefore, the Macaulay duration for an FRN is simply the fraction of a period remaining until the next reset date.
Just the time left until it resets. How's that calculated?
The formula is straightforward. McDure floating, TTT, where T is the total number of days in the current coupon period, say 90 for quarterly, 180 for semiannual, and T is the number of days that have passed since the last coupon reset.
Okay, total days is days past total days. Can you give an example?
Sure. Consider a Bank of America floating rate note in the U.S. that resets its coupon every 6 months, so roughly T equals 180 days. If 57 days have passed, T equals 57 in the current period since the last reset, its Macaulay duration is 180, 57, 180 equals 123, 180, that's only about 4 months.
Very short duration then.
They're very short. Let's take an Indian context example. Maybe an HDFC Bank floating rate bond or a loan that resets quarterly. T equals 90 days. If 30 days have passed, T equals 30 since the last reset, its Macaulay duration would be 90, 30, 90 equals 60, 90 equals 0.6667 periods, roughly 2 months.
Okay, so FRNs have tiny durations.
Exactly. Their coupon periods are usually short, meaning their Macaulay durations are typically less than half a year, often just a few months. As a result, investors commonly use floating rate instruments specifically to reduce the overall duration and therefore the interest rate risk in their fixed income portfolios. They're a strategic tool, especially if you expect rates to rise.
Wow, what an incredibly comprehensive deep dive into bond duration. We have covered a tremendous amount of ground today. Seriously, from the core definitions, that crucial distinction between price risk and reinvestment risk, right through to the practical uses of modified duration, money duration, PVBP, and then all those fascinating nuances of how bond features actually drive the risk. I feel like you now have a really robust understanding of how to quantify, interpret, and even anticipate interest rate risk, which is, as we said, just fundamental for Level I and beyond.
Yeah, it was a good run through. To quickly recap the main takeaways, modified duration, that's your speedometer, estimating the percentage price change. Money duration and PVBP translate that risk into actual currency units, which is crucial for managing your real investment position.
Right, the dollars and rupees.
Exactly. We also really dug into how fundamental bond characteristics, maturity, coupon, yield, fundamentally shape a bond's duration and its risk profile. And finally, we demystified those special cases, zero coupon bonds, perpetuals, and especially floating rate notes, showing how their unique structures give them distinct duration properties.
Remember, this understanding isn't just, academic stuff for the exam. It's absolutely essential for making genuinely informed strategic investment decisions. Whether you're looking at India GSECs, U.S. corporates, or managing a huge institutional portfolio, it's about building that solid framework.
And that leads us perfectly into a final provocative thought for you to mull over. We've established duration is a powerful first-order measure of interest rate risk. It gives us the slope of the line. But what happens when that price-yield relationship isn't perfectly linear, which we know it isn't?
The curve.
Convexity. Exactly. How do we account for the curve itself, especially during really large yield changes where our linear duration approximation might start to fall short? It really raises an important question about the limits of duration as a standalone measure.
Ooh, that's a fantastic, thought-provoking question to leave everyone with, and that perfectly wraps up Module 11 of CFA Level I 2025 Fixed Income, Volume 6. Next time, we'll dive right into Module 12 and build on that very thought. We'll learn how to refine our risk assessment by understanding yield-based bond convexity and portfolio properties. Thanks so much for joining us on the deep dive. Until next time, keep learning, keep questioning, and keep making those informed financial decisions. Welcome back to the deep dive, your shortcut to being genuinely well-informed. We're really excited to be continuing our journey through the CFA Level I 2025 Fixed Income Volume 6 material. We're aiming to build that solid foundation for you.
Absolutely. Great to be back.
Today, we're taking a deep dive into Module 12, yield-based bond convexity and portfolio properties. If we thought of duration as like the basic beat of bond risk, then convexity, well, that's where the music gets really interesting, right? Much more complex, nuanced.
That's a great way to put it. It adds a whole new layer.
We've all used duration, right? It gives you that first look at how bond prices might react when interest rates change. Feels pretty solid at first glance.
It's the standard starting point for sure.
But then, rates make those bigger jumps, or maybe you're dealing with bonds that mature way out in the future.
Yeah, long-dated stuff.
And suddenly that initial duration estimate feels, well, a bit shaky. Incomplete.
It definitely shows its limitations then, because it's linear.
Exactly. Duration is super useful, no doubt, but it's only giving us part of the picture. It's drawing that straight line in a world that, let's face it, is curvy.
The price-yield relationship isn't a straight line. That's the key.
Right. So convexity is that crucial, sometimes missed piece of the puzzle. It helps investors like you get a real measurable advantage when managing fixed income risk.
It really does. It's about precision.
So our mission today is pretty clear. We're going to unpack what convexity actually is. We'll demystify how you calculate it. We'll look at a couple of ways.
The nuts and bolts.
Explore why it's so valuable for you as an investor. And then, importantly, see how these ideas apply when you're managing a whole portfolio of bonds, not just one.
Scaling it up.
Yeah, moving beyond just the basics to get that really sophisticated grip on fixed income risk. And as we wrap up today, we'll also set the scene for our next deep dive.
What's coming next?
That'll be Module 13, Curve-Based and Empirical Fixed Income Risk Measures. We'll build right on what we covered today, tackling even trickier risk scenarios.
Sounds good. Looking forward to that. But first, convexity.
First, convexity. Let's master this. Okay, so we've talked a lot about duration before. It's a great starting point.
Absolutely fundamental.
You'll remember, modified duration, that's our main first-order measure. It gives us a linear approximation, right? A straight-line guess of how sensitive a bond's price is to yield changes.
Like drawing a tangent line on the price-yield graph at the current point.
Exactly. Visualize that classic downward-sloping price-yield curve. Duration is just the slope of the straight line touching that curve right where you are.
And for tiny yield changes, a few basis points here or there, that tangent line is often pretty close to the actual curve.
Yeah, for those small moves, the linear approximation is often good enough. It gives you a decent ballpark figure for the price move, lets you do quick risk checks.
It works for small stuff.
But here's where it gets really, really interesting, and maybe a bit non-intuitive if you're stuck thinking in straight lines. That true relationship between a bond's price and its yield. It's not straight.
No, it's curved. Specifically, it's convex for these kinds of bonds.
Right. Think about that price-yield graph again. Duration predicts the price moving along that straight tangent line. But the actual market price, it's moving along the curve itself.
And the further the yield moves from your starting point, the bigger the gap between that straight line estimate and where the price actually ends up on the curve.
Precisely. And that gap, that difference, becomes really significant when you have large yield changes rates shooting up or crashing down. Or even with smaller yield changes, if you're looking at bonds with very long maturities.
Those 30-year bonds, for example.
Yeah. In those cases, just relying on duration means you're probably underestimating how much you could lose if yields rise or underestimating how much you could gain if yields fall.
It consistently underestimates the good changes and overestimates the bad changes compared to reality.
So it just falls short. It doesn't capture the whole picture of interest rate risk accurately enough, especially when things get volatile.
Which is why we need something more.
Exactly. That's why we need this complementary measure, this second-order adjustment, to refine our estimates and manage risk with real precision. And that, right there, is where convexity makes its grand entrance.
That frames it perfectly because it really underscores a critical point that sometimes gets glossed over in basic analysis. Bond markets just aren't linear.
Right.
And what's fascinating, really, is how understanding this nonlinear, this curved relationship gives you a real tangible edge for any finance professional, especially if you're managing serious fixed income money.
Pension funds, insurance companies.
Exactly. It could be a huge pension fund in the U.S., maybe managing retirement money for thousands of people, or a big insurance company in India, say, needing to match long-term liabilities. If you just rely on that linear duration approximation in today's rate environments, which can be pretty volatile,
Definitely.
you could make some serious misjudgments about your risk exposure. Imagine you misjudge the impact of a, say, 100 or even 200 basis point yield swing on a multi-billion-dollar or multi-crore rupee portfolio.
Yeah, that's big money.
Even a seemingly small percentage error because you assumed linearity. That can translate into millions, maybe tens of millions of dollars or rupees in unexpected gains or, more likely, losses.
Ouch.
It really boils down to achieving a level of precision in your risk management that sets you apart. You know, basic duration numbers are everywhere now. Everyone has access to those.
Sure.
But truly getting these nuances, understanding this second-order effect of convexity, that's not just academic. It gives you a genuine strategic advantage. It means you can anticipate market moves more accurately, you can optimize your portfolio better, and you fundamentally cut down the chance of nasty surprises. Your decisions just become much more robust.
That makes perfect sense. It's like upgrading from a basic map to a high-res satellite image with terrain view. You see the landscape much more clearly.
Exactly like that.
Okay, so let's really dig into this concept then. We often hear convexity called a second-order effect. Sounds technical, maybe a bit scary.
It can sound that way.
But it simply means it's measuring that non-linear part of the relationship, right? Between yield changes and the price of these specific bonds, option-free fixed-rate bonds. It's the correction factor, the adjustment, that refines the linear guess duration gave us.
It fine-tunes the estimate.
And here's a really, really critical property to lock in for these kinds of bonds. Convexity is always positive.
Always positive for plain vanilla, option-free fixed-rate bonds. That's key.
And this isn't just, a footnote on a formula sheet. It's an inherent, almost kind of magical advantage for you as the investor.
It works in your favor. Let's explain why.
Okay, so here's why this positive convexity is such a great feature. Imagine yield falls significantly. Rates go down. The actual price increase your bond experiences. It's always higher than what duration alone would have told you.
You get a bonus upside?
Exactly. You get a little kicker. Now, flip side. Imagine yield increase significantly. Rates go up. The actual price decrease your bond experiences. It's lower, meaning less painful than duration alone would have predicted.
You lose less. Your downside is cushioned.
Right. So this asymmetry, this is the amazing part. Positive convexity inherently benefits you because it gives you this bonus in both scenarios, rising and falling yields, especially when those yield changes are big.
Better performance when rates fall, better protection when rates rise, compared to just the duration estimate.
It's like having a financial product that just behaves better when the market makes a significant move. Doesn't matter which way. Maybe an analogy helps. Imagine you're in a boat on a choppy sea.
Okay.
Duration tells you the immediate slope of the wave you're on right now. You point it up or down.
The instantaneous angle.
Yeah. But convexity tells you about the curvature of that wave. It hints if the next part of the ride will be more extreme or less extreme than just following that initial straight slope. It gives you a sense of how the boat will handle the whole wave, not just the bit you're on.
Ah, so a more convex bond is like a boat that rides the waves more smoothly, higher peaks, shallower troughs.
Exactly. It offers a smoother, safer ride for the investor. It's got this sort of built-in shock absorption, a hedge against that interest rate uncertainty, provides protection.
That boat analogy works really well. It makes that abstract idea of curvature much more tangible. So that leads me to think, okay, what specific things about a bond give it this smoother ride, this higher positive convexity?
Good question. What drives it?
If we connect this back, it's clear that convexity has similar relationships with bond features as duration does, but there's a nuance. It magnifies those nonlinear effects. Let's break down the main drivers and maybe think about why they create more convexity.
Okay, lay it out for us.
First one, probably the most obvious, time to maturity.
Longer bonds, more sensitive?
Right. A bond with a longer time to maturity will just naturally have greater convexity. Makes sense, right? Longer-term bonds are way more sensitive to rate changes overall. Their cash flows are stretched out so far into the future.
That their present value gets hammered or boosted more by discount rate changes?
Precisely. The discounting effect is magnified over longer periods. Think about the example in the CFA material. They mention a 30-year Romanian government bond. Its annualized convexity is huge, something like 369.64.
Yeah.
Now compare that to the BRWA Corporation 5-year bond in the example. Its convexity is around 24.24.
Big difference.
Massive difference. And that's almost entirely down to the much, much longer maturity of the Romanian bond. That long horizon just fundamentally ramps up the nonlinear effect of yield changes.
So like a U.S. pension fund manager choosing between a 5-year Treasury note and a 30-year Treasury bond.
The 30-year bond offers way more convexity, better protection if rates swing wildly. But, of course, it also comes with a much higher duration risk. It's a trade-off. You usually get more convexity with more duration.
Got it. Makes sense.
What's next?
Next up is the coupon rate.
Okay, how does that play in?
A bond with a lower coupon rate will actually have greater convexity.
Lower coupon, more convexity. Why is that? Well, think about it. If the coupon is low, you're getting less of your return through those regular interest payments. A bigger chunk of the bond's total value comes from getting that principal back at the very end.
Right, the face value repayment.
Which means the average timing of the cash flows is pushed further out into the future. It makes the bond's value more reliant on that distant payment, and therefore more sensitive to changes in long-term discount rates in that nonlinear way.
So less cash flow up front means the back end matters more, amplifying the effect.
Exactly. So imagine an Indian debt fund manager, maybe at HDFC Asset Management or SBI Funds Management. They're looking at two GSECs, similar maturities, maybe 10 years, but one has a 7% coupon, the other has a 5% coupon.
Okay.
The 5% coupon GSEC will have higher convexity. If that manager expects the RBI, the Reserve Bank of India, to make some big moves causing rate volatility, they might prefer the lower coupon bond for that extra convexity protection, even if it means a slightly lower current yield.
Interesting strategic choice there. Okay, maturity, coupon rate, what else?
Then there's the yield to maturity itself.
The starting yield.
Yeah. A bond that already has a lower yield to maturity will tend to show greater convexity.
Why is that? Seems a bit counterintuitive.
It happens because when yields are already very low, think about the near zero rates we saw in the US and Europe for a while. Any further change in yield, especially a downward one, can have a disproportionately large impact on the bond's price.
Because the denominator in the present value calculation is already small.
Exactly. That 1 plus YTM term in the denominator is smaller, so changes have a bigger percentage impact. The math just makes the price more sensitive, particularly on the upside, amplifying that convexity effect.
So low-rate environments naturally boost convexity effects.
Okay, one more.
One more, slightly subtler factor, the dispersion of cash flows.
Dispersion, meaning how spread out they are.
Precisely. Let's say you have two bonds, and somehow they have the exact same duration, same overall weighted average timing.
Okay, bit theoretical, but possible. The bond whose cash flows are more spread out over time, maybe it has some big coupons early, then small ones, then the principal, versus one with just steady coupons and principal, the one with greater dispersion will have greater convexity.
So it's not just the average timing duration, but the spread around that average.
Exactly. It adds another dimension beyond just maturity. The more varied the timing of payments across the bond's life, the more that nonlinear price yield curve asserts itself.
Fascinating. So these four things, longer maturity, lower coupon, lower starting yield, and greater cash flow dispersion, they all tend to push up convexity.
They all work by basically pushing more of the cash flows further out or making that discounting effect more pronounced and spread out, which increases that desirable nonlinear sensitivity. For a portfolio manager, understanding these drivers allows for really deliberate bond selection based on what they expect markets to do.
That's a really solid understanding of the what and the why. Okay, so now we know what it is, what drives it. The next logical step is the how. How do we actually put a number on this? How do we quantify convexity?
Right, the calculation part.
Just like we did for Macaulay and modified duration, we can calculate annualized convexity, usually called and convexity. And there are a couple of main ways to do it. We'll look at the detailed spreadsheet way. First, this sort of exact fundamental method, and then a more practical approximation.
Two tools for the job.
Okay, method one, the spreadsheet calculation. You can think of this as the exact method. It's very similar in spirit to how you calculate duration from first principles by breaking down every single cash flow.
Getting granular.
Yeah. The CFA material in Exhibit 2 walks through this for that BRWA Corporation 5-year, 3.2% semi-annual bond. You'd start by listing out all the cash flows, the semi-annual coupons, the final principal payment.
Standard bond setup.
Then, for each cash flow, you figure out its present value using the current yield, and then calculate its weight. What percentage of the total bond price does this specific cash flow represent?
Same steps as for duration calculation so far.
Exactly. But now comes the unique part for convexity. It's often shown as column 7 in those textbook examples. The calculation for each cash flow's contribution to convexity is, okay, it looks a bit intimidating at first. Time to receipt of CF, X. Time to receipt of CF plus 1, weight of CF.
Let's break that down. It's not as scary as it looks.
Right. The absolute key part here, the bit that brings in the nonlinearity, the curvature we keep talking about, is that time to receipt of CF, time to receipt of CF plus 1 part. It's basically introducing a time squared element.
So duration uses time, convexity uses something like time squared.
Pretty much. Think of it like this. Duration weights cash flows by how far away they are, time. Convexity takes it further, effectively weighting them by the square of how far away they are. This mathematically captures and amplifies that second-order effect.
Which means cash flows way out in the future have a much, much bigger impact on convexity than they do on duration.
Exactly. Reflects their amplified sensitivity. So you calculate that time squared-like term, multiply it by the cash flow's weight. You do this for every single cash flow.
Sum them all up.
Sum them all up. And then one final step to get the standard annualized convexity measure. You divide that total sum by the square of the number of periods per year.
So for a semi-annual bond like BRWA, divide by 2 squared, which is 4. For a quarterly bond, divide by 4 squared, 16.
Perfect. You run all those numbers for the BRWA bond, and the result, the and convexity, comes out to about 24.2389. It's precise. It's built from the ground up using every cash flow.
The theoretically pure method.
Right. Now, method 2, the approximation method, often called ApproxCon. This one is super practical, very widely used, especially handy for bonds where maybe the future cash flows aren't perfectly certain.
Like bonds with options, callable bonds, putable bonds.
Exactly, things we'll cover later. Or just for speed. The formula itself is quite neat. ApproxCon, PV plus 2 PV0.
Looks simple enough. What are the pieces?
Okay, PV0 is just the bond's current price at its current yield. Easy. PV plus is the bond's price if the yield goes up by a tiny amount, yield. And PV is the price if the yield goes down by that same tiny yield.
So you nudge the yield up a bit, find the price. Nudge it down by the same amount, find the price.
Exactly. You're essentially seeing how the price reacts to a small, symmetrical yield shock around the current level.
Yeah.
You take those 3 price points, PV plus OKR, and the original PV0, and use them to mathematically infer the curvature at that point.
Clever. Using price changes to estimate the curve shape.
Let's quickly try it with our BRWA bond. Original YTM is 3.20%, original price PV0 is 100. The source material uses a yield of 5 basis points, which is 0.0000965.
Okay,
If we bump the yield down 5 BPs to 3.15%, the price PV plus drops to 99.770965. If we nudge the yield down 5 BPs to 3.15%, the price PV rises to 100.2210641.
Got the 3 prices.
Now plug PV, PV plus CAM, and PV0 into that ApproxCon formula, along with yield 0.00005. You crunch the numbers and you get an ApproxCon of 24.23896. They're practically identical in this case. Shows how good the approximation can be for these standard bonds.
That really does highlight the practicality, which naturally leads to the question. Okay, we have these 2 methods, the exact and the approximate. Why both? When would you, as a professional, use one versus the other?
Good question. What's the trade-off?
Well, the spreadsheet method, the exact one, gives you that theoretical precision. It's fantastic when you know all the future cash flows with certainty. Think standard government bonds like a U.S. Treasury or a high-quality Indian G-Sec. Perfect for deep analysis, maybe building or validating pricing models.
Academic rigor, almost.
Kind of, yeah. But it can be slow and cumbersome if you're dealing with a massive portfolio, hundreds of bonds. And crucially, it gets really complicated or even breaks down for bonds with embedded options like callable bonds, where the issuer might redeem early if rates fall. The cash flows become uncertain.
So the exact method needs exact cash flows.
Pretty much. The approximation method, though, that's all about practical utility. All it needs are 3 price points, current price, price up a bit, price down a bit. That makes it super versatile and efficient.
Much faster to calculate.
Way faster, especially for those bonds with uncertain cash flows, or when you just need a quick risk assessment for a complex portfolio holding many different types of bonds. Imagine you're a trader, maybe on a bond desk, at a big bank in Mumbai or New York.
High pressure, need answers fast.
Exactly. They need real-time risk numbers for thousands of bonds, many with options. The approximation method lets them get actionable convexity estimates quickly without modeling every single possible cash flow path.
So exact for purity and foundation, approximate for speed, and real-world complexity.
That's a great summary. Understanding both gives you that complete picture. You know the theory, and you know the practical shortcut. That's invaluable for anyone serious about fixed income.
Fantastic distinction. It's about having the right tool for the specific job. Okay, so we've defined convexity, we know what drives it, we know how to calculate it. Now for the really exciting part, how do we actually use it? How does it make our price change estimates better? This is where the rubber meets the road for investors.
Making it useful.
The full formula, the one that combines both duration and convexity to estimate the percentage price change, looks like this. PP full ek yield plus XX and convexity ek field.
Okay, let's unpack that.
The first part, Ankmutter ek yield, that's familiar territory. That's just the duration effect, the linear estimate we started with. Tells you the change based on the initial slope.
The first order effect.
Right. But the second part, hack ek and convexity ek yield 2, that's our star player today. That's the convexity adjustment.
The second order correction.
And here is the absolutely critical takeaway for these option-free bonds. This convexity adjustment term, it is always positive. Doesn't matter if the yield change is positive or negative.
Why always positive?
Because you're squaring the yield change.
Yeah.
Square positive number, it's positive. Square negative number, it's also positive. Since and convexity is also positive for these bonds.
The whole adjustment term, half and convexity x, has to be positive.
Exactly. which means convexity always adds to your estimated price change relative to the duration-only estimate. Think about what that means. If yields go up, yield is positive. Duration gives you a negative price change. Convexity adds a positive amount, making the total estimated decline smaller.
Cushions the blow.
If yields go down, yield is negative. Duration gives you a positive price change. Convexity adds another positive amount, making the total estimated gain larger.
Boosts the gain. It's a win-win compared to the linear estimate.
It really is. It's this wonderfully asymmetric, advantageous property, acts like a safety net and a performance booster rolled into one.
And that inherent positive nature, that's exactly why this enhanced precision is so valuable, so transformative for a portfolio manager. Let's go back to that BRWA bond example again, because the source material shows this so clearly with a big yield change plus or minus 100 basis points.
Okay, a 1% shift in yield. Let's see the numbers.
Right. If the yield goes up by 100 basis points, so yield plus 0.01, the actual true percentage decline in the bond's price is calculated as negative 4.46788%.
Okay, that's the reality.
Now, if you just use duration, your linear estimate, and under Eck yield, would be 4.58676%.
So duration alone predicts a bigger loss than actually happens.
Exactly. The error is negative 0.1887%. You're off by almost 12 basis points. Seems small, but we'll see why it matters. Now, bringing convexity. Use the full formula. And under X yield, plus half X and convexity du. Your new estimated decline is negative 4.46788%.
Wow, that's incredibly close to the actual Nagsville 4.46788%.
Right. The difference now is just 0.00232%. The error shrinks from nearly 12 BPs down to less than a quarter of a basis point. It's a massive jump in accuracy.
It's stunning, almost perfect prediction. What about when yields fall?
Same story, just mirrored. If the yield goes down 100 BPs, yield equals 0.01, the actual price increase is 4.71035%.
Right.
Duration alone estimates a 4.58676% gain. Again, it underestimates the good news. The error is about mega to 0.0359%, over 12 BPs off.
Missing out on predicting the full gain.
But add the convexity adjustment, your estimate jumps to 4.70795%. The error, just meta 0.000239%, again, virtually eliminated.
The precision is undeniable.
And now let's answer that crucial question. Why should you, the listener, whether you're managing your own retirement account or advising on a huge institutional fund, care about getting rid of an error of, say, 12 basis points?
Yeah, why sweat the small stuff?
Because in the world of fixed income, especially with large portfolios, 12 basis points is not small stuff. If you're managing a, let's say, USD 500 million bond portfolio, an error of 12 basis points, 0.12%, in your price estimate translates to a $600,000 difference in your valuation.
Wow. Okay, that's not small change at all.
Not at all. That kind of discrepancy can seriously impact your reported returns, your risk metrics, your hedging effectiveness, your capital allocation decisions.
Yeah.
Getting that precision with the convexity adjustment, it's invaluable for careful risk management, for building effective hedges, and just fundamentally for optimizing how the portfolio performs. It lets managers make much smarter, more granular calls about their interest rate bets.
It moves from guesswork to near certainty on the price impact.
Exactly. And let's dig a bit deeper into those positive attributes of bond convexity, which Exhibit 3 in the source material illustrates so well. Imagine you have two bonds, and critically, they have the same price right now, the same maturity, the same YTM, and even the same modified duration.
So at this exact point in time, they look identical from a duration perspective. Same tangent line.
Correct. But one bond has significantly more positive convexity than the other, maybe due to lower coupons or cash flow dispersion.
Okay, so different curvatures, even with the same slope.
Precisely. Now, let yields make a big move. If yields fall significantly, the bond with the higher convexity, the one with the more pronounced curve, its price, goes up more than the price of the less convex bond.
Bigger gain for the more convex bond.
Yep. And if yields rise significantly, that same more convex bond, its price goes down less than the price of the less convex bond.
Smaller loss for the more convex bond.
This leads to a really powerful conclusion for portfolio strategy. A more convex bond will actually outperform a less convex bond in both falling and rising yield environments, assuming those yield changes are reasonably large.
Outperforms either way. That sounds like a free lunch.
It feels like it. Positive convexity acts like this built-in buffer, this almost free option. Enhances gains, cushions losses. It makes convexity a super desirable characteristic for any investor, especially if you think rates might be volatile. It's like buying extra insurance against rate swings.
Yeah. There's always a but in finance, right? Is it really free?
Ah, good point. No, probably not entirely free and inefficient market. That's the crucial caveat. If a bond genuinely offers superior convexity, chances are the market already recognizes that value.
So it would trade at a higher price.
Exactly. A higher price, which means a lower initial yield to maturity compared to a similar but less convex bond. You essentially pay for that desirable convexity feature by accepting a slightly lower starting yield.
Ah, the trade-off. Lower yield now for better performance or protection later if rates move significantly.
Precisely. It's a strategic decision. Do you want a bit more yield now, or do you want that convexity benefit for potential future volatility? Depends on your market view.
That makes perfect sense. You pay for the feature. Okay, so we've seen the power of convexity in percentage terms, and we understand its value. Now let's bring this right down to earth, into the realm of actual money changing hands. Let's talk currency dollars, rupees, euros, whatever.
Getting practical with the cash impact.
We touched on money duration before, right? That gives you the first order effect, the initial dollar or rupee price change for a 1% or 1 BP yield shift.
The linear currency impact.
Now we introduce its counterpart, money convexity, often called money con. This captures that second-order nonlinear effect, but critically, it expresses it in currency terms too. This is what portfolio managers really track day to day.
The curvature effect, but in dollars and cents.
And calculating it is wonderfully simple. Money con and convexity SPV full. You just take that annualized convexity number we figured out earlier and multiply it by the bond's full price in your currency.
Scales it up from a relative measure to an absolute currency figure.
Yep. And when you put money duration and money convexity together, you get an incredibly accurate estimate of the actual change in your bond's full price in currency.
Yeah.
Money der egg yield plus half egg, money con egg 2. This lets you quantify not just the percentage shift, but the actual potential gain or loss in your investment's value.
The bottom line impact.
Let's revisit our trustee BRWA bond one last time. But now, imagine you're a U.S.-based institutional investor, maybe managing part of an endowment, and you hold a position with a par value of USD 100 million.
Significant holding.
We know its AND MODR is 4.58676, and AND convexity is 24.23895. Let's stick with that 100 basis point 0.01 increase in yield scenario. We saw earlier the actual decline in market value for this $100 position would be about $4,467,884.
The true loss.
Now, if you'd only use money duration to estimate this, the estimated decline would have been around $4,586,759.
Overestimating the loss by quite a bit.
Yeah, the error is about $118,875. You'd think your position lost 119Ks more than it actually did. Could lead to bad hedging decisions.
Definitely.
But now let's bring in money convexity. First, calculate money con. That's 24.23895 times our 100 bills in dollar initial full price, which gives a money con of roughly $2.42 billion. It's a big number because it scales with price.
Okay.
Now use the full formula with money duration and money convexity. The estimated decline in market value comes out to approximately $4,465,564.
And how close is that to the actual loss?
The actual loss was $4,467,884. Our estimate is $4,465,564. The difference, the error, it shrunk to just $2,320.
Wow. From an error over $100,000 down to just over $2,000 on a $100 million position move.
Exactly. The difference between the estimated change and the actual change becomes tiny. That kind of pinpoint accuracy isn't just, academically satisfying. It's absolutely critical when you're managing large sums and accountable for performance and risk.
That example makes it crystal clear. Money convexity isn't just theory. It's a vital tool for practitioners. And connecting that to the bigger picture, this is exactly where it hits a portfolio manager's P&L, their performance metrics, their reputation.
Right.
For those huge institutional players, think sovereign wealth funds, major U.S. pension giants like CalPERS, or large Indian debt mutual funds run by firms like Aditya Birla Sun Life, AMC, even tiny percentage misestimations like that 12 basis points we saw earlier multiply out into millions, potentially hundreds of millions of dollars or rupees across the whole portfolio.
The scale magnifies everything.
Absolutely. So this level of detail, calculating money duration and money convexity, is critical for the risk management teams trying to quantify exposure accurately. It's critical for the portfolio managers making the active buy-sell hedge decisions. And it's critical for the treasury folks managing a company's overall financial risk profile.
Different roles, same need for precision.
Think about that Indian asset manager again, maybe at Kotak Mahindra AMC, managing a large debt fund. They've got a mix of GSECs, maybe some state development loans, SDLs, and corporate NCDs from issuers like Larsen and Toubro or HDFC Bank.
A typical diversified Indian debt portfolio.
Right. When the RBI makes a policy announcement, or maybe global oil prices spike impacting inflation expectations, the Indian yield curve can shift quickly. By having accurate money duration and money convexity figures for all their holdings, that manager can instantly estimate the likely rupee impact on their NAV, net asset value.
Allows them to react fast.
Exactly. They can decide whether to rebalance, maybe use overnight index swaps, OIS, or interest rate futures on an exchange like NSE for hedging, or perhaps even take a tactical view based on the expected change. They're not flying blind based only on duration. They understand the nonlinear effects, too.
Same logic for a U.S. manager facing Fed decisions or economic data surprises.
Precisely. A U.S. manager holding billions in treasuries or corporate bonds from, say, Microsoft or Johnson & Johnson relies on these exact same money duration and money con calculations to manage their exposure with the utmost precision. It's fundamental to meeting their investment objectives and fiduciary duties. Without money convexity, their risk models are just fundamentally incomplete. They'd be vulnerable to those unexpected market swings.
That really paints a clear picture of the high stakes involved at the professional level. Okay, so let's zoom out again. We've nailed down convexity for individual bonds. How do these powerful ideas translate when you're managing a whole collection of different bonds and entire portfolio?
Right. The portfolio perspective.
This is where portfolio duration and portfolio convexity become essential. Just like these metrics gauge the rate risk of one bond, we can aggregate them to get a single unified measure of the interest rate sensitivity for the whole portfolio. Gives you that big picture view of your overall exposure.
A single number for the whole book.
Now, conceptually, there are actually two main ways you could think about calculating portfolio duration and convexity. The first way, which is probably the most theoretically pure,
The Pearson's approach.
is to calculate the weighted average of the time to receipt of all the combined cash flows from every single bond in the portfolio. You'd essentially treat the entire portfolio as if it were one giant, complex synthetic bond.
Aggregate all the coupons, all the principals from all the bonds. Wow.
Exactly. You can see the problem, right?
Right.
If your portfolio has hundreds, maybe thousands of different bonds, different maturities, coupons, payment dates, maybe some floaters, some option-embedded stuff, trying to mesh all those unique cash flow streams into one single coherent timeline.
That sounds like an absolute nightmare, practically impossible for a real-world portfolio.
It really is.
Yes,
It's computationally infeasible for most managers. And that's exactly why the second method is the one that's overwhelmingly used in practice by portfolio managers everywhere. It's much more pragmatic.
The practical shortcut.
Yes. Simply take the weighted averages of the durations and convexities of the individual bonds within the portfolio. It provides a really useful, actionable estimate of the portfolio's overall sensitivity without the headache of aggregating every single cash flow.
That makes intuitive sense. Average the risk characteristics of the parts to get the risk of the whole.
Exactly.
And that practical weighted average approach really is the workhorse for portfolio risk management globally. The calculation itself is straightforward. Your portfolio modified duration is just the sum across all bonds in the portfolio of the market value weight of bond 20 times the modified duration of bond 1.
Weight times duration summed up.
Yep. And portfolio convexity is calculated the exact same way. The sum of the market value weight of bond 1 times the convexity of bond 1.
Weight times convexity summed up.
The key here is using the market value weights. If a bond makes up 10% of your portfolio's total market value, its duration and convexity contribute 10% to the portfolio's overall duration and convexity.
Okay, market value weighting is crucial.
Very crucial. This weighted average method works reasonably well, especially when the yield across the different bonds in your portfolio aren't wildly different, and when the yield curve itself is relatively flat or expected to move in parallel.
Let's make this concrete, maybe a U.S. context example.
Sure, let's go back to that U.S. pension fund manager. Imagine their portfolio has two main holdings for simplicity. One, USD 50 million par value in that BRWA-like corporate bond, maybe a 5-year Apple bond, and Madur 4.58676, and convexity 24.23896. Two, USD 50 million par value in a long-term U.S. Treasury bond, say a 30-year, and Madur 15.90637, and Convexity 369.64203, using the source's long bond numbers as a proxy.
Okay, a corporate and a treasury 50-50 par value.
Right. Now, we need their market values for the weights. Let's assume the corporate bond is trading near par, say $50 million market value. Maybe the long-term treasury is at a slight discount due to rates, say $49.01 million market value.
So the total portfolio market value is $99.01 million.
Correct. So the weight of the corporate bond is 50 meters, $99.01 is a 50.50%. And the weight of the treasury is $49.01. $99.01 is 49.50%.
Got the weights. Now calculate portfolio duration and convexity.
Portfolio duration, weight corp, ector corp plus, weighty 8 dirty. 3.5050, U 2.4950 is a 15.90637. 10.19004. Portfolio convexity, weight corp, acom corp plus, weighty acom vitsushi, 0.5040, 0.24.23896 plus 5.4950, a 369.64203, and 195.21581.
Okay, so the portfolio as a whole has a duration of about 10.2 and convexity of 195.
Exactly. Now, the manager has these single numbers representing the entire portfolio's sensitivity. If they expect yields to rise by 100 BPs across the board, a parallel shift.
They can use the full formula with these portfolio numbers.
Right. Portfolio value A of 14 up portfolio A toward of yield plus summa 10.19004, 0.01000 plus 1 times 0.1104 plus half is 195.21581 minus 0.0100 plus up 0.0103 added 0.1 pro 000 2 A court mid to 1.092100 or 90000.
Extremely useful for quick assessment and hedging decisions.
What about an Indian context example? Similar logic. Imagine an Indian asset manager at, say, Nippon India Mutual Fund running a diversified debt scheme. Their portfolio might hold 1. A 5-year Indian government security GSEC. Let's say Madur 4.8 and convexity equals 28. 2. A 30-year GSEC. Let's use similar numbers. Madur equals 16 and convexity equals 370. 2. A 30-year GSEC. Let's use similar numbers. 3. Some AAA-rated corporate NCDs, maybe from Reliance Industries.
Yeah.
Let's say these average out to Madur 6 and convexity 45.
Okay, a mix of government and corporate debt.
They'd calculate the market value weight of each holding. Let's say it's 40% 5R GSEC, 30% 30R GSEC, and 30% corporate NCDs.
Not the weights.
Then they calculate the weighted averages. Portfolio duration equivalent 0.4 AI 4.8 plus 0.3 R 16 plus 0.3 I 6 plus 1.92 plus 4.8 plus 1.8 plus 1.52. Portfolio convexity has a portfolio duration of 8.52 and convexity of 135.7.
So this Indian fund has a portfolio duration of 8.52 and convexity of 135.7.
Right. Now, if this manager gets wind that the RBI is likely to hike the repo rate significantly in the next policy meeting, causing market yields to jump, they can use these portfolio numbers, 8.52 and 135.7, to estimate the immediate negative impact on their fund's NAV in percentage terms and thus in total rupees.
Allows them to anticipate the hit and maybe adjust positions beforehand?
Exactly. Maybe they reduce their holding in the long-duration 30-year GSEC or use derivatives to hedge some of that duration risk. It informs their active management strategy based on their view of the RBI's actions and overall market direction.
Makes sense. It's a practical tool used globally.
Huh.
But you mentioned it works best if yields move in parallel. That sounds like a big if.
Yes. That is the crucial limitation of this weighted average approach. It's something every finance professional using these numbers must keep in mind. This method implicitly, mathematically, assumes a parallel shift in the yield curve.
Meaning it assumes the 1-year yield, the 5-year yield, the 10-year, the 30-year. They all change by the exact same number of basis points, up or down, at the same time.
Precisely that. Which leads to the important question, how realistic is that assumption?
Doesn't feel very realistic. Yield curves twist and turn all the time, don't they?
They absolutely do. Pure parallel shifts are actually quite rare in the real world. Much more often, yield curves do non-parallel things. They might steepen, maybe long-term rates rise more than short-term rates, or they might flatten short-term rates rise more than long-term rates. Or they can even twist, with short rates going one way and long rates the other.
So the weighted average duration and convexity numbers might not be perfectly accurate if the curve doesn't shift in parallel.
Exactly. The estimate of the portfolio value change will be less accurate if the yield curve shift is non-parallel. So while this weighted average method is incredibly useful and practical for getting a baseline risk reading, managers need to be aware that it's a simplification, especially during times when the yield curve shape is changing dramatically, maybe due to shifts in monetary policy expectations or major economic events. They need to consider these potential non-parallel effects beyond just the single portfolio duration convexity numbers.
A powerful tool, but used with awareness of its underlying assumption.
Got it.
That's the key.
So knowing all this, how does it feed into actual investment decisions? Making those calls about adding or removing bonds from a portfolio. The source material had an example, right? Example 2, Exhibit 7.
Yes, a good practical application scenario. Let's walk through that logic. Imagine that institutional investor, again, the one with a portfolio containing the BRWA-like corporate bond and the long-term U.S. Treasury.
The one with portfolio duration 10.19 and convexity 195.
Right. Now, they're thinking about adding a new position, USD 50 million par value of a 10-year U.S. Treasury bond.
Okay, adding an intermediate maturity bond.
First step, recalculate the portfolio's weighted average duration and convexity, including this potential new bond. They run the numbers with the new weights. And let's say they find the new portfolio duration would be 9.87415, and the new portfolio convexity would be 161.62749.
So adding the 10-year Treasury would lower both the overall duration from 10.19 to 9.87 and the overall convexity from 195 to 161.
Correct. That specific 10-year bond, given its characteristics and the weighting, pulls down the portfolio averages for both measures in this case.
Okay, now comes the decision. What if the investor expects rates to fall? Say, they anticipate a 100 basis point parallel shift downward across the yield curve.
This is where the analysis leads to a recommendation. If you expect rates to fall, what do you want from your bond portfolio?
You want it to go up in price as much as possible, which means you want higher duration to capture more of the initial price pop, and you want higher convexity to get that extra boost on top.
Exactly. But what does adding this specific 10-year Treasury do to the portfolio?
It lowers both duration and convexity.
So, based purely on this analysis and the investor's expectation of falling rates, the recommendation would be do not add this particular U.S. Treasury position.
Because it would make the portfolio less sensitive to the falling rates, reducing the potential gain. It works against their market view.
Precisely. If they are bullish on rates falling, they should be looking for ways to increase the portfolio's duration and convexity, perhaps by adding even longer-dated bonds or bonds with lower coupons, not this specific 10-year bond that dilutes those characteristics.
That's a really clear example of how these metrics aren't just descriptive numbers, they are direct inputs into shaping the portfolio to align with an investment outlook. Powerful stuff.
It really is. Drives strategy.
Okay, that feels like a very thorough exploration of Module 12. Let's just quickly recap the main points we've hit.
Good idea.
We established that convexity is that vital second-order risk measure. It complements duration, and it's especially important when yield changes are large, or for bonds with long maturities, common in many institutional portfolios.
Captures the curvature.
For standard option-free bonds, it's always positive, which is inherently good for investors. It enhances gains when rates fall and cushions losses when rates rise. That advantageous asymmetry.
The built-in benefit.
We saw how to calculate it either precisely with the spreadsheet method, breaking down every cash flow, or practically using the approximation method with 3 price points.
Exact versus approxicon.
Then we brought it into the real world with money convexity, translating those percentage effects into actual currency impacts, which is critical for managing dollar or rupee risk.
Making it tangible.
And finally, for portfolios, we learned that using weighted average duration and convexity is the practical way to get a handle on overall interest rate risk. But we have to remember that key limitation.
The assumption of parallel yield curve shifts, which isn't always reality.
Right. A powerful simplification, but a simplification nonetheless.
A great summary. We've seen how convexity gives us a much more refined, much more accurate picture of how bond prices really behave compared to just using duration. It gets us closer to the true market dynamics.
Definitely fills in a big piece of the puzzle.
But it still largely relies on that idea of the whole yield curve shifting together, even if we account for the curve itself. What happens when the curve doesn't shift uniformly? When it twists or steepens or flattens, meaning short-term rates do something different from long-term rates.
Yeah, that parallel shift assumption is the lingering issue.
Our current tools, duration and convexity, as we've discussed them today, don't fully capture those kinds of complex, non-parallel movements. And that complexity is exactly what brings us to our next deep dive.
The transition.
Indeed. Next time, we'll jump into Module 13, curve-based and empirical fixed income risk measures. We'll explore more advanced techniques designed specifically to handle those non-parallel shifts, giving us an even more sophisticated toolkit for understanding and managing interest rate risk in all its real-world messiness.
Sounds like the next level of complexity building directly on today's foundation. Looking forward to it.
Me too.
Okay, before we wrap up for today, here's something for you to mull over, a provocative thought building on our discussion. We've talked a lot about how positive convexity is inherently valuable to investors. It improves outcomes in both rising and falling rate environments. If something is consistently valuable like that, markets tend to price it in, right?
Usually, yes. Efficient markets should reflect known value.
So think about this. What are the actual market mechanisms, subtle or maybe not so subtle, that ensure you, as an investor, are either adequately compensated, maybe through higher yields, for taking on bonds with less convexity, or that you end up paying a fair price through lower yields for the desirable benefits of bonds with more convexity? How does this convexity premium actually manifest in bond prices?
Good question. How is it priced?
And maybe take it a step further, how might the efficiency of that pricing differ between, say, the deep, liquid, highly analyzed U.S. Treasury market versus maybe a less liquid but rapidly growing and maturing emerging bond market like India's? Could there be different opportunities or challenges in how convexity is valued and traded in those different environments? Something to ponder about market efficiency and the real-world pricing of these risk characteristics we've just dissected.
Welcome back to The Deep Dive. We're here to break down complex finance topics, make them clear, and hopefully pretty engaging too.
Absolutely.
Today, we're diving deep, really getting into the weeds of your CFA Level I-2025 Fixed Income Volume 6 course. We're tackling Module 13, Curve-Based and Empirical Fixed Income Risk Measures.
Really crucial in this.
It really is. Now, you've probably already spent some time with, the standard duration and convexity measures. Great tools.
The foundations.
Exactly. But here's the thing. What happens when a bond isn't quite so straightforward? What if the cash flows aren't certain? Or maybe the whole yield curve does more than just shift up or down nicely in parallel.
Right, it twists, it flattens, it steepens.
Exactly. Suddenly those traditional tools, they don't quite cut it anymore, do they?
No, they're based on assumptions that just don't hold in those cases.
So this deep dive, it's really your shortcut to understanding these trickier, more real-world fixed income situations. We want to arm you with the tools you need to analyze bonds that have options embedded in them, or to figure out how specific yield curve moves affect prices, and also to really get the nuances of credit risk.
It's about moving past the textbook basics.
Yeah, to really see how bond prices actually react when things get complicated. So what's on the agenda today?
Well, we'll start by looking at why those yield-based duration and convexity measures we learned earlier, why they fall short for bonds with embedded options.
Okay.
And that leads us straight into effective duration and effective convexity, much more powerful for these situations.
Then what?
Then we'll zoom in on key rate duration. This is a really neat tool for understanding how different parts of the yield curve impact a bond's price, not just the whole curve moving at once.
So like what happens if only short-term rates move?
Exactly, or just long-term rates. It dissects the risk.
Okay, cool. And finally,
We'll tackle a really important distinction. Analytical duration versus empirical duration. We'll see why looking at historical market data, the empirical approach, can sometimes give you a much more accurate picture, especially for bonds that carry credit risk.
particularly when markets get choppy, I imagine.
Precisely. That's often when the difference really shows up.
Okay, great. And once we've got these advanced risk tools under our belt.
We'll be perfectly set up for our next deep dive, which is Module 14, Credit Risk. We'll shift focus there to assessing the likelihood that an issuer might default.
Makes perfect sense. But first things first, let's dive into Module 13.
Let's do it. It's true, we're kind of shifting gears here. Moving from the, let's say, cleaner theoretical world into the sometimes messy practical reality of bond markets.
Right.
In the earlier modules, you built that solid foundation with Macaulay duration, modified duration.
Yeah, the yield-based stuff.
Exactly, yield-based measures. And they are absolutely essential for what we call option-free bonds, bonds where everything is predictable. The core assumption there is really clean. Cash flows are fixed, they're certain, and you can use a single yield to maturity, or YTM, to capture all the interest rate risk.
Right.
And those measures, they tell you how much the bond's price should change if its own YTM shifts. It's neat, it's tidy.
It's calculating a train journey. You know, the start, the end, the speed. Very predictable.
That's a good way to put it. But the real world of fixed income,
Oh. Yeah,
Well, it isn't always that cooperative, is it?
no, definitely not. It
Oh.
feels more like trying to measure the duration of a flight where the pilot might just decide to land early because of bad weather,
Hmm.
or maybe even divert.
That's a fantastic analogy because this is where it gets really interesting and frankly more complex. A lot of bonds have these contingency features, or as we call them, embedded options.
Okay, embedded options. Like what?
Well, take a callable bond that gives the issuer the right to pay you back early. Maybe rates have fallen and they want to refinance cheaper.
Right, they call it back.
Exactly.
Hmm.
Or a putable bond that gives you, the investor, the right to sell it back to the issuer before maturity. Maybe rates have gone up and you want your money back to reinvest elsewhere.
Okay, so the option is for the investor there.
Correct. And then you got things like mortgage-backed securities, MBS. Their cash flows depend on homeowners deciding whether or not to refinance their mortgages.
So if rates fall, homeowners refinance, and the MBS investor gets paid back sooner than expected.
Precisely. So in all these cases, callable, putable, MBS, the future cash flows are uncertain. They depend entirely on what market interest rates do.
Which means you can't really nail down a single reliable yield to maturity, can you? If the maturity itself might change, or the cash flows aren't fixed.
You've hit the nail on the head. That's the crux of the problem. If the cash flows aren't certain, if the bond's life isn't fixed, how can we rely on measures like Macaulay or modified duration that assume a fixed YTM?
It's like trying to measure a moving target. So if those tools aren't right for these kinds of bonds, what do we use? How do we measure their interest rate sensitivity?
Excellent question. And this is where we need to make a really important shift in thinking. Since these bonds with embedded options don't have a well-defined YTM,
Because of the uncertainty.
right, because of those uncertain cash flows, Macaulay and modified duration just aren't appropriate. They'll give you misleading numbers. Instead, we need a measure of the bond's price sensitivity to a change in a broader benchmark yield curve.
Okay, a benchmark curve, like the U.S. Treasury curve.
Exactly. Think of a benchmark yield curve like the U.S. Treasury par curve, or here in India, the Indian G-Sec par curve, as reflecting the market's required yields for government bonds of various maturities, all trading at par. It's our sort of risk-free baseline for the market.
Got it. It sets the stage.
It does. And we measure how the bond's price reacts when that curve shifts. This is precisely what effective duration and effective convexity are designed to do. They are curve duration statistics, not yield duration statistics.
Okay, so they measure sensitivity to the benchmark curve, not the bond's own uncertain yield. That makes a lot more sense for these complex bonds.
It's a much more robust approach for these instruments.
So how are these effective measures actually calculated? I'm guessing it's not just simple bond math anymore. There's got to be more going on under the hood.
You're absolutely right. It definitely involves a bit more computational horsepower. Effective duration and convexity, they're calculated by observing how a bond's price changes when the entire benchmark yield curve shifts.
The whole curve moves.
Yes, typically in a parallel fashion, meaning all maturities, 2-year, 5-year, 10-year, etc., move up or down by the same amount, say 25 basis points across the board.
Okay, a parallel shift. And we assume other things stay constant.
For the calculation, yes. The analyst assumes things like credit spreads or liquidity risk don't change for that moment. The key difference is how we get the bond prices for this calculation. We need the price if the curve shifts up, PV plus, and the price if the curve shifts down, PV.
Right. How do we get those prices if the bond has an option?
That's where option pricing models come in. These are sophisticated financial models designed specifically to value instruments with embedded options.
Option pricing models. Okay, now it sounds serious. Can you give us like an intuitive feel for what these models actually do without getting lost in the math?
Sure. Think of an option pricing model, like a
Hopefully.
sophisticated probability calculator for your bond's future. It's not predicting the future, but it uses assumptions about how interest rates might move, how volatile they might be.
Okay.
And based on those potential rate paths, it calculates the likelihood that the embedded option, like the call option on a callable bond, will be exercised.
So it figures out how valuable that option is under different rate scenarios.
Exactly. It incorporates inputs like, for a callable bond, how long the issuer has to wait before they can call it, the call protection period, what price they'd pay if they call it, assumptions about the credit spread, and crucially, an assumption about future interest rate volatility.
Right. Volatility matters for option value.
Hugely. So the model takes all this, simulates raising and lowering the benchmark interest rates, and calculates the resulting bond prices, PV plus and PV, including the impact of the option.
Okay, that makes sense. It's pricing in the option's likely behavior. So let's talk specifics. Callable bonds seem really common. How does that call option affect the bond's effective duration and convexity?
Callable bonds are a classic case where effective measures are absolutely essential. Remember, a callable bond gives the issuer the right to buy it back early.
Usually if rates fall. Right,
But
so they can refinance cheaper.
exactly. It's great for the issuer, but for the investor, well, they get their money back, but now they have to reinvest it at those lower prevailing rates. It limits their upside.
So my potential gains get cut short if I hold a callable bond and rates fall. It feels like there's a ceiling on my profits.
That's a perfect way to think about it. And it's reflected in the price, too. A callable bond's price is always less than an identical non-callable bond. The difference is basically the value of that call option the issuer holds.
Okay.
Now, when benchmark yields are really high, that call option isn't worth much. The issuer isn't likely to call the bond. So the callable bond behaves pretty much like a regular option-free bond. Its duration is similar.
But what happens when rates fall? That's when the issuer might want to call it.
Precisely. And here's the critical part. When benchmark yields fall, the effective duration of the callable bond becomes lower than a comparable non-callable bond.
Lower duration, why?
Because the bond's price just doesn't go up as much as an option-free bond would. As rates fall, the chance of it being called increases, and that puts a cap on how high the price will go. Investors know they might just get par value back soon, so they won't pay a huge premium.
So the price appreciation gets dampened.
Severely dampened. And here's the kicker. As yields keep falling, a callable bond can actually exhibit negative effective convexity.
Whoa, negative convexity, that sounds bad. What does that mean practically?
It means the price appreciation slows down even more or even flattens out completely as rates fall. But on the flip side, if rates were to rise significantly, the price depreciation accelerates.
So less gain when rates fall, more pain when rates rise. That's not a good combination for the investor.
It's a very unfavorable asymmetry. You capture less of the upside, more of the downside. It's a hidden risk if you're not looking for it using effective convexity.
That really drives home why these measures are important. Can you give us some real-world examples, maybe one from the US and one from India?
Absolutely. Let's say Apple Inc. issues a 10-year callable bond in the US. If U.S. Treasury yields plummet, making borrowing much cheaper.
Apple might call the bond back.
Exactly. They pay investors back, maybe at par, and issue new debt at the lower rate, the original bond investors. They get their cash, but now they have to find a new home for it in a low-yield environment. Their potential gains from falling rates were capped by that call.
Okay, makes sense. How about an Indian example?
Sure. Think about Reliance Industries issuing a callable non-convertible debenture, an NCD, in India. If the Reserve Bank of India, the RBI, goes on a rate-cutting spree, pushing down overall Indian bond yields.
Reliance might decide to call back those NCDs?
They could. And again, the Indian investor holding that callable NCD finds their potential gains are limited. They can't fully benefit from the falling rate environment because they get their principal back early and have to reinvest at lower rates. It's a common feature you'll see in the Indian corporate bond market.
So callable bonds definitely favor the issuer when rates fall. What about the flip side, putable bonds? You said they give the investor the option.
Precisely. Putable bonds are the mirror image. They give you, the investor, the right to sell the bond back to the issuer before maturity, usually at par.
When would I want to do that?
Typically, if interest rates have risen significantly, if rates go up, the market price of your bond would normally fall below par. But with a putable bond, you can exercise your put option, sell it back to the issuer at par, avoid that capital loss, and then reinvest your money at the new, higher market rates.
So it protects my downside if rates rise.
Like insurance. Exactly like insurance. And because of that protection, the price of a putable bond is always higher than an identical non-putable bond. That difference is the value of the put option.
Okay. And how does this affect duration and convexity?
When benchmark yields are low, the put option isn't worth much, and the bond behaves like a normal bond. But when benchmark yields rise, that put option becomes very valuable. It limits the bond's price depreciation because the investor can always just sell it back at par.
So the price doesn't fall as much as a regular bond would when rates rise.
Correct. And importantly, putable bonds always maintain positive effective convexity.
Always positive, unlike callable bonds.
Yes. Their price depreciation is cushioned when rates rise, and they still have upside potential if rates fall. It's a much more favorable asymmetry for the investor compared to callable bonds.
That definitely sounds like a better deal for the investor.
Yeah.
Can we get some examples of putables too?
Sure. In the U.S., maybe a municipal bond issued by a city to fund a new school. It might have a put option. If interest rates spike unexpectedly, investors holding that bond can put it back to the city at par, protecting their capital, and reinvest elsewhere at higher yields.
Okay. And in India?
Imagine an investor holds a putable corporate bond from, say, an Indian infrastructure company. Then, maybe the RBI hikes rates unexpectedly to fight inflation. The market price of that bond would normally tank.
But the put option saves the day.
It provides a safety net. The investor can sell it back to the issuer, often at par, avoiding a potentially large loss they'd face selling it in the open market. It's a valuable feature, especially for bonds from less stable issuers or during volatile times.
Got it. Now, what about mortgage-backed securities? MBS. You mentioned them earlier. They seem notoriously complex. How do effective duration and convexity help us understand them?
MBS are definitely complex, and effective duration and convexity are absolutely critical for analyzing them. The big challenge with MBS is that their cash flows depend on homeowners' prepayment behavior.
Right. People refinancing their mortgages.
Exactly. If interest rates fall, more homeowners refinance. This means the investors holding the MBS get their principal back earlier than expected. This is called prepayment risk, and it acts a lot like the call risk in a callable bond.
So, again, limited upside when rates fall because you get your money back too soon.
Precisely. It shortens the effective duration. But there's also the opposite risk. If interest rates rise, homeowners are less likely to refinance or move. They hold on to their lower rate mortgages longer.
Meaning the MBS investor gets their money back later than expected?
Yes, and that's called extension risk. The bond's effective duration lengthens, making it more sensitive to further rate increases just when you don't want it to be.
Wow, so MBS have both prepayment risk and extension risk. Double trouble.
It makes them very sensitive to rate changes in complex ways. That's why effective duration and convexity are essential. Think about U.S. agency MBS, those issued by Fannie Mae or Freddie Mac. When U.S. mortgage rates drop, prepayments surge, shortening the duration. Investors need these tools to manage that.
Is there a similar dynamic in India? I know the MBS market is smaller there.
It is less developed than in the U.S., but it exists. Institutions like HDFC Housing Loans, for example, do securitize pools of their home loans. Investors in these Indian mortgage-backed securities or similar asset-backed securities face very similar prepayment and extension risks. If interest rates fall in India, you'll see Indian homeowners refinance more, and that impacts the duration and cash flows of those securities, just like in the U.S. The principles are the same.
Okay, this makes it crystal clear why we need these effective measures and what they tell us about callable, putable, and mortgage-backed bonds. Now let's get practical. The formulas. How do we actually calculate effective duration and convexity? Let's peek under the hood.
All right, let's look at the formulas. They might look a bit intimidating at first, but the concepts are fairly intuitive once you break them down. For effective duration, FDUR, the formula is an approximation, similar to how we calculated approximate modified duration. After PV, PV plus, to curve PV. Okay, let's break that down. PV and PV plus are the prices after the curve shift. Correct. PV is the price if the benchmark curve shifts down, rates fall, and PV plus is the price if the curve shifts up, rates rise. These come from our option pricing model.
Got it. And PV0?
PV0 is just the original price of the bond before any shift.
And curve?
Curve is the size of the parallel shift in the benchmark curve expressed as a decimal. So a 25 basis point shift is 0.00025.
Okay, so top part is the price difference from the shifts. Bottom part involves the size of the shift and the original price. Kind of like a percentage price change per unit of curve shift.
Exactly. It averages the sensitivity to upward and downward shifts. Now, for effective convexity, FCON, the formula captures that curvature. FCON PV plus to PV0 curve.
This one looks a bit more involved.
It's a second order effect. It's looking at how much the average of the two new prices, PV plus, deviates from the original price, PV0, adjusted for the size of the shift squared. A positive result means positive convexity price goes up more than it goes down. A negative result means negative convexity, the unfavorable kind we saw with callables.
Got it. It measures the acceleration or deceleration of price changes. Let's try plugging in the numbers from that example in the source material to really see it's in action. We had PV0 1.060, PV plus equals 99.050, PV equals 102.891, and the shift curve was 25 basis points, so 0.0025.
Perfect. Let's calculate effective duration first. After 102.89199.050, 2.001.060, after is 3.841, 0.5053, which comes out to after is 7.601.
Okay, after 7.00060.
Right.
Let's plug into the FCON formula. FCON 102.891 plus 99.050, 201.01.00000.00625, 101.060, made 0.0062 as CO 0.80, surrender 2 under 283. FCON is a negative 283.39.
Wow. Okay, so effective duration is 7.6, which seems pretty sensitive to rates, but that effective convexity is negative 283, a big negative number. What does that combination tell us about this bond's risk?
That's where the interpretation is key. The duration, 7.601, tells us it's quite sensitive to interest rate changes. A 1% parallel shift up or down in the benchmark curve would cause roughly a 7.6% price change in the opposite direction, based on duration alone.
But that large negative convexity, negative 283.39, is the really critical piece of information here. It screams callable bond characteristics. It means the bond's price will fall more if rates go up than it will rise if rates go down by the same amount.
That unfavorable asymmetry again.
Exactly. The price appreciation is capped or slowed by the call option, while the depreciation isn't. So if you were a portfolio manager looking for bonds with positive convexity bonds that help protect you more when rates rise, this bond would be a definite red flag. It works against that goal.
That makes sense. Now, a quick clarifying question. You mentioned earlier that even for option-free bonds, effective duration and modified duration aren't exactly the same. Why is that again? Seems subtle.
It is subtle, but important conceptually. Remember, effective duration uses shifts in the benchmark par curve. When that par curve is shifted in the model, the underlying spot curve, or zero Couton curve, also shifts. But the way it shifts isn't always perfectly parallel across all maturities in the same way we assume a single YTM changes for modified duration.
Ah, okay. So shifting the par curve causes a slightly different, maybe non-parallel shift in the spot rates used for discounting.
Exactly. Which leads to slightly different calculated prices, PV plus and PV, than if you just shocked the bond's single YTM up and down. The difference gets smaller if the yield curve is flat, or for shorter maturities, or bonds near par. But technically, they only become identical if the yield curve is perfectly flat, which rarely happens.
That's a fascinating detail. Shows the precision involved. Okay, so now we have effective duration and effective convexity. How do we use them together to get a better estimate of the bond's price change? Duration is the first guess. Convexity refines it.
Precisely. We can combine them into a single formula for a much better approximation of the percentage change in the bond's full price, the mere PV full, for a given change in the benchmark yield curve. Best price PV full, F-door curve, plus 0.5 FCON curve 2.
Okay, let's unpack that. The first part, F-door curve, that's just the standard duration effect, right? The linear approximation.
Correct. That's your first order estimate. The second part, 0.5 FCON curve 2, is the convexity adjustment. It adds or subtracts based on the curvature, capturing the nonlinear relationship between price and yield. This term becomes more important for larger shifts in the curve.
And it's the second term that really captures the impact of options and that negative convexity we saw.
Absolutely. It adjusts the linear estimate to account for that asymmetry.
Let's apply this to our example bond again. F-dur equals 7.601, FCON equals 283.39. What's the estimated price change if the benchmark curve goes up by 100 basis points? Curve equals 0.01.
All right, plugging in the numbers for a 100 BPS increase. I get 7.601 plus a 0.5, you get 283.39, 0.012. Percent PV full, min equals 0.07601, plane 0.09601. Percent FPV full, emit equal up 0.0901695, which rounds to about negative 9.02%, a drop of just over 9%.
Okay, a 9.02% drop for a 100 BPS rate hike. Now, what about a 100 BPS decrease in rates? Curve equals 0.01.
Let's calculate that. Terra PV, full euro, MATIFOS 7.601, MATIF 0.01 des, 0.5 def 283.39, MATIF 0.012. Remember, MATIF 0.012 is still positive 0.0012, percent PV full 1.0001 high, percent PV full 1.0.0141695, percent PV full, Kalivi full 0.061840.5, which rounds to about plus 6.18%, an increase of just over 6%.
Wow, that really shows it clearly. A 100 basis point rise leads to a 9% loss, but a 100 basis point fall only leads to a 6% gain. That negative convexity is really biting into the upside and exaggerating the downside.
It's a stark illustration of the risk. The negative convexity term, net of 0.014, adds to the loss when rates rise but subtracts from the gain when rates fall. It's crucial for anyone investing in callable bonds or MBS to understand this dynamic.
So from an investor's point of view, you absolutely need this analysis to understand your true risk and potential reward. You might be taking on more downside than you realize.
Absolutely. It helps in assessing risk, setting expectations, deciding position sizes, and even in hedging strategies. Without considering effective convexity, especially for bonds with options, your risk assessment is incomplete.
And what about the issuer? How does this look from their side?
Well, for the issuer of a callable bond, this feature, the negative convexity for the bondholder, is exactly what gives them flexibility. It allows them to refinance when rates fall, lowering their borrowing costs. They benefit from the structure that causes this asymmetry for the investor.
Great. And for a putable bond issuer?
For a putable bond issuer, they know investors have that protection if rates rise, which means the investors might demand a slightly lower yield up front. The issuer accepts the risk of having the bond put back to them if rates rise significantly, but gains some certainty in their funding otherwise. It's all about how risk is allocated between issuer and investor.
Can we see how this plays out in portfolio management?
Right.
Say, for an institutional investor in the U.S. or an asset manager in India.
Definitely. Imagine a large U.S. pension fund holding a lot of callable corporate bonds, maybe from companies like General Electric or AT&T. Using effective duration and convexity, the portfolio manager can run scenarios: what happens if the Fed hikes rates by 50 BPs or cuts by 75 BPs?
They can forecast the portfolio impact much better.
Precisely. It informs decisions about hedging interest rate risk, perhaps using derivatives, or maybe shifting allocation towards bonds with positive convexity if they anticipate volatility, or simply adjusting the portfolio's overall duration target.
Okay. And in India?
Picture an asset manager in Mumbai. Their portfolio includes callable debentures issued by various Indian corporations. Maybe the RBI is signaling rate cuts are coming.
The manager needs to know how much upside they really have.
Exactly. The effective duration and negative convexity calculations will show them that the callable bonds won't rally as much as non-callable ones. This might lead them to rebalance, maybe sell some callables and buy non-callables, or look at other asset classes entirely to make sure they can still hit their return targets for their clients in that falling rate environment. It's active management informed by these more advanced risk measures.
That really highlights how these tools move beyond simple duration into more strategic portfolio construction. But we've been mostly talking about parallel shifts, where the whole curve moves up or down together.
Yes, that's the core assumption for effective duration and convexity.
But we know reality is messier. Curves steepen, flatten, invert, they twist. How do we analyze the risk from those kinds of non-parallel shifts?
That's a fantastic point, and it brings us to the next crucial tool: key rate duration, sometimes called partial duration. While effective duration gives you the overall sensitivity to a parallel shift, it doesn't tell you much about how the bond reacts if, say, only short-term rates move or only long-term rates move.
Okay, so it breaks down the risk along the curve.
Exactly. Key rate duration measures the bond's price sensitivity to a change in the benchmark yield at a specific point, or key rate maturity, on the yield curve like the 2-year rate, the 5-year rate, the 10-year rate, the 30-year rate, while holding all the other key rates constant.
So you isolate the impact of a change at one specific maturity?
Precisely. This helps you identify and manage what's called shaping risk. The risk that changes in the shape of the yield curve will impact your portfolio value.
Shaping risk. I like that term. Can you give us an analogy?
Sure. If effective duration is like knowing how much a whole bridge sways back and forth in a uniform earthquake,
Okay.
then key rate duration is like knowing how much each individual pillar of the bridge moves when different parts of the ground underneath it shake differently. It gives you that pinpoint sensitivity analysis.
That's a great visual. So instead of one duration number, you get a set of key rate durations, one for each important point on the curve. How's the formula for that look?
The formula for the key rate duration at a specific maturity K looks like this. Key rate DIRK, 1 PV, key BV BIRK.
Okay, let's see. PV is the original price again. Here is the small change in just that one key rate at maturity K.
Correct. And T/V is the resulting change in the bond's price from shifting only that one key rate.
Yeah.
So it isolates the price impact of a tiny nudge at just one point on the curve.
And how's it calculated in practice? You can't just observe this easily.
No, it requires modeling. Analysts use their pricing models, including option pricing models if needed, and they shift only one key rate on the benchmark curve up and down by a tiny amount, maybe just 1 basis point. 0.00001, while keeping all other points on the curve unchanged.
Okay, just tweak the 5-year rate, for instance.
Exactly. They calculate the new prices, PV plus and PV, resulting from that single key rate shift, and use those to derive the key rate duration for that specific maturity, the 5-year point in your example. Then they repeat the process for each key maturity they care about, 2-year, 10-year, 30-year, etc.
So it's a series of targeted sensitivity tests.
That's a good way to put it.
Is there a relationship between all these key rate durations and the overall effective duration we talked about earlier?
Yes, there's a very neat and important property. The sum of all the key rate durations for a bond or a portfolio should be approximately equal to its effective duration.
Ah, so some key rate Dürkheim efter. They add up.
Roughly, yes. It provides a nice consistency check and links the granular analysis back to the overall risk picture. It shows how the total duration is distributed across the curve.
That makes a lot of sense. So how would a portfolio manager use this strategically? Knowing the duration isn't just one number, but spread across maturities seems really powerful.
It's incredibly powerful for active management. Knowing the key rate durations allows a manager to anticipate how their portfolio will react to non-parallel shifts and position it accordingly.
So if they expect the curve to flatten, for example.
Right. Let's say a manager expects short-term rates to rise more than long-term rates, a flattening. By looking at the key rate durations of their bonds, they can see which bonds are most sensitive to those short-term rates, high short-term key rate duration, and maybe reduce exposure there. They could also increase exposure to bonds sensitive to the long end if they expect those rates to stay stable or fall.
They can tilt the portfolio's sensitivity profile.
Exactly. They can tilt the portfolio's key rate durations to align with their view on how the shape of the curve is likely to change, aiming to add alpha or manage risk more precisely.
Can you give us a U.S. and an Indian example of this kind of strategic positioning?
Sure. Imagine a U.S. Treasury fund manager who believes the Federal Reserve is going to hike short-term rates aggressively, but they think long-term inflation fears will cool down. Their view is a flattening yield curve.
Okay, short rates up, long rates steadier down.
Right. They look at the key rate durations for their 2-year, 5-year, 10-year, 30-year treasuries. They might see high sensitivity at the 2-year point. So they could sell some 2-year treasuries and perhaps buy more 10-year or 30-year treasuries, effectively reducing their portfolio's sensitivity to the short end and maintaining or increasing sensitivity to the long end, positioning to benefit from that expected flattening.
Makes sense. How about in India?
Let's say an Indian fund manager expects the RBI to hold the repo rate steady, but they're worried about government borrowing pushing up longer-term GSEC yields. So they expect a steepening of the curve.
Okay, short rates stable, long rates rising.
They analyze the key rate durations for their holdings of Indian government securities, GSECs, across different maturities, maybe 5-year, 10-year, 15-year. If their analysis shows a high key rate duration at the 10-year point and they expect 10-year yields to rise,
They want to reduce exposure to that 10-year point.
exactly. They might sell some of their 10-year GSEC holdings, perhaps participating in an RBI auction if they're primary dealer, or just selling in the secondary market to lower the portfolio's sensitivity to that part of the curve they expect to underperform. It allows for much more precise risk management than just managing the overall effective duration.
That really shows the power of granularity. Key rate duration lets you manage shaping risk, not just parallel shift risk. Okay, this leads us to the final major topic for today. The difference between analytical duration and empirical duration. What's the story here?
This is a really interesting and practical distinction. It gets down to the difference between theoretical models and observed market reality. Analytical duration basically refers to all the duration measures we've been discussing so far, modified, effective, key rate durations.
So one's calculated using formulas and models.
Exactly. They're derived using mathematical formulas based on specific predefined scenarios like a parallel curve shift or a single key rate shift. And importantly, a key underlying assumption in many of these analytical models is that benchmark yields, like treasury yields, and credit spreads move independently of each other. They're assumed to be uncorrelated.
Okay, so analytical is model-driven, assumes independence between rates and spreads. What's empirical duration then?
Empirical duration takes a different approach. It's estimated using statistical models applied to historical market data. Fixed income professionals look at how a bond's price actually moved in the past relative to changes in various market factors.
So it's based on observation, not just theory.
Right. These statistical models incorporate not just benchmark yield changes, but potentially other factors affecting bond prices, like changes in credit spreads, liquidity measures, even equity market volatility. And crucially, These models capture the historical correlations between these factors.
Ah, so empirical duration doesn't assume independence between rates and spreads. It looks at how they actually moved together in the past.
Precisely. That's often the most critical difference. Empirical duration reflects how bonds really behaved historically, including any relationships between different risk drivers, rather than how a purely theoretical model says they should behave based on isolated inputs.
That sounds potentially much more realistic, especially for bonds that aren't just simple government bonds. Where does this difference really bite?
The difference becomes starkest when you look at bonds with significant credit risk, especially during times of market stress. Think about a flight to quality scenario.
We mentioned this earlier, like the start of the pandemic in 2020. Investors sell risky stuff, buy safe stuff.
Exactly. So what happens? Investors dump corporate bonds, risky, and pile into government bonds, safe.
Okay, so government bond yields fall sharply due to high demand.
Right. And at the same time, credit spreads on corporate bonds widen dramatically because investors are demanding much more compensation to hold that perceived risk.
So falling government yields, but widening corporate spreads, they're moving in opposite directions.
Correct. Now consider a government bond. Since it has minimal credit risk, its price is mainly driven by the benchmark yield changes. So its analytical duration and empirical duration would likely be pretty similar. Both would show the price rising as yields fall.
Okay, but what about a corporate bond?
Here's the divergence. Analytical duration, assuming independence, would look at the falling government yields and predict a price increase for the corporate bond.
But that ignores the widening spread.
Exactly. Empirical duration, because it captures the historical negative correlation between benchmark yields and credit spreads during such crises, would show a much lower price increase, or possibly even a price decrease. The negative impact of the widening credit spread offsets, or even overwhelms the positive impact of falling benchmark yields.
So analytical duration gives you the wrong signal in a crisis for a corporate bond, while empirical duration captures the offsetting effects.
In that scenario, yes. Empirical duration provides a much more realistic picture of how bond's price is likely to behave because it incorporates the combined correlated impact of both interest rate risk and credit spread risk.
Can you give us those U.S. and Indian examples again in this context? How did this play out?
Let's revisit Q1 2020. The 10-year U.S. Treasury yield plummeted. At the same time, U.S. corporate BB credit spreads exploded upwards.
A clear negative correlation.
Absolutely. Now, if you held a bond from, say, Tesla or another BB-rated company, analytical duration, based only on the Treasury yield drop, might have suggested a nice price gain.
Yeah.
But empirical duration, factoring in that huge jump in the credit spread, would have given a much more sobering and accurate estimate of the price change, likely a much smaller or even negative. The market was pricing in increased default risk alongside the flight to safety.
Got it. And in India.
Imagine a similar stress scenario in India may be triggered by global factors or domestic issues. Investors sell Indian corporate bonds and rush into Indian G-Secs. G-Sec yields fall, but credit spreads on corporate bonds, say from an Infosys or perhaps a smaller infrastructure firm, widen significantly.
Same pattern.
Right. For that Indian corporate bond, analytical duration would only capture the G-Sec yield drop, suggesting a price rise. But empirical duration, reflecting the historical tendency for spreads to widen when G-Sec yields fall sharply in a crisis, would give a more accurate forecast, accounting for the negative impact of that widening spread. It captures the interplay between rates and credit risk as observed in the market.
So when should we rely on empirical duration? It seems clearly better for bonds with credit risk, right? Are there downsides?
Generally, yes. For government bonds with little to no credit risk, analytical and empirical durations will likely be quite close. But for corporate bonds, especially lower-rated ones, or bonds with liquidity concerns, empirical duration is usually the more accurate and relevant measure. It gives a better forecast of actual price behavior because it implicitly includes the sensitivity to credit spreads and their correlation with benchmark rates.
So it's the go-to for credit-sensitive bonds. What are the catches? It sounds like you need good data and models.
That's the challenge. Estimating empirical duration isn't trivial. You need to make choices. What historical period do you use? Recent data reflects current conditions but might miss longer cycles. Older data might be irrelevant. What factors do you include in your statistical model besides benchmark yields and spreads? Maybe equity volatility, commodity prices.
Lots of modeling choices.
Yes, and there's always the risk of overfitting the model to past data so it doesn't predict the future well. And of course, empirical models rely on past relationships holding true. For a truly unprecedented black swan event, Even empirical duration might struggle if historical correlations break down completely. It requires careful statistical work and judgment.
It sounds like a powerful tool, but one that requires expertise to use effectively. This whole discussion has been incredibly insightful, really peeling back the layers on fixed income risk beyond the basics.
It really moves into the practical application, doesn't it? Bridging theory and market reality.
Absolutely. So let's try and wrap up Module 13. Today, we really took a deep dive, didn't we?
We certainly did.
We started by seeing why the standard yield-based duration and convexity just don't work well when cash flows get uncertain, like with bonds having embedded options.
Right, the assumptions break down.
That led us straight to effective duration and effective convexity. These use benchmark curve shifts and option pricing models to give a much better handle on price sensitivity, especially for callable bonds, putable bonds, and MBS.
And we saw that crucial concept of negative convexity in callable bonds.
Yes, that unfavorable asymmetry, limited upside, amplified downside, definitely something to watch out for. Then we moved beyond parallel shifts with key rate duration.
Breaking down the risk along the curve.
Exactly. Measuring sensitivity to specific maturity points, which is vital for managing shaping risk and implementing more nuanced portfolio strategies.
A really powerful tool for active managers.
And finally, we contrasted analytical duration, model-based, assuming independence, with empirical duration, data-based, capturing correlations. We saw why empirical is often better for bonds with credit risk.
Especially during market stress, when that negative correlation between rates and spreads really kicks in. It reflects market behavior more accurately.
So a fantastic set of advanced tools for understanding interest rate and curve risk.
Definitely. But understanding how bonds react to rates and curve shapes, as crucial as it is only part of the fixed income story.
Right, there's the other major risk factor.
Exactly. Now that you're equipped with these tools for interest rate risk, our next deep dive, Module 14, is going to shift focus squarely onto credit risk. We'll get into the nitty-gritty of how we assess an issuer's fundamental ability and willingness to actually pay back their debt.
Perfect transition. From rate risk to credit risk. It covers the two biggest drivers of bond returns and risk.
So as we wrap up Module 13, here's a final thought to chew on, especially after our discussion on empirical duration. In today's world, markets seem increasingly volatile, interconnected. Unexpected events feel almost commonplace. Do you think our elegant, clean, analytical models can ever truly capture the full spectrum of risk? Or will the, let's call it the wisdom of the crowd, reflected in messy historical data, and those complex correlations, will that always offer a more profound, even if less tidy, insight into how bonds are actually priced? Something to ponder as you continue your CFA journey. That wraps up our deep dive into Module 13.
Welcome to the CFA Level I 2025 Fixed Income Volume 6. Today we're really digging into Module 14, Credit Risk. And this module, well, it's absolutely fundamental. It's about understanding trust in debt markets, the whole risk and reward dynamic.
Exactly.
Yeah.
It's critical for anyone wanting to grasp how fixed income instruments get evaluated and priced out there in the real world.
Kind of like being a financial detective.
Right.
Uncovering the real story behind the promises.
That's a good way to put it, because credit analysis isn't static at all. It's dynamic, always needing reevaluation as things change. And as the risk components shift, well, the market reprices those instruments. So today, we'll cover the basics, the components, ratings, and what drives credit risk.
It's about getting that granular picture, isn't it? What you're really signing up for.
Precisely. Understanding the compensation for the risk you take.
Great. And just so you know, next up will be Module 15. We'll build on this and look specifically at credit analysis and government issuers. But first things first, let's unpack this crucial concept of credit risk. At its heart, it's all about the borrower's ability and, importantly, their willingness to keep their promises. #TAG. Understanding credit risk and its core components. Okay, so let's elevate credit risk beyond just a simple definition. It's the potential for economic loss, right? When a borrower doesn't make those full, timely payments they agreed to.
Exactly. It's not just a black and white default scenario. It's a spectrum, a form of performance risk in any lending contract.
When you buy a bond, you're buying that promise. Credit risk is the market's price tag on the chance that promise gets broken.
And for you as an investor, it's about getting compensated not just if a default happens, but for the expected economic loss over the bond's life. Think of it as a probability-weighted shortfall. Even for top-tier issuers, the chance might be tiny, but the potential loss still needs factoring in.
Right. Getting that true risk-adjusted return picture. And to really break down this expected loss, we need to look at two main things: the probability of default, POD, and the loss given default, or LGD.
Let's start with POD.
Okay.
Probability of default. It's simply the likelihood an issuer will fail on payments over a certain time, usually annualized. The chance the promise breaks.
So let's take a U.S. example, like an Apple bond. Huge company, solid balance sheet.
Their POD would be incredibly small, tiny fractions of a percent. It reflects that remote possibility of something catastrophic,
Right.
But it's still there, priced into the tiny spread over treasuries. No credit risk is truly zero.
Got it. And flipping to India. Maybe a mid-sized company, say a newer renewable energy firm issuing an NCD, a non-convertible debenture.
Their POD might be noticeably higher, maybe 2%, 3%, could be more.
Not necessarily bad, just different risks.
Exactly. Business volatility, maybe a newer market, reliance on funding, shorter track record. All that means investors assign a higher POD and demand a higher premium for that NCD. You have to look at the specific issuer.
Okay, so that's the if. What about the how much? If the default actually happens.
That's where loss given default, LGD, comes in. It's the actual financial hit you take. It combines the severity of the loss with your expected exposure, EE, at the time of default, sometimes called EAD, exposure at default.
And a key part of LGD is the recovery rate, RR, right? How much you get back.
Precisely. LGD is essentially your expected exposure multiplied by 1 minus the recovery rate. So EE1RR.
And that expected exposure, it's your total vulnerability when default hits.
Yes. For a bond, usually principal plus accrued interest minus any collateral. But think about a corporate line of credit. EE could even include the undrawn portion they might pull down right before defaulting. That makes it worse for the lender.
Ouch. Okay, so POD and LGD, bringing them together.
Gives us expected loss, or EL. It's the probability-weighted loss. EL equals POD, A, LGD. We can state LGD in currency, say, EUR 450,000, useful for one deal. But for comparing across investments, expressing it as a percentage, like 45%, is much better, makes benchmarking easier.
And this is where it gets really practical, isn't it? Using these to see if we're fairly paid for the risk.
Exactly. There's a very useful approximation. Credit spread, APOD, ALGD. Remember, the credit spread is the extra yield over a risk-free benchmark, like a treasury or a GSEC. If that spread you're earning is greater than your calculated expected loss, POD, ALGD, then generally you're considered compensated for the credit risk.
Okay, let's try that with the calculation from the source. The BRWA bond example. U.S. context. It's unsecured, 5-year, 3.2% coupon, trading at a 90 basis point G spread over treasuries. G for government spread.
Right. And let's say our analysis estimates its POD at 1% per year and LGD is 80%.
So expected loss, EL, is 0.01 times 0.80, which is 0.008, or 0.8%, 80 basis points.
Perfect.
Since the credit spread is 90 basis points, and that's more than the EL of 80 basis points.
The investor is fairly compensated. They get that extra 10 BP's margin for the risk. Makes it look potentially attractive, assuming our estimates hold.
Makes sense. How about an Indian context example?
Okay, let's hypothesize. Imagine you're looking at an INR 500,000 loan, maybe a privately placed NCD, to a mid-sized Indian real estate developer. We assess the POD as higher, say 5%, given sector risks. The loan has some collateral, maybe land worth INR 100,000. We estimate the recovery rate, RR, on the unsecured part at 90%. So the expected exposure, EE, after collateral is INR 400,000.
Okay, calculated. The EL POD is 0.05. Exposure minus collateral is 400K, 100K, so 300K, and 1RR is a 1.9, which is 0.1.
Right, so EL equals 0.05, INR 300,000, 0.1, which comes out to INR 1,500.
So an investor would compare that INR 1,500 EL to the actual yield spread offered on that NCD.
Precisely. If the spread offered amounts to, say, INR 2,000 per year for that loan size, the investor is getting INR 500 above their expected loss. That helps quantify if it's fair compensation. #tag2. Sources of credit risk and borrower types.
Right, so we know what credit risk is and how to sort of measure with POD and LGD, but what causes it? What are the triggers?
Good question. It's rarely just one thing. It's a mix of factors, some specific to the borrower, some more about the bigger picture. Analysts often use the C's of credit analysis framework. We can split these into bottom-up, issuer-specific things, and top-down, more general factors.
Okay, the C's. Let's start bottom up.
First C is capacity, the borrower's ability to generate cash to pay debt. It's quantitative, looking at cash flow, revenue stability. Second, capital. The company's financial strength, equity, other resources providing a cushion, think debt to equity, liquidity ratios, also quantitative. Third, collateral, quality and value of assets backing the debt. This is both qualitative, how sellable is it, and quantitative, what's it worth. Better collateral means lower LGD.
Makes sense. What else?
Fourth, covenants. These are the legal terms in the debt agreement the issuer has to follow. Mostly qualitative protective clauses for lenders. They act like tripwires.
Like don't take on too much more debt or maintain certain ratios.
Exactly. Affirmative covenants require actions. Negative ones prohibit actions. And the fifth C, often the trickiest, is character. This is about management quality, their ethics, their willingness to repay, very qualitative reputation, track record, governance. Sometimes underestimated, but crucial. You mentioned financial detectives earlier. Assessing character back in the day was even more art than science.
I bet. Okay, let's try a U.S. example for these Cs. Say Tesla issuing bonds.
Okay. Analysts would look at their cash flow from operations, scaling production, that's capacity, their equity base from capital raises, liquidity, that's capital, any specific assets pledged for secured debt collateral, management's track record, innovation, maybe volatility character, and the specific bond terms, covenants.
And for India, maybe a big player like Reliance Industries issuing NCDs.
Similar process. Assess cash generation from their diverse businesses, petrochemicals, telecom, retail, that's capacity, their large capital base, debt levels capital, whether the NCDs are secured or unsecured, specific terms, collateral, and covenants, and the leadership strength and reputation character, often a big factor for Indian investors.
Got it. Now the top-down factors.
Yeah.
The bigger picture.
Right. First, conditions. The general economic climate, competition, industry trends, GDP growth, inflation, rates, market sentiment. Then, country. The geopolitical stability, legal system, political environment where the issuer operates. Hugely important, especially for cross-border debt. And finally, currency. The risk from exchange rate changes, especially if borrowing in foreign currency without hedging. A falling local currency can balloon foreign debt repayment costs.
That makes sense. And you mentioned a distinction earlier, illiquid versus insolvent.
Yes, very important. Illiquid means they can't raise cash right now, even if assets cover liabilities overall. A temporary cash crunch. Insolvent means liabilities actually exceed assets. A fundamental problem, usually leading to bankruptcy. One's a timing issue, the other's a solvency crisis.
Huge difference for investors. Okay, so how repayment happens differs too, right, between corporates and governments.
Absolutely. For corporate bonds, the main repayment source is operating cash flow from the core business. Secondary sources, maybe selling assets, new debt, new equity.
And the risks. Recession hitting sales, bad strategy, competition, margin pressure, too much debt.
Exactly. For sovereign or public entity bonds, the primary source is tax revenues. Income tax, sales tax or GST, tariffs, fees. Governments collect money.
Secondary sources might be issuing new debt, selling state assets.
Right. The risks here are more systemic. Economic contraction, hitting tax take, political instability, huge deficits, poor tax collection ability, excessive debt burden.
So U.S. Treasury bonds are super safe because the U.S. government has a massive economy and undeniable taxing power. Default risk is seen as practically zero.
The global benchmark, effectively.
And in India, the equivalent benchmark would be central government securities, GSECs. Backed by union government tax revenues, RBI manages issuance.
Correct. Safe haven asset in India. But if you look at a bond issued by an Indian state government, it's different. Like a U.S. muni bond, repayment depends on that state's revenues, fiscal health. The analysis gets more localized. You look at the state's economy, tax efficiency, maybe even the project being funded.
Okay, let's loop back to ELL's POD ALGD. We said POD, probability of default, hinges on the issuer's ability to pay. We assess that with the qualitative Cs, but also, crucially, with hard financial metrics.
Right, the quantitative side. So what specific ratios do analysts really drill down into for corporates? What numbers give us that insight into profitability, coverage, leverage? Good question. Analysts focus on several key areas. First, profitability. You want stable, predictable cash flows and profits. Think EBIT margin, earnings before interest and taxes sales, or EBITDA margin. Higher is generally better, showing strong core operations leading to lower POD. Second, coverage. Does the company earn enough to easily cover its debt payments? Look at EBIT to interest expense, interest coverage ratio, or the debt service coverage ratio, DSCR. Higher ratios mean more breathing room, less financial strain. Third, leverage. How much does the company rely on debt versus equity? Key ratios are debt to EBITDA, cash flow to net debt, debt to equity, debt to capital. Generally, lower leverage means less risk, a stronger balance sheet, lower POD, though the right level varies by industry. Utilities can handle more debt than tech startups.
I'm thinking of that Exhibit 5 concept now. Higher profit, higher coverage, lower leverage all point toward lower POD, higher credit quality. It's intuitive, but applying these ratios effectively is the key, right? Knowing why they move.
Absolutely. Deep insight comes from understanding the dynamics. Now, while POD is about the likelihood, loss given default, LGD, is more about the consequences. And that depends heavily on the debt's nature and its seniority in the capital structure. Legal stuff matters here.
Seniority where you stand in line if things go bad.
Exactly. Secured debt usually has much lower LGD. It's higher ranking and backed by specific pledged assets. If default happens, secured creditors have first claim on those assets, boosting recovery chances. Unsecured debt, on the other hand, has higher LGD. Lower ranking relies on the general pool of assets after secured claims are met. Recovery rates can be much lower, sometimes minimal.
Let's revisit that BRWA versus DIU example. BRWA is investment grade but issued unsecured debt. If they defaulted, investors rely on the general asset pool. Recovery might be limited.
Correct. Now, VIVU is high yield, so higher POD, but it borrows mainly on a secured basis, maybe pledging inventory or equipment. If VIVU defaults, those secured lenders have direct claims on those assets. This lowers their LGD, even though the default risk, POD, was higher initially. The collateral is a safety net.
We can see that in India, too. Say, State Bank of India, SBI, issues bonds. A secured SBI bond, maybe backed by loans or property, would likely have lower LGD than an unsecured SBI bond, even though SBI itself is very strong credit.
Right. And conversely, an unsecured NCD from a small Indian startup, likely very high LGD, no specific collateral, higher business risk, maybe fewer assets for recovery.
So how does this difference affect how investors manage risk for investment grade versus high yield?
Great question. For IG bonds, where POD is already low, the biggest risk is often an unexpected rise in POD, a sudden shock or downgrade. For HY bonds, where default is a more tangible risk, investors focus more on lowering LGD. They push for stronger security, tighter covenants, better seniority in the debt structure. It's about damage control if or when default happens. #TechIV. Credit rating agencies and their role.
Okay, we've covered a lot on risk components and measurement. But how do we get a quick, standardized view across all these different bonds and issuers globally? That seems to be where rating agencies come in.
That's their main function, yes. The big three Moody's, S&P, Fitch, provide independent assessments. They use models, qualitative analysis, aiming for symbol-based ratings like AAA, AA, B, etc. for comparability. Remember, it's usually an issuer pays model. They monitor ratings ongoingly and might issue outlooks positive, negative, stable, signaling potential changes.
So for you, the investor, what do these letters actually mean? What's the difference between an A and a B?
The crucial line, as shown in Exhibit 7, is between investment grade, IG, and non-investment grade, high-yield junk. IG is BAHE 3 BBB, or higher. Lowest perceived default risk. AAA is the best. Big institutions, pension funds, insurers often must hold mostly IG bonds due to rules or policies.
In non-investment grade.
That's BA 1BB plus or lower, substantial to very high credit risk, definitely speculative. They offer higher potential yields to compensate, but the default risk is much, much higher. Attracts investors with higher risk tolerance.
So a U.S. example, a municipal bond from a stable state like California, likely IG, good for institutions seeking stable income.
Yes, or a bond from Apple or Microsoft. Solidly IG.
And in India, RBI-issued bonds, GSECs, or bonds from top public sector units like NTPC or Power Finance Corp.
Typically IG. Lower risk due to government backing or strong operations. Favored by large domestic and foreign institutions looking for quality Indian debt.
But, as we know, it's not a perfect system. History shows ratings can miss things badly. What are the big limitations we need to be aware of if we're relying on these ratings?
A critical point. Relying only on ratings is risky. First, ratings often lag market pricing. They're sticky. Agencies take time to decide. Markets react instantly to news via spreads and prices. By the time a rating changes, the market may have moved significantly already. You could be way behind the curve.
So the market often smells trouble before the rating changes.
Frequently. Credit default swaps, CDS, often move much faster. Second, agencies can overlook key risks or find them hard to model. Think litigation, environmental liabilities, cyber risks, sudden big acquisitions financed with debt. These nuances need deeper digging by the investor.
That reminds me of the 2008 crisis and those AAA-rated mortgage securities that blew up, or accounting scandals like Enron, WorldCom, even Wirecard more recently in Germany.
Exactly. Those are examples of miscalculations or unforeseen changes. The information might be flawed or the risks too new. The models didn't capture reality.
And sometimes agencies don't even agree, right?
Yes, split ratings. Different agencies use different methods, different judgments. WeWork in 2018 is a classic case. Fitch said BB, S&P said B plus M, Moody's K1, all junk, but different levels of risk implied. Investors have to do their own homework.
The Wirecard story you mentioned is a really stark example of the lag problem.
It really is. Wirecard had an investment-grade Bathory rating from Moody's in August 2019. But just 2 months later, October 2019, after fraud allegations hit the news, its bond price tanked below 85 cents on the dollar.
But the rating didn't change immediately.
No. Despite market panic and mounting evidence, Moody's kept the IG rating until June 2020. Only then, when billions in missing cash were confirmed, did they slash it to junk, B3, and then withdraw it. The company filed for insolvency, bonds went below 20 cents.
Wow. A huge lag. It really shows you need to do your own due diligence, not just trust the symbol. Look at the market, the news, the financials yourself. #V. Factors impacting yield spreads. Okay, so credit spreads are the extra yield for taking risk. But what makes them move? Widen or narrow? It seems like a mix of the big picture, market mood, and the issuer itself.
That's spot on. That fluctuation is credit spread risk. The risk your bond value drops because spreads widen, reflecting higher perceived risk or lower liquidity. And yes, the drivers fall into those 3 buckets: macro, market, and issuer specific.
Let's start with macroeconomic factors. The big one seems to be the credit cycle, right?
Absolutely. Top of the cycle economy booming, confidence high spreads are tightest. Risk seems low. Bottom of the cycle recession, fear spreads blow out. Defaults are expected. Investors demand huge premiums.
And high-yield bonds play an interesting role here.
They do. Besides higher coupons, they can offer portfolio diversification because their returns aren't always perfectly correlated with IG bonds or rates, especially outside of major crises.
But during a crisis, they all fall together.
Correlation spike, then, yes. But in recoveries or specific sector downturns, that lower correlation can help. HY also offers potential for capital appreciation. In a recovery, spreads narrow, prices rise, often more dramatically than for IG bonds, and sometimes equity-like returns with lower volatility due to the steady coupon income buffering price swings compared to pure stocks.
But when things get scary, we see that flight to quality.
Yes. Investors dump risky assets like corporates, widening HY spreads, and rush into safe havens like treasuries, bunds, or Indian G-Secs, tightening their spreads. It's a self-reinforcing cycle.
Like in the U.S. recession, selling, say, airline bonds and buying treasuries. Spreads on airline bonds widen.
Exactly. And treasury yields fall as prices rise.
Same in India. A slowdown might see investors sell bonds from, say, an infrastructure company and buy G-Secs. Corporate spreads widen.
Correct. The RBI might intervene to stabilize G-Secs, but the dynamic holds.
And Exhibit 9 shows HY spreads move much more dramatically than IG spreads through the cycle.
Much more sensitive. HY issuers are more vulnerable to economic swings. Investors demand a much bigger risk premium when things look shaky, so their spreads fluctuate more wildly.
Are there other broad reasons spreads move?
Yes. Tighter regulations like Basel III increased bank capital costs for holding credit risk, reducing market-making capacity and widening spreads. Funding stresses in money markets, like repo, increased dealer costs, also widening spreads. And heavy new issue supply can overwhelm demand, pushing prices down and spreads wider.
Okay, what about market factors like liquidity?
Market liquidity risk is key. It's about transaction costs, the bid-ask spread. Less debt outstanding, infrequent trading, lower credit quality all mean higher liquidity risk and wider bid-ask spreads. It costs more to trade.
So a liquid treasury might have a tiny fraction of a basis point spread, but a small corporate bond might have 10 or 20 BPs.
Easily. That's your cost for getting in or out.
The source had that French government bond example. Bid 93.75, offer 93.775.
Right. Calculating yields at bid and offer gave a liquidity spread of 0.00054% or 5.4 basis points. That's the transaction cost embedded in the yield.
And in India, a less traded corporate NCD would have a much wider bid-ask spread than a liquid GSEC, maybe 25-50 BPs.
Definitely. That illiquidity impacts your potential return if you need to sell.
And we can break down the total spread, like that Romania Eurobond example.
Yes, spread decomposition. You take the bond's total spread over its benchmark, like a German bond, then calculate the liquidity spread from the bid-ask. The rest is the pure credit spread for the issuer's risk. So if the total spread was 306 BPs and liquidity spread was 12 BPs, the credit spread is 294 BPs.
That's useful. Shows how much you're paid for illiquidity versus actual credit risk.
Precisely. Finally, issuer-specific factors. Even within the same market conditions, an individual company's performance and decisions matter hugely. Things like their debt coverage and leverage are constantly watched. Investors also compare bonds within the same rating, sector, or business model to find relative value.
The WeWork case study really highlights this, doesn't it? How issuer specifics can dominate.
Absolutely. WeWork's bond yield volatility was way higher than average B-rated bonds. After its failed IPO in 2019, its yield nearly doubled, while the B-rated index yield actually fell. Market panicked about its specific funding situation.
Then COVID hit its business model hard.
Disproportionately hard. Bonds crashed, ratings downgraded. But then the recovery and eventual IPO via SPAC plus debt reduction efforts helped yields fall back closer to B-rated peers, despite its history.
What really stands out to you about WeWork's wild ride and how its bonds reacted?
The sheer amplitude of the swings. It shows how an unproven model, high leverage, and funding dependency create extreme vulnerability. Idiosyncratic risk completely overwhelmed the market trend at times, a real wild card.
And we could imagine an Indian parallel. A fast-growing, asset-light tech startup relying on VC funding issues debt.
Yes, a failed funding round, a regulatory change hitting its specific model, its bond yields, could spike dramatically, far more than an established firm like Infosys, because the market instantly prices in that amplified specific uncertainty. #6, the price impact of spread changes.
Okay, so spreads move. How does that actually hit the price of a bond you own? This sounds like where duration and convexity come back in, but applied to spreads.
Exactly that. For a plain vanilla fixed-rate bond, the same duration and convexity stats we use for interest rate changes also approximate price changes from spread changes. The spread is just part of the total yield. For small changes, it's roughly pricely. Price change, annualized modified duration, x spread.
Simple enough. But for bigger moves.
You need convexity for accuracy. The formula becomes % price change and mod dur S spread, plus half and convexity spread. And remember to scale convexity correctly. If duration is 5 and convexity is reported as 0.235, you usually need to use 23.5 in the formula if the spread change is a decimal, like 0.01 for 1%. Critical detail for accuracy.
Okay, let's see this with numbers. The BRWA bonds in Exhibit 11.
Right. It compares a 5-year and a 10-year BRWA bond. For small spread changes, like 25 BPs, duration alone is pretty good. But for larger changes, like 150 BPs widening, adding convexity significantly improves the price change estimate. The main takeaway: longer duration bonds have higher spread sensitivity. The prices move much more when spreads change. More risk on the downside, more potential gain on the upside.
And the remaining Eurobonds example reinforces this, comparing a 2030 and a 2049 bond.
Definitely. The 2049 bond has much higher duration, 17.3 versus 8.3, and convexity, 389 versus 79. It's far more sensitive. A small shift in Romania's perceived risk causes a much larger price swing in the longer bond.
It's fascinating how duration really magnifies the impact on those longer bonds, isn't it?
It really is. It's not linear. The impact grows exponentially further out. Small spread moves that barely affect a 5-year bond can cause huge percentage drops in a 20-year bond because those distant cash flows are so sensitive to the discount rate, which includes the spread.
We'd see the same in India, right? Comparing a 5-year Emphasis bond to a 15-year Reliance bond.
Absolutely. The longer duration Reliance bond would be significantly more sensitive to shifts in perceived Indian corporate credit risk or liquidity. Bigger price swings for the same spread change, more risk, more reward potential.
And this isn't just theory. The credit downgrade example shows real pain. BRWA 2030s and 2035s.
Yes. Imagine a one-notch downgrade due to tech environmental risk. Spreads widen, say, 1.0%, 100 BPs for the 2030s, but a bigger 2.2%, 220 BPs, for the longer 2035s, reflecting more long-term uncertainty. Calculating the price impact, the 2030 bond drops about -3.7%, but the longer 2035 bond, it plunges roughly -13.1%.
Wow, that really drives home the impact of credit migration risk on longer duration bonds.
It underscores why managing duration is critical when thinking about credit. Higher yield comes with higher spread risk, especially for longer bonds.
It's a fundamental trade-off.
Exactly. And remember, the quoted yield is just the starting point. Your realized return will differ based on rate changes, reinvestment rates, holding period, and all these credit risks, default, LGD, spread changes. Volatility also varies massively by rating. HY bond returns swing much more than IG. It's the whole journey that matters. #outro.
And that brings us to the end of our deep dive into Module 14. Credit risk. a really foundational piece for navigating fixed income.
We definitely covered a lot. We looked at credit risk itself, POD, LGD, EL. We unpacked the C's of credit analysis, both bottom-up and top-down. We discussed rating agencies, their role and limitations. And we explored what drives yield spreads, macro market, issuer factors, and how duration and convexity determine the price impact of those spread changes.
That neatly wraps up Module 14. Next time we'll move into Module 15, Credit Analysis of Government Issuers. We'll look at sovereign and non-sovereign debt in detail. So as you look at fixed income, here's something to think about. Beyond that initial yield number, are you truly being compensated for all the credit risks involved, especially the ones that might slip past the ratings or only show up later? Your own analysis is key.
Welcome back to the Deep Dive, your personalized shortcut to being well-informed. We cut through the noise to bring you the insights that really matter in the financial world. Today, we're embarking on, well, a pretty crucial journey. It's all about government finance, and this is especially for those of you working through the CFA Level I 2025 Fixed Income Volume 6 course. We are right on Module 15, which gets into credit analysis for government issuers. Now, here's the challenge we're sort of tackling today. How do you really figure out how stable something as huge and, frankly, complex as a nation's economy is? How do investors weigh that promise of repayment from a sovereign state against, well, all the constant churn of politics, economic dips, global crises? It's a lot. Our mission today is to demystify this, to break down the art and science behind evaluating the creditworthiness of governments. We're talking national treasuries, local municipalities, public agencies, the whole spectrum. We'll uncover what makes government debt kind of unique, the factors, sometimes surprising ones, that influence its safety, and how smart investors actually gauge the risks involved. It's a world with a different rule book compared to corporate debt, and getting these distinctions is, well, key.
Yeah, what's really fascinating here is that unlike corporate credit, where you're often laser focused on a company's profits, its balance sheet, government credit analysis brings in a whole other set of considerations, completely different factors. We're talking about things like, the underlying political stability, how strong the legal system is, even down to this very basic concept of willingness to pay. And this raises a really fundamental question for any investor, doesn't it? What actually happens when a country, for whatever reason, just can't pay its debts?
Mhm.
Or maybe even more controversially, won't pay? The knock-on effects can be huge.
That's a powerful way to frame it. Gets right to the core of the issue, I think. And just a quick heads up for everyone listening. Once we've thoroughly unpacked government issuers today, our next deep dive, which will be Module 16, is going to shift focus. We'll be looking at credit analysis for corporate issuers. It'll be really interesting to compare and contrast, see where the principles align and where they really diverge when we look at businesses. But for now, let's dive deep into governments. Okay, so let's start with the basics, the fundamental building blocks. When we talk about government debt, what really sets it apart? What are those core distinctions from corporate debt? It just feels different, doesn't it? A country isn't exactly selling widgets.
You've hit it right there. The differences are profound, and they mainly revolve around two things. The use of proceeds, what the money's for, and the source of repayment, where the money comes from to pay it back. Think about a corporation. When it borrows, right? It's usually for things like working capital, maybe investing in new machines, building a plant, expanding its market reach. The goal fundamentally is to generate profit.
Yeah.
That profit then flows back to repay the debt and hopefully reward shareholders. It's a very clear economic engine driving repayment. Governments, though, they operate under a different mandate entirely. They borrow to fund what we call fiscal policy. That means providing public goods, essential services for their citizens. Could be anything, really. Building roads, bridges, power plants, funding healthcare, schools, even national defense. They also borrow just to cover their ongoing budget needs, especially if the economy slows down and there's some unexpected crisis. Their purpose isn't profit in the same way a business's is. So naturally, their sorts of repayment is fundamentally different too. Corporations rely on cash flow from their business operations. Governments, on the other hand, tap into a much, much broader pool. We're talking tax revenues from people, from businesses, tariffs on goods coming into the country, various fees for services they provide, and sometimes, even profits from state-owned enterprises, if they have them. It's a whole different financial ecosystem, really, built on the collective activity of the entire nation.
That makes a lot of sense. Funding the collective good, using collective resources, or borrowed collective resources. Okay, but this brings us to what I think is one of the most critical points, and maybe one of the most paradoxical things about government debt, the default mechanism. If a company defaults, bondholders usually have clear legal paths, right? They can push for bankruptcy, liquidate assets, try to get some money back. Does that kind of legal power apply when a whole country fails to pay? Can you just, seize their assets?
And that's exactly where this concept of sovereign immunity comes in and completely reshapes the risk landscape. It's a huge insight for any investor. Unlike with a corporation, sovereign bondholders generally cannot force a national government into bankruptcy. They can't just liquidate its assets. And this isn't just some minor technical point. It's a really deep legal principle. It basically protects a sovereign state from being hauled into another state's courts and forced to comply. So what it means is, if a government defaults, your legal options as an investor, they're extremely limited, sometimes non-existent when it comes to actually seizing assets or forcing a liquidation.
Okay, this is where it gets really interesting and honestly a bit unnerving if you're used to the corporate world. If you can't seize their assets, if bankruptcy isn't really on the table, what actually backed that bond? What recourse do you really have? Is it just hoping they decide to pay you back?
You've nailed the core paradox. It means that for sovereign debt, sure, the ability to pay is critical. Does the country generate enough revenue? But the willingness to pay becomes just as important, maybe even more so. Because legal options are so limited, especially against a sovereign government that operates outside foreign court jurisdiction, investors have to assess not just if a country can generate the money, but if its political will, its institutions, its commitment to playing by the global financial rules mean it will pay. So instead of liquidation, what usually happens in a sovereign default, it's debt restructuring. Now, this is a complex process, often takes a long time. It typically involves negotiating new terms with bondholders, things like extending the maturity dates, maybe agreeing to lower interest rates, or even taking a haircut, which means accepting less than the full principal amount back. And these restructurings, they often involve big multilateral agencies like the International Monetary Fund, the IMF. The IMF might step in with financial support, but it usually comes with strings attached. The defaulting country has to implement significant economic reforms.
Let's take a real-world example here. Uruguay's 2003 sovereign debt exchange. It's quite compelling. Uruguay had faced years of pretty stagnant economic growth. Then in 2002, it got hit by a massive banking crisis. Huge deposit withdrawals. First, Argentines pulling money out due to their own crisis, then Uruguayans themselves. This pushed the country right to the edge of default. The currency tanked, and the cost of propping up the banks made their debt-to-GDP ratio just skyrocket. So with some crucial help from the IM, in March 2003, Uruguay announced this proactive debt exchange. They offered bondholders new bonds, but with longer maturities. Essentially, they pushed out the repayment dates by 5 years. Now, about 90% of bondholders actually agreed to this voluntary exchange. Pretty high take-up. But rating agencies and most analysts still saw it as a default in substance.
Why, if it was voluntary?
Good question. Because even though it was voluntary, the bondholders didn't really get enough extra compensation for having to wait longer for their money. And crucially, those who didn't participate, their claims effectively became less valuable, subordinated. So this example really drives home the point that even these voluntary restructurings can feel very much like a default for investors. It shows just how limited the leverage bondholders really have against a sovereign power.
That's a very stark reminder. The rules are just different, often more political, more negotiated than a straightforward corporate default. So, okay, when we talk about government debt, it's not just the big national governments like the U.S. Treasury or the government of India, right? There are other layers involved.
Exactly. It's important to break it down. We usually categorize government debt into a few key types based on who's issuing it and what backs it up. First, there's the big one, sovereign debt. This is debt issued by a country's national government. Its creditworthiness is ultimately backed by that government's huge power, its ability and hopefully willingness to tax all the economic activity within its borders, plus its control over monetary policy. In advanced economies, this type of debt, especially in the local currency, is often seen as effectively default risk-free. Why? Because of that massive taxing power, the ability to print money if absolutely necessary, though that has consequences, of course, and strong institutions that usually ensure a high willingness to pay. So for Indian context example, think government securities or GSECs, issued by the government of India. They're widely seen as very safe precisely because they're backed by the central government's power to tax and manage the national budget. And in the U.S. context, the classic example is U.S. Treasury bonds. Globally, they're considered among the safest assets you can own, backed by the full faith and credit of the U.S. government, its strong taxing ability, and historically an unquestioned willingness to pay. Okay, then we have non-sovereign debt. This is basically debt issued by entities other than the national government. It's a bit of an umbrella term that covers local governments, think states, provinces, cities, municipalities. We often call these sub-sovereign entities. It also includes quasi-government entities like specific agencies set up for a purpose, or public banks, and even supranational organizations like the World Bank. Now, the repayment for this kind of debt, it's typically backed either by local tax revenue or sometimes by the revenue generated from a specific project the debt is funding. Let's take an Indian context example. Imagine a bond issued by a municipal corporation in a big Indian city, say Mumbai or Bengaluru. Maybe they issue it to fund a new metro line or upgrade the water system. The repayment would likely come from local property taxes, maybe specific user fees from the project, or other city revenues. In the U.S. context, the direct parallel is municipal bonds, or munis, issued by states like California or cities like New York or counties. They fund local projects for general operations. And their credit quality, it really depends heavily on that specific local economy, its tax base, how well that city or state manages its finances.
Right, so different layers, different backing. That clarifies the landscape nicely. So what does this all mean for someone actually trying to invest? How do we analyze these different types of debt? How do we distinguish the safer bets from the riskier ones beyond just knowing who issued the bond? What's the deep dive approach here?
That's the key question, isn't it?
Yeah.
Assessing sovereign creditworthiness isn't just plugging numbers into a formula. It really needs a sophisticated kind of dual approach. You have to combine both qualitative factors and quantitative factors. You absolutely need to look beyond just the numbers on a spreadsheet to get the full, nuanced picture of a nation's real ability and that crucial willingness to pay its debts.
Okay, let's unpack this then.
Yeah.
Maybe starting with the qualitative side. These are the soft factors, right? The things that aren't easily measured, maybe more subjective, but can fundamentally make or break a country's credit rating. It feels like it's about the character and resilience of the country itself.
Exactly, you put it well. These qualitative factors give you the essential context. They tell you the why behind the numbers. We typically break them down into 5 key areas. Think of them as interconnected pillars supporting a country's creditworthiness. They are government institutions and policy, fiscal flexibility, monetary effectiveness, economic flexibility, and external status. Let's start with the first one, government institutions and policy. This is really fundamental. It looks at how a government's institutions and its actual policy choices create political and economic stability. It's a pretty broad category. It covers things like the rule of law, is it strong? Are property rights enforced consistently? That's critical for investment. It also looks at whether there's a culture of debt repayment, transparency in government, consistency in financial data, how easy it is to do business there. And beyond the purely economic stuff, political stability itself is huge. Are there strong democratic institutions? Peaceful power transitions? Is the country free from major internal or external conflicts? Rating agencies try to capture these using various scores and rankings.
And for you, the listener, this isn't just abstract theory. Why does this matter for your investment? Well, a country with reliable, predictable institutions where contracts hold up, policies are stable, corruption is low, that's just a more predictable environment for returns. It means a lower risk of sudden shocks that could hit the value of your bonds. It really underpins that willingness to pay we keep talking about.
Absolutely. The credibility of those institutions and a country's track record of honoring its debts becomes so important precisely because sovereign immunity limits your legal options if things go wrong. Okay, second pillar, fiscal flexibility. This looks at how good a government is at managing its finances. Can it maintain discipline? Not just when times are good, but through the whole economic cycle. It digs into how effective its tax collection is, whether it spends money prudently on public goods, and how skillfully it manages its overall debt load relative to the economy's size and health. We look at past performance. How did they handle spending during the last recession? And consider what future policy changes might mean. A government that consistently manages its budget well, showing a clear path to keeping debt sustainable, just inspires more confidence. A good international example here. Look at the government of Romania's improved ratings outlook back in October 2021. Moody's shifted their outlook from negative to stable. A big reason was the clear expectation that Romania would stick to fiscal consolidation. As they aimed for deeper EU integration, they committed to reforms to get their budget deficit below 3% of GDP. The incentive was strong, failed to comply, and they could lose access to valuable EU structural funds. So it shows how a credible policy commitment to fiscal discipline can directly boost credit perception. And in the Indian context, you see this play out with the Reserve Bank of India's, RBI, role in monitoring state government finances. The RBI actively works to enforce fiscal responsibility rules at the state level. These rules aim for prudent debt management, better tax collection, responsible spending, all things that boost the fiscal flexibility and creditworthiness of individual Indian states. Third is monetary effectiveness. This is all about the central bank. How effectively does it manage the money supply and credit in the economy? It involves tools like setting interest rates, bank reserve requirements, open market operations, all aimed at achieving stable growth and keeping prices stable. But the absolute key here, and it's often debated, is the central bank's independence from direct government influence.
Okay, that raises a really interesting, almost provocative question. Why is that independence so critical? Wouldn't a government, especially one maybe struggling with debt or facing an election, want to control the money supply? Seems like it could be a useful lever.
It's a very perceptive point. And yes, the temptation is definitely there for governments. But central bank independence is vital. Think of it as a shield. It protects against the government simply deciding to monetize its debt, basically, printing money to pay its bills. If the central bank isn't independent, if it just does what the government tells it, what happens? Almost inevitably, you get higher domestic inflation, more money chasing the same goods. It also hammers the external value of the currency, erodes purchasing power, can cause capital to flee the country, and might even trigger a full-blown currency crisis. All of that severely damages creditworthiness. Look at the U.S. context. The Federal Reserve's independence is a cornerstone of its global credibility. That separation allows it to pursue its goals: maximum employment, stable prices, without direct political meddling. That fosters huge confidence in the dollar and the U.S. economy. Fourth pillar, economic flexibility. This looks at the fundamental economic engine. How big is the economy? What's the income level per person? Critically, how diversified is it? And what's its potential for sustainable growth?
Generally, countries with advanced, highly diversified economies, strong and consistent growth prospects. They're seen as more creditworthy. They have a broader, more resilient tax base that can handle shocks better. On the flip side, many emerging or frontier markets often rely too heavily on just one industry, maybe a couple of key commodities or only a few trading partners. That makes their tax revenues much more vulnerable to economic downturns, wild swings in commodity prices, or disruptions in trade. They're inherently more fragile.
Yeah, and for you, the learner, this really boils down to resilience, doesn't it? Think about a massively diversified economy like the U.S. tech, finance, agriculture, manufacturing, everything. Or a booming hub in India, maybe like Hyderabad, with its mix of IT, pharma, and services. Compare that to a country that basically relies solely on, say, oil exports or tourism. That diversification in the U.S. or India means a much broader, more stable tax base for the government, more resilience against shocks in one particular sector, and that translates directly into more reliable government revenue.
Precisely. That diversification provides a buffer. And finally, the fifth pillar, external status. This is about how a country interacts with the rest of the world financially. How do its international trade policies, its rules on capital flows, its foreign exchange policies influence its ability to service its debt? It's about its standing in the global financial system. A really key distinction here is whether a country's currency is considered a reserve currency. What does that mean? It's a currency that's fully convertible, widely held by foreign central banks and big investors as part of their foreign exchange reserves. Think US dollar, euro, yen.
Okay, so if your currency is a reserve currency, like the US dollar, that sounds like it gives you a lot more flexibility to borrow internationally, right? That must be a massive advantage.
Oh, it's a huge advantage. Colossal. If foreign investors are willing and able to hold your assets, your cash, your government bonds, whatever denominated in your own currency, it dramatically expands your government's ability to borrow from foreigners without having to issue debt in, say, dollars or euros. This flexibility significantly lowers the risk of sovereign default because the government isn't exposed to exchange rate risk on its own debt repayments. It can also allow a government to run structural budget deficits and maintain higher debt levels for longer without necessarily triggering a crisis. Contrast that with many emerging market countries. They might face restrictions on converting their currency or controls on capital moving in and out. This really limits their ability to borrow internationally in their own currency. Often they have to issue bonds in foreign currencies, which exposes them to that exchange rate risk we mentioned. And they frequently need funding from supranational bodies like the IMF for development or reforms. A really poignant example of this, showing deteriorating external status and its consequences, is Moldova's reliance on an IMF credit facility, especially highlighted around May 2022. The Russia-Ukraine conflict hit Moldova incredibly hard. It's right next door, took in a huge number of refugees relative to its size. The economic impact was severe, inflation spiked, growth stalled, their current account deficit ballooned because exports fell and energy prices shot up. It was a dire situation. It forced Moldovan authorities to get permission from the IMF to draw down funds just to meet their immediate external bills, especially for vital energy imports. It really illustrates the vulnerability of non-reserve currency countries, especially in tough geopolitical spots. And, if we try to connect all these qualitative factors together, it's clear they're not isolated silos. They're deeply interconnected. For instance, a weak legal system, That might directly hamper effective tax collection, which hits your fiscal flexibility. It could also scare off foreign investment, which hurts your external status. It's all linked. Maybe the best way to see this interplay is to compare Moldova and Romania. They share language, history, both moved away from central planning, but their sovereign credit profiles. Worlds apart. Romania is now investment-grade BOFA 3 from Moody's, BBB from S&P and Fitch. Moldova, still non-investment grade, B3. Big difference. Why? It comes down to how these qualitative factors played out. Take government institutions and policy. Romania joined the EU in 2007. That was a huge anchor. It meant access to markets, economic integration, and importantly, pressure to strengthen institutions, improve rule of law, adopt reforms. Moldova's transition, much slower, less stable, plagued by corruption, weaker governance, unresolved conflict in Transnistria. Their institutions are just seen as less reliable. How about fiscal and monetary factors? Romania aiming for the euro means its policies are disciplined by strict EU rules on deficits and debt. Plus, it has a more developed financial system. Moldova, less developed system. Government debt often concentrated in short-term stuff. Limited borrowing capacity. All vulnerabilities exposed by the war and high inflation. Then economy. Romania has a much larger, more diversified, competitive industrial economy. Attracted lots of foreign investment, especially from the EU. Has natural resources. Moldova. Slower privatization, struggled to attract foreign capital, heavily reliant on Russia for energy, disproportionately dependent on agriculture, very vulnerable to weather and commodity prices. And finally, external status. Both eventually accessed foreign bond markets, sure, but Moldova had to reschedule its foreign debt back in 2002 and still relies heavily on the IMF. Romania, meanwhile, has kept strong access to international capital markets, even issuing foreign currency bonds after the 2022 invasion. Moldova's reliance on fewer trading partners and less diverse exports also meant it got hit harder by trade disruptions from the war. So this comparison really shows how all these qualitative pieces fit together to create a very different credit picture for each country.
Wow, yeah, that Moldova-Romania comparison really brings the why behind the ratings to life. It shows how those qualitative factors really stack up. Okay, so now let's switch gears and turn to the numbers. Qualitative gives us the story, the context. Quantitative should give us the how much, the concrete metrics. But you mentioned a challenge here, didn't you? Dealing with government data. It's not always as straightforward or standardized as reading a company's annual report.
You're absolutely right. That's a critical point to remember. Unlike corporations, which generally follow pretty well-defined accounting standards like GAAP or IFRS and issue standardized statements, sovereign credit analysts face a much murkier landscape with government economic data. The quality varies hugely from country to country. So does the timeliness. Comparability can be a nightmare. Data gets revised frequently. And crucially, sometimes politics can influence the numbers, especially around elections. So just relying on detailed public sector balance sheets, it can be misleading, might not give you the best forecast of creditworthiness. Because of that, analysts tend to favor a more top-down macroeconomic approach. And we usually focus on three main quantitative pillars. The first quantitative pillar is fiscal strength. This is all about measuring the government's current and expected future debt burden. How reliant is it on debt versus other resources? Basically, it assesses solvency of the long-term ability to pay its bills. We'll look at some key ratios. You might recognize the concepts from corporate finance, but applied to a government. Debt to GDP. That's total general government debt, divided by the country's gross domestic product. Gives you a broad sense of debt relative to the economy's size. Debt to revenue. This takes that government debt and divides it by total government revenue. Tells you debt relative to income, a more direct look at repayment capacity. Interest to revenue. This looks at government interest payments as a percentage of its total revenue. Shows how much income is just going to service existing debt. Interest to GDP. Similar idea. Interest payments relative to the overall economic output. Generally speaking, higher ratios for the debt burden, debt to GDP, debt to revenue, and for debt affordability. Interest to revenue. Interest to GDP usually mean lower credit quality. Makes sense, right? And you also have to watch the annual fiscal balance surplus or deficit as a percentage of GDP. A consistent surplus suggests the debt burden is improving. Persistent deficits signal it's getting worse. Tells you a lot about fiscal discipline.
Okay, so how does this play out in the real world? Can you give us an example where these ratios really told a story, maybe one that didn't end well?
Oh, absolutely. One of the most vivid and frankly painful examples is the Eurozone crisis that really blew up around 2010. After the 2008-09 global financial crisis, governments across Europe, especially in places like Greece, Portugal, Ireland, Spain, Italy, the so-called PIEAS nations, were in deep trouble. They'd spent huge sums bailing out banks, running stimulus packages. Meanwhile, their economies stalled and tax revenues just collapsed. And because they were all in the Eurozone, they couldn't use their own monetary policy, couldn't devalue their currency to boost exports or make debt cheaper in foreign terms. It was a perfect storm. This exposed already high debt-to-GDP ratios, add rapidly rising fiscal deficits, and boom! Sovereign credit spreads, the extra yield investors demanded compared to safer German bonds, just exploded upwards. It was a crystal-clear signal from the market. Creditworthiness plummeting, default risk soaring. Many of those countries ended up needing massive bailouts from the EU and IMF and had to impose really harsh austerity measures to regain confidence. A stark lesson in what happens when those fiscal ratios get out of control. Closer to home, in the Indian context, think about the constant discussion around India's fiscal deficit target as a percentage of GDP. It's always in the news, a key indicator for rating agencies, for investors. The government sets annual targets. If the deficit stays persistently high, or higher than targeted, it raises alarms about the rising debt burden, impacting the view of India's fiscal health and potentially its credit rating. Hitting those targets signals prudence. Okay, the second quantitative pillar, economic growth and stability. The core idea here is pretty straightforward. Bigger, wealthier, more stable economies are just better placed to grow sustainably and handle shocks. This means a stronger tax base, greater capacity to generate revenue. So the sheer size of the economy, usually measured by GDP and its per capita income, are really important gauges of economic prospects and health. We also look at growth itself, historical and projected real economic growth, and importantly, the volatility of that growth. Is it stable expansion or boom and bust? Key measures include size of economy, often GDP using purchasing power parity, PPP, to adjust for local price differences, per capita GDP. That's total GDP divided by population. Gives a sense of average wealth, productivity per person, standard of living, potential tax base per head, average real GDP growth. Annual growth rate after accounting for inflation shows the real expansion. Real GDP growth volatility, usually the standard deviation of that real GDP growth. High volatility suggests a less predictable, riskier economic environment. For instance, let's look again at the sovereign credit risk of Southeast Asian economies. Compare, say, Malaysia, Indonesia, and Vietnam. Malaysia has one of the highest per capita GDPs in the region, even if it's not the biggest economy overall. It's high growth, diverse, export-driven economy, strong in electronics. Healthcare helps give the highest credit rating among that group, like 83 from Moody's. Indonesia, biggest overall GDP, but lower per capita income. Huge population, but less wealthy on average. Vietnam, smaller economy, second lowest per capita GDP, but consistently one of the highest growth rates for years. They even grew in 2020 during the pandemic. That stability and high growth, even from a lower base, has led to positive ratings outlooks, even upgrades. And in the Indian context, tracking India's GDP growth rates and per capita income trends is absolutely vital for assessing long-term creditworthiness. Also crucial is the ongoing economic diversification, that big shift away from relying so heavily on agriculture towards stronger services and manufacturing sectors. Why? A more diverse economy means a more resilient, broader tax base. Government revenues become less vulnerable if one sector hits a rough patch. Right, our third quantitative pillar is external stability. This focuses on a country's position in the global financial system, its ability to manage international financial flows. Specifically, can it attract and keep foreign investors holding its domestic currency assets? And critically, can it generate enough stable foreign currency inflows to meet its external debt obligations? That includes paying interest and principal on foreign currency debt, but also other payments to foreigners like profits being sent home. Key ratios here: FX reserves to GDP, foreign exchange reserves divided by GDP. Shows the size of the foreign currency buffer relative to the economy. Reserve ratio, foreign exchange reserves divided by total external debt. Crucial one. How much external debt could theoretically be covered by reserves? External debt burden. Long-term external debt divided by GDP. Measures foreign currency debt relative to the economy's size. External debt due. External debt coming due in the next 12 months divided by GDP. Highlights short-term foreign currency pressure.
Okay, let me jump in there. Why do these foreign exchange reserves matter so much to me as an investor? What do they actually do for a country's financial health beyond just being a big number on a report?
Great question. Think of them as the nation's emergency savings account, but in foreign currency. They are an absolutely crucial buffer. Having strong FX reserves gives a country the ability to handle sudden external shocks. Things like foreign investors suddenly pulling their money out, its own currency taking a sharp dive, or maybe import costs suddenly spiking. Those reserves ensure the government can still meet its foreign currency debt payments, like paying back a dollar bond, even if its usual foreign currency income from exports or tourism dries up temporarily. Without enough reserves, a country faces a much higher risk of a currency crisis, problems paying its international bills, or even outright default on foreign debt. That obviously hammers its creditworthiness. It's a vital safety net. Let's revisit those FX reserves of Southeast Asian economies: Thailand, Malaysia, Indonesia, Vietnam, Philippines. Now, if you just glance at FX reserves to GDP, Thailand might look like it has the highest external creditworthiness. But rating agencies dig deeper. They'll consider Malaysia's greater economic competitiveness, its more diverse exports, and importantly, its lower reliance on foreign currency debt. All that might lead to a higher overall external credit rating for Malaysia, even if its FX reserves GDP ratio is lower than Thailand's. Or compare Thailand and the Philippines. They might have similar foreign currency ratings, but a key factor strengthening the Philippines' external stability is remittances money sent home by workers abroad. In 2020, remittances were nearly 10% of the Philippines' GDP. That's a huge, stable inflow of foreign currency, acting as a powerful buffer against external shocks. And in the Indian context, the RBI's careful management of India's foreign exchange reserves is constantly watched. A healthy, growing reserve level provides crucial stability against external shocks, supports the rupee, and boosts overall investor confidence. But sadly, not every country has this stability or these big reserves. Look at the really stark case of Zambia's default in 2020. Zambia is Africa's second biggest copper producer, heavily dependent on copper exports for foreign cash. When copper prices started falling around 2014 and then got hammered by the pandemic slowdown, Zambia's economy took a massive hit.
Inflation soared, their currency plunged against the dollar, and their external debt just ballooned from about 20% of GDP in 2014 to nearly 50% by 2019. At the same time, their FX reserves basically vanished, went from covering over half their external debt to just 5%, perilously low. So you have this toxic mix: commodity price dependence, no diversification, soaring debt, disappearing reserves. Default became pretty much inevitable. Zambia became the first African nation to default during the pandemic, leading to a very painful debt restructuring. It's a really clear, powerful example of why external stability is absolutely critical, especially for commodity-reliant countries.
Right. That brings us to a really important point beyond just the national governments. We've focused a lot on sovereigns, the big players. But you mentioned earlier, a lot of public debt actually comes from other places: agencies, local authorities, even international bodies. So how does credit analysis change when we look at these non-sovereign issuers? Are they just like mini versions of national governments, or do they have their own unique risks and things we need to consider?
That's an excellent and really nuanced question. You're right. While these non-sovereign issuers often benefit from the overall health of the national economy, the political climate, they absolutely have unique features. And these can cause their creditworthiness to differ quite a bit, sometimes significantly, even from the national government itself. It's not just about size. It's about their specific mandate, their revenue sources, the support structures they have. We usually break them down into a few key types: agencies, government sector banks, supranationals, and regional governments. Okay, first up, agencies. These are often called quasi-government entities. Their main job is to carry out a specific mission sponsored by the government, often providing essential public services. They're typically set up by law, and that law usually lets them issue debt to fund their activities. Now, because they're so closely tied to the government, often doing things the government sees as critical, investors generally assume there's a high chance the sovereign government would step in and support them if they got into financial trouble. This support can be implicit or explicit. And because of that strong link, rating agencies often give them a credit rating that's very similar, sometimes even identical, to the sovereign government itself. An international example: let's look at the airport authority Hong Kong SAR AAHK, perpetual bonds. AAHK is owned entirely by the Hong Kong government, runs the international airport, obviously critical infrastructure. In late 2020, they issued perpetual bonds for construction. Now, the bonds themselves got rated AA, which was one notch below the Hong Kong sovereign rating of AA plus NEFLU. Why? Because of a buyback option that could disadvantage bondholders. But AAHK's issuer rating, that was equalized with the sovereign's AA plus NEFL, based on the implicit support expected from the Hong Kong government if AAHK ever faced distress. It recognized that strategic importance. For an Indian context parallel, think about bonds issued by a major public sector enterprise like the State Bank of India, SBI. SBI is its own corporate entity, right? But its implicit backing by the government of India means it generally gets a very strong credit rating, extremely close to the sovereigns. The market assumes the government wouldn't let SBI fail. Okay, next type: government sector banks and development financing institutions. These are specialized financial intermediaries, again, sponsored by sovereign governments. They're set up to promote specific goals, maybe economic development, social programs, funding sectors that private banks might avoid. Like agencies, they're usually created or heavily backed by the sovereigns, so they tend to enjoy very similar credit ratings. Their mission is often seen as part of government policy, A really prime international example is Kreditanstalt für Wiederaufbau, KfW, in Germany. It's Germany's biggest national development bank, 80% owned by the federal government. It benefits from an explicit state guarantee and institutional liability from the German government. So no surprise, KfW bonds get a AAA rating, rock-solid backing. It's also a huge issuer of green bonds, funding sustainable projects. Though we have supranational issuers, these are powerful organizations, established and owned by multiple sovereign governments acting together as members. They pursue common goals that go beyond national borders. Think of the giants: the World Bank, the Asian Development Bank, ADB. They issue debt to help developing countries with big projects, like infrastructure or poverty reduction. And because they're owned by many governments, their credit quality is often exceptional, typically AAA. An international example showing their impact: Indonesia Infrastructure Finance, IHINAFA. It wasn't just set up by the Indonesian government. The World Bank, ADB, Germany's KfW, and others were involved. Its job is accelerating vital infrastructure development in Indonesia. That strategic importance, plus its strong multilateral ownership, gets it a BBB rating the same as the Indonesian sovereign. While not an issuer itself, in the Indian context, India often works closely with these supranationals like the Asian Development Bank, ADB, or the World Bank. They provide financing for large-scale development and infrastructure projects across India, leveraging their strong credit backing. Okay, finally we get to regional government issuers. This category includes provincial, state, and local governments. Think municipal bonds in the U.S. or local authority bonds elsewhere. Now, the creditworthiness of these entities, it can vary a lot even within the same country. And often, it's quite different from the sovereign rating itself. Why? Well, they usually have limited powers within their specific jurisdiction. They have no control over national economic or monetary policy. And they can be much more exposed to purely local changes. Maybe a big local industry declines or demographic shift. Their fortunes are often tied very closely to their specific region. So in the Indian context, think about an Indian state government, maybe Maharashtra or Tamil Nadu, issuing bonds. They might do this to fund their state budget or specific projects. These bonds are typically backed by the state's power to levy its own taxes, things like VAT, stamp duties, property taxes. But they're still fundamentally operating under the economic and monetary policies set by the central government in Delhi. And the financial health of one state can be dramatically different from another, depending on its economy and how well it's governed. Within these regional government bonds, there are two main subtypes you really need to know: general obligation bonds and revenue bonds. Let's take general obligation bonds first. These are essentially unsecured bonds. They're backed by the general revenues of the issuing government, the city, the state, whatever. Their ultimate security comes from the issuer's powers to tax everyone and everything within its borders. Analyzing go-go bonds. It has some similarities to sovereign analysis. You look at their ability to tax, the strength of the local economy, how diverse the tax base is, how well they manage their budget. But you must also factor in their limitations. They only have power within their borders. They can't print money or set national interest rates. And they're much more vulnerable to localized economic downturns that a national government might absorb more easily. A really stark, famous international example of the risks here is the city of Detroit bankruptcy filing in 2013. Biggest U.S. municipal bankruptcy ever. What caused it? Decades of decline in the auto industry, people moving out of the city, the tax-based property taxes, income taxes just shrinking dramatically. The city simply couldn't meet its debts, estimated around $18 billion. Filed for Chapter 9 bankruptcy. Took 17 months of really complex negotiations to emerge. But creditors took significant hits. Pensioners lost about 15% of their benefits. And holders of general obligation unlimited tax bonds, usually seen as super safe, they only recovered about 74 cents on the dollar. It was a powerful lesson in how long-term local economic and demographic shifts can absolutely crush a regional government's ability and maybe even willingness to pay even supposedly most secure debt. Okay, the second type, often more specialized, is revenue bonds. These are issued specifically to finance a particular project, like toll roads, airports, hospitals, water systems. They generally carry more risk than go-go bonds. Why? Because their repayment depends explicitly on a single source of revenue, the money generated by that specific project. If the project doesn't perform well, the bondholders are directly in the line of fire. So analyzing revenue bonds is kind of a hybrid approach. You need rigorous project analysis plus traditional financial analysis. You assess, is there a real need for this project? How much will people use it? Will enough cars pay the tolls? Enough planes use the airport? What's the economic base supporting it? What are its operating results, its cash flow projections, its liquidity, its capital structure? It feels quite similar to analyzing a corporate bond, actually, because you're focused on whether that specific project can generate enough cash to pay the debt. A key metric here is the debt service coverage ratio, DSCR. This ratio measures the revenue available to cover the principal and interest payments after you've paid all the operating expenses. A higher DSCR means stronger credit quality, more buffer to make those debt payments. And these bonds often have covenants, rules requiring the issuer to maintain a minimum DSCR. If it falls below that level, they have to take action. It's protection for investors. An interesting international example is the Lima Metro Line 2 Finance Limited debt offering in Peru. Huge infrastructure project. It was financed using this unique government-backed mechanism called RPI-CAOs, basically milestone payments. The company building the metro gets paid systematically as work progresses, once the Ministry of Transport approves the reports. Crucially, these payment rights are guaranteed by the ministry, so bond investors have recourse back to the Peruvian government if the ministry doesn't pay. The bonds were issued specifically to fund this 35-kilometer subway line. The key takeaway.
Repayment to bondholders is tied directly to these RPI-CAO payments, which are backed by the government's commitment to this specific project, not the general taxing power of Lima or Peru for everything else. And in the Indian context, the direct parallel would be something like a toll road project bond. Repayment comes explicitly from the tolls collected on that specific highway, not from the state government's general tax revenues. It's a classic revenue bond structure. Project success is everything for getting paid back.
Wow. Okay, that was a truly comprehensive deep dive. Really covered the ground from the big picture of sovereign immunity right down to the nitty-gritty of municipal revenue bonds. It's fascinating how different governments operate, how we assess that complex mix of ability and willingness to pay, and all the unique factors affecting their debt across the globe.
Yeah, and if you connect it all back to the bigger picture, whether you're analyzing a national government's broad fiscal policy and its institutions, or the very specific revenue stream of a local project, understanding the underlying cash flows, understanding the complete institutional framework that's absolutely paramount. It's never just one number. It's that intricate interplay, right? The qualitative stuff like central bank independence, economic diversity, alongside the hard quantitative ratios for fiscal strength, external stability, that paints the complete nuanced picture investors need. That holistic view is really your best defense against nasty surprises.
So what does this all mean for you, the learner, listening right now? It means you now have a really robust, sophisticated framework for assessing government debt. It empowers you to move beyond just the headlines, to really understand the stability and the risks involved. From huge events like the Eurozone crisis down to the specifics of financing a metro line in Peru, these principles apply globally. You've got a toolkit now to dissect national balance sheets and local project viability with much more confidence. It should help you make far more informed, strategic decisions in public sector fixed income.
And maybe it leaves us with a final kind of philosophical question to think about. In this increasingly interconnected, frankly volatile world, where geopolitical risks can shift so fast, the global financial landscape is always changing. How might the very definition of default risk-free sovereign debt evolve over the next decade? Will the traditional safe anchors hold? Or will new factors become more important? It's definitely something worth mulling over as you continue your studies.
That definitely gives us something to think about. And that wraps up Module 15 of our CFA Level I 2025 Fixed Income Volume 6 course. Next time, we'll dive straight into Module 16. We'll be shifting our focus entirely to credit analysis for corporate issuers. We'll explore how these principles differ and maybe where they surprisingly align when we're looking at businesses instead of governments. Thank you so much for joining us on the deep dive. We'll catch you next time. Okay, let's unpack this. Welcome to the deep dive, where we're not just scratching the surface, but really digging deep today. We're embarking on a pretty crucial journey within the CFA Level I 2025 Fixed Income Volume 6 course. Specifically, we're zeroing in on Module 16, Credit Analysis for Corporate Issuers. Our mission today, well, it's straightforward, but also kind of profound. We want to equip you, our listener, with the analytical tools to really dissect a company's financial health. To understand its capacity to meet those critical debt obligations and ultimately make an informed judgment on its creditworthiness. We're going to pull back the curtain a bit on how seasoned financial pros, the ones making big investment decisions, evaluate that whole risk and reward balance in corporate debt. And what I find really interesting about credit analysis is that it's never just a math problem, is that you can crunch all the numbers you want, but there's this definite art to it, this qualitative side that feels, more like detective work sometimes. So we're going to explore that balance. How much is science? How much is intuition? And just a quick heads up, once we've really got a handle on corporate credit analysis today, we'll then pivot to Module 17, Fixed Income Securitization. That's where we'll look at how individual loans get bundled up and turned into securities you can trade. But first things first, let's build this foundation.
Yeah, absolutely. And what's really fascinating here, I think, is that corporate credit analysis, At its core, it's about understanding a company's sustainable ability. It's about their power to generate not just sufficient profits, but more critically, reliable cash flow. That's the key, right? Cash flow to meet its interest and principal payments. It's not enough for a company just to look profitable on paper. The real question is that money consistently and predictably available to pay back the lenders, through thick and thin? And this leads us straight to two really critical, often unobservable components of credit risk that analysts are always trying to estimate. First, you've got the probability of default, or POD. That's pretty straightforward. It's the likelihood that an issuer will actually fail to make timely debt payments, a big worry for any lender. And second, there's loss given default, LGD. This is the investor's actual financial loss if a default does happen. And it's not just the face value of the bond, it's that amount minus whatever you manage to recover from the company's assets, maybe through a bankruptcy process.
It's easy to miss the nuance that even companies showing strong profits can be on shaky ground if those profits don't translate into predictable, accessible cash for debt service. That's a common mistake.
Right, so it's about cash actually hitting the bank account, not just numbers on a spreadsheet.
Exactly. And to navigate these unobservable things, analysts don't just use one tool. It's really a blend, a sophisticated mix of both qualitative and quantitative factors. We dive deep into financial statement analysis, meticulously forecasting cash flows. Those are our core quantitative tools. But we also have to consider the broader story, the less tangible stuff. The company's competitive landscape, its management's integrity, are they trustworthy? What's their strategic direction? These qualitative elements provide crucial context to the numbers. So throughout this deep dive, we'll start by looking at those broad qualitative factors, the big picture story. Then we'll move into the specific quantitative ratios, the hard evidence, and finally we'll look at the critical elements of debt seniority and how credit ratings tie it all together, which connects directly back to understanding that crucial LGD. It's a structured way to tackle a complex puzzle.
Okay, so if we, as aspiring financial pros, are trying to really understand a company beyond its latest earnings report, what does this all mean for us? It sounds like before we even touch a calculator, we need to get our heads around the qualitative side, those big picture factors influencing whether a company can actually pay its debts. These are like the underlying currents shaping the environment where the numbers happen, right? Giving them meaning. We're talking about things like the basic business model, the specific industry, the competitive environment, any inherent business risks, those broader external factors. And crucially, corporate governance, you mentioned management integrity, the company's sort of moral compass. These narratives give context, depth, and sometimes those critical early warnings.
That's spot on. When we dig into these qualitative factors, what we're really trying to gauge is the fundamental sustainability and predictability of a company's cash flows. Think about it from a lender's perspective. You want assurance that the money will be there reliably, month after month, year after year. So for instance, we scrutinize things like demand, revenue, and margin stability and predictability.
Sure.
Are their earnings super cyclical, going up and down with the economy, or are they steady? Established firms with consistent cash flows, maybe from essential services or long-term contracts, they're generally preferred by debt investors. Lower, more predictable risk. Then there's asset quality. Not just how many assets they have, but what kind of assets. And what are they worth? Are they tangible things you can touch and sell, like property, plant, equipment, PPE? Or are they more abstract, like intellectual property or brand value? Harder to value, harder to sell in a pinch? Lenders definitely prefer those hard, identifiable assets, especially if the company's credit quality isn't top-notch.
Okay, so physical stuff is generally better than ideas when it comes to collateral.
Generally, yes. We also look intensely at the structure, concentration, and competitive forces within their industry. Is it a really fragmented industry with loads of players fighting tooth and nail on price? Or is it more concentrated with a few big players and high barriers to entry? What are the long-term growth prospects? How does the company stack up against its rivals? This whole analysis feeds directly into our understanding of business risk. That's basically any significant deviation from what you'd expect in terms of demand, revenue, or margins. A company in a super volatile, fast-changing tech sector probably faces higher business risk than, say, a stable utility company. And higher business risk generally means a higher likelihood of default, so lenders will demand a higher return.
That makes sense. Risk and reward.
Exactly. And then there are industry-specific factors, like how cyclical is the industry? Think about autos or construction. They boom and bust with the economy. Compare that to, say, pharmaceuticals, which tend to be much less sensitive. We also look at the intensity of intra-industry rivalry. How fierce is the competition? And where is the company in its own life cycle? Is it a mature cash cow kind of business or a high-growth startup that's just burning through cash trying to scale up? And finally, don't forget external factors. These can be huge, often unpredictable game changers. Macro trends like GDP growth, big technological shifts. Think how digital cameras basically killed the film industry. Demographic changes, new government regulations, geopolitical events, and increasingly ESG, environmental, social, and governance considerations. All these can fundamentally change a company's stability and risk profile. A big regulatory push towards green energy could seriously hurt a traditional fossil fuel company's creditworthiness, while boosting a renewable energy firm. These qualitative factors are often the first signs of trouble or opportunity.
That's a really thorough look at the qualitative side. It definitely feels like trying to predict the weather sometimes. Let's try to make this more concrete, though. Can we walk through an example? Maybe something that shows how these different factors interact. Let's imagine a company, say, Brightwheel Automotive or BRWA. It's a hypothetical car maker, mostly focused on traditional internal combustion engines, ICE technology. Now, maybe they launched their first electric vehicle, their first EV, a couple of years back, but it's still only, say, 5% of their total revenue. Just a tiny fraction. But management sees the writing on the wall, right? The global shift to EVs. So they announced these super ambitious plans, convert over half their models to all electric in the next decade, and maybe adopt hybrid tech for the rest in that same time frame. For a big company, that's not just a small change, it's a massive strategic bet, a huge undertaking.
Oh, absolutely. This BRWA scenario is a perfect textbook example of how these qualitative factors, especially business model changes and industry competition, play out very differently depending on the debt maturity. It really highlights how an investor's view changes based on their time horizon. It's not one size fits all.
Okay, so how would that look for different types of BRWA debt?
Well, let's start with BRWA's commercial paper. This is really short-term debt, maybe maturing in, say, 150 days. For investors holding this paper, their exposure to that long-term, highly uncertain EV strategy is pretty minimal, right?
Yeah.
Their main concern is the company's immediate liquidity. Can they pay their bills now? And that liquidity is still largely supported by the existing, established ICE revenue stream. The big EV shift, while strategically vital for the long run, has almost no bearing on whether BRWA can repay that commercial paper in the next 5 months. Those investors are looking at the current snapshot, operational cash flow, available credit lines, not a 10-year transformation.
Okay, short-term focus for short-term debt. Makes sense. What about longer debt, like 5 years out?
Right, so now consider BRWA's 5-year notes. Investors here have a growing exposure, definitely, but maybe not an overwhelming one yet, to the competitive pressures and business risks of the EV strategy. When these bonds mature in 5 years, the company will likely still be getting a good chunk of revenue from its traditional ICE cars. But that transition risk, it's definitely on their radar now. It's a material consideration. Will BRWA manage to scale up EV production effectively? Can they compete against the established players like Tesla, or maybe even against, say, Indian companies like Tata Motors, which has made big moves in the Indian EV market? That 5-year horizon means the success or failure of the EV strategy starts to really matter for the company's financial health by the time the bond matures. Investors would likely demand a bit more yield for that medium-term uncertainty.
Okay, so the risk grows with the timeline. What about really long-term debt, 15 years?
Ah, now the 15-year notes. That's where the greatest credit risk really sits. Investors in these long-term bonds are significantly exposed, massively exposed, really. They are exposed to the absolute success or potentially the catastrophic failure of BRWA's EV strategy. All the associated competitive pressures, the heightened business risk, it all lands squarely on them. The later interest payments, and especially the principal repayment way down the line, will depend almost entirely on whether this capital-intensive EV transition works out. If BRWA misjudges consumer tastes, hits unexpected tech roadblocks, or just gets outcompeted, the long-term revenue base supporting these bonds could just evaporate. So this perfectly illustrates how the impact of qualitative factors like business model shifts and industry competition can vary so much across different debt tenors. Longer maturities soak up much more of that long-term strategic and execution risk. That's why, as a credit analyst, you absolutely have to consider the specific tenor of the debt you're analyzing. How will these different qualitative factors impact that particular bond's repayment prospects?
So we've established that cash flow is plan A, the primary source of repayment. That's the goal. The finance is unpredictable, right? Things go wrong. What happens when the cash flow isn't enough? What's plan B? This is where collateral comes in, isn't it? That sort of secondary source of repayment when things go sideways. The safety net.
Precisely. The unsung hero, as you put it.
Yeah.
And this brings us to that crucial difference between secured debt and unsecured debt. Secured debt, well, the name says it all. It designates specific assets as collateral. legally pledged assets. This means if the company defaults, the lender has a direct, legally enforceable claim on those specific assets. They can seize them, sell them off. This significantly reduces the loss given default, LGD, for those lenders. It's a powerful protection. Unsecured debt, on the other hand, is just a general claim on the issuer's assets. No specific assets are pledged, so unsecured debt holders are further down the queue in a default. They might recover less, maybe even nothing, if there aren't enough assets left after the secured creditors take their share.
So secured is definitely safer from the lender's point of view.
Generally, yes. And lenders also care about the type of collateral. They differentiate between tangible or hard collateral and intangible or soft collateral. They strongly prefer tangible assets, physical things you can see, touch, value relatively easily, and sell, like property, plant, equipment, inventory, maybe even cash. Intangible assets, think intellectual property, patents, brand names, goodwill. They're much harder to value accurately and much harder to sell off, especially when the company's in distress. Imagine trying to sell a bankrupt company's brand versus selling its factory. It's just easier with tangible stuff. This preference for hard collateral is especially strong for companies with lower credit quality, where default is more likely. The collateral becomes the main source of comfort for the lender. It's the bedrock of their potential recovery.
Let's look at a real-world case where collateral was absolutely critical. I remember Royal Caribbean Cruise Lines, RCL, during the start of the COVID pandemic. That must have been terrifying for them. They had to stop all cruises globally in March 2020. Their entire revenue stream just vanished overnight. An existential crisis, truly.
It was an immediate severe liquidity crisis. Absolutely. They had to get creative fast to raise cash in a market that was practically frozen. So in May 2020, they moved quickly. They issued $3.3 billion in senior secured notes, due in 2023 and 2025. And the crucial part, the collateral. These notes were secured by 28 of their cruise ships, these massive valuable assets, plus some important intellectual property. Now think about it. The probability of default, POD for RCL, had obviously shot way up because of the pandemic's impact on travel. But investors were still willing to provide this huge chunk of financing. Why? Because the reduced loss given default, LGZ, offered by those secured notes. Thanks to the pledge of those tangible assets, the ships provided a really strong safety net. Those ships, even sitting idle, still had significant underlying value. It just shows the immense power of collateral. It can help companies access capital even in incredibly stressed, unprecedented market conditions. Trying to issue unsecured debt then, probably impossible or incredibly expensive. We saw similar dynamics elsewhere too.
In India, during the pandemic, airlines like SpiceJet or Indigo likely faced similar pressures and would have explored collateralizing aircraft or other assets to secure emergency funds. The principle holds globally.
Okay, so beyond the business model, the industry, the assets, there's this other layer. You mentioned it earlier, the character of management and corporate governance. How does management treat its debt holders? Are they looking out for everyone or just shareholders? This human element seems vital, but maybe harder to pin down.
You've hit on something that's profoundly difficult, yet incredibly important. Evaluating management's true character and how they'll treat debt holders is challenging, especially for big public companies. Unlike shareholders who have voting rights, debt holders mainly rely on the contracts, the bond indentures, specifically the covenants, and management's track record. Covenants are like the guardrails.
Guardrails, how so?
Well, for highly rated companies issuing unsecured debt, the covenants might be quite light. Often just affirmative covenants basically promises to do things like obey laws, stay in their current business, insure assets, pay taxes, standard stuff.
Yeah.
But for high-yield issuers, companies with lower credit ratings, higher-risk investors demand more. They want additional restrictive covenants. These restrictions limit the company's actions to protect bondholders if things go sour, like limits on paying dividends, taking on more debt, or requirements to maintain certain financial ratios. It stops them from doing things that increase risk for debt holders.
So analysts have to watch management's actions very closely then, looking for red flags.
Constantly. Red flags pop up pretty quickly when management starts pursuing strategies that could lead to credit downgrades. Things like making huge, debt-fueled acquisitions that really stretch the balance sheet thin, or issuing massive debt-financed special dividends to shareholders, basically pulling cash out that could have repaid debt, or big debt-financed stock buybacks that shrink the equity cushion protecting debt holders. Aggressive accounting is another huge warning sign, trying to mask the true performance or risk. That includes stuff like significant off-balance sheet financing to hide debt, capitalizing costs instead of expensing them to inflate profits, or recognizing revenue too early. And maybe the biggest red flag, frequent unexplained changes in auditors or the chief financial officer, the CFO. That often signals something's being hidden. These actions suggest either potential wrongdoing or, at the very least, a clear disregard for debt holder interests. It's like reading between the lines of the financial statements, looking for those behavioral clues.
Wow. To really see the devastating impact of bad governance and outright fraud, we just need to look at Wirecard AG, the German payments company. That was a huge story. Meteoric rise then. Collapse.
Wirecard is such a stark, painful reminder of why qualitative analysis, especially focusing on management and governance, is absolutely vital. It can be way more revealing than just looking at the reported numbers. In the years before its insolvency in June 2020, a really diligent qualitative analysis would have spotted several critical red flags that, frankly, were often ignored or downplayed. I mean, despite its rapid growth and expansion, Wirecard had this really opaque, overly complex business model. There were constant market rumors about suspicious transactions, even money laundering allegations. That lack of transparency should have been a major alarm bell.
Complexity is a warning sign.
Definitely. And a huge chunk of its reported revenue and most of its profits relied on just 3 third-party partners in distant, less regulated markets. Extreme concentration risk. Plus, many assets were held in external offshore trust accounts. That inherently lacks direct transparency and control. You should ask why, with this convoluted setup. And get this, Wirecard's own bank subsidiary was lending money to its fintech partners, which artificially boosted its interest income. It made them look stronger operationally than they were.
Wow. Okay, so how did it finally unravel?
The house of cards collapsed when the auditors, EY, couldn't confirm the existence of EUR $1.9 billion in cash. That was the bulk of Wirecard's reported profits. Turns out, this supposed cash was allegedly held in escrow accounts by third-party trustees, not by Wirecard directly. The money just wasn't there. It likely never existed. The consequences were immediate and brutal: insolvency, debts of EUR $3.2 billion, share price down over 70% in a day, unsecured bonds trading at like 20 cents on the euro, an 80% loss for investors. The CEO arrested. It's still Germany's biggest post-war corporate fraud, a vivid lesson in how governance failures and fraud destroy creditworthiness and recovery prospects no matter how good the numbers looked. We saw something similar in India with Satyam Computer Services, where the founder admitted inflating revenues. The credit impact was instant and severe. Trust evaporated, debt was drastically reevaluated. Robust governance is fundamental everywhere.
Okay, so we've painted this picture with the qualitative strokes, industry shifts, management integrity, or the shocking lack of it with Wirecard. But these stories, while crucial, can feel subjective. How do analysts turn these narratives into something, measurable, something objective? This is where we get down to the quantitative side, right?
Yeah.
Crunching the numbers.
Exactly. This is where the science really kicks in. Quantitative analysis mostly involves financial statement modeling and forecasting. And the model inputs aren't just pulled out of thin air. They're based on our understanding of the company's fundamental business drivers, those qualitative insights we gathered, and a realistic view of future risks and opportunities. There are a few ways to approach this. You could do a top-down macroeconomic approach. Start with GDP forecasts, industry trends, market size, then drill down to the company. Or you could go bottom-up, issuer-specific. Forecast granular details like revenue per product line, cost structures, balance sheet items, building up from the company itself. But often, the best way is a hybrid approach, combining both macro trends and company specifics for a more robust forecast.
And the goal of all this number crunching?
The main goal is to identify the key financial factors driving a company's probability of default, POD, and crucially, to understand how these factors might change over the credit cycle in good times and bad. To give it some structure, we usually focus on 4 key pillars of financial resilience. Profitability. Can the company actually generate earnings from its operations? Leverage. How much does it rely on debt versus equity? Coverage. Can it comfortably meet its regular debt payments from its cash flow? And liquidity. Does it have enough cash or access to cash to meet short-term needs, its safety net? Analyzing these 4 pillars together gives you a pretty holistic view of a company's financial strength and its ability to handle shocks.
Right, these aren't just random numbers. They're specific tools, the language of finance, giving us real insights into a company's financial strength and ability to pay its debts. Let's break down some key ratios. What are analysts really looking at?
Okay, absolutely. First up, profitability. Strong, stable earnings are vital because that's where the cash for debt repayment ultimately comes from. A key ratio here is the EBIT margin. That's operating income divided by revenue. It shows operating performance before interest and taxes, giving a clean look at operational efficiency. Higher EBIT margin means more profit available for debt service. But we don't just look at the number, we look at the trend. Is it going up or down, and why? We also hear a lot about EBITDA, That adds back depreciation and amortization, which are non-cash charges. It gives a better sense of operating cash flow before those big non-cash hits. Useful for comparing companies. But, and this is important, EBITDA doesn't account for capital expenditures, the real cash spent on maintaining and growing the business. So high EBITDA doesn't automatically mean healthy if they aren't reinvesting.
Good point. So profitability is step one. What about covering the actual debt payments? That's coverage.
Exactly. Coverage ratios measure the ability to meet those regular debt payments, especially interest. The classic one is EBIT to interest expense, operating income divided by interest expense. How many times over can operating profit cover the interest bill? A higher ratio means more breathing room, lower credit risk. A ratio of 1x means you're just scraping by on interest, very risky. Investors want to see much higher multiples, like 3x, 5x, or more. You'll also see variations using EBITDA in the numerator, or even EBITDAR, adding back rent. And sometimes the denominator includes lease payments, too, especially now with accounting changes that put leases on the balance sheet. These give a fuller picture of fixed charges.
Okay, and then leverage. How much debt are they carrying relative to their size or earnings?
Right, leverage shows the reliance on debt financing. A very common one is debt to EBITDA. Total debt divided by EBITDA. A higher ratio means higher leverage, more risk. Once you get above 3x or 4x, it's generally considered highly leveraged. But be careful with this one in cyclical industries. EBITDA can swing wildly, making the ratio jump around by context. A more insightful and maybe more conservative measure is retained cash flow, RCF, to net debt. This uses cash flow, not just earnings. It's RCF divided by net debt, which is total debt minus cash. Here, a higher ratio means lower leverage, because you're comparing cash flow available after dividends to the net debt burden. Now, just to clarify those cash flow terms quickly, FFO, or funds from operations, is typically net income plus non-cash stuff like D&A, deferred taxes. It's cash from core operations before debt payments. Then RCF, retained cash flow, is basically FFO minus dividends paid. This is crucial because it's the cash actually left over in the company after paying shareholders. Cash that could potentially pay down debt. It's a better measure of deleveraging capacity. Think about Reliance Industries in India recently.
They made a conscious effort to deleverage. And watching metrics like debt to EBITDA fall and RCF to net debt rise showed their balance sheet strengthening. That attracted investors.
That cash flow perspective seems really important. What about the last pillar, liquidity?
Liquidity is all about the short term. Can the company meet its immediate obligations? A company can be profitable, even solvent assets liabilities, but still default if it runs out of cash to pay bills right now. So we look at cash on hand, marketable securities they can sell quickly, and committed bank lines, unused credit they can draw on. More liquidity is always better. It's that crucial safety buffer. Look at a company like Infosys in India. They consistently hold large amounts of cash. That gives them immense financial flexibility and contributes to their strong credit rating. One really important caveat, though. Many of these cash flow ratios, like FFO and RCF, are non-IFRS or non-GAAP. Their definitions can vary. So you have to be careful, check the footnotes, and be consistent when comparing companies.
Right, so just calculating today's ratios isn't enough. It's a snapshot. Analysts need to look forward, right? Model different scenarios. Let's use another hypothetical, maybe Bowstream Corporation, to see how you'd actually use these ratios to assess risk under pressure. Stress testing the numbers.
Absolutely. Let's paint a picture for Bowstream. Say it's a mid-sized, solid investment-grade company, maybe making consumer durables like appliances. Initially, things look good. Solid 10% sales growth, healthy 35% operating profit margin. Seems efficient, demand is strong. But a good analyst always asks, what if? We need a downside scenario, something realistic but challenging. So let's model this. Sales growth slows dramatically, maybe due to recession fears. Production costs shoot up, supply chain issues. Inflation push cost of goods sold from 65% of sales way up to 85%. And interest rates rise, so their borrowing costs jump from 6% to 8%. Plausible stresses, right?
It definitely sounds like things that could happen. So what would the model show?
Well, when you run those tougher assumptions through a detailed financial model, the impact on the key ratios is usually pretty stark. It tells a story of deterioration. You'd likely see the EBIT margin plummet, maybe from that healthy 25% down to just 5% over 5 years. That eats away at the profit available for debt service. Consequently, the debt-to-EBITDA ratio, our leverage measure, would probably increase dramatically, say from a comfortable 0.36x up to maybe 1.21x. Much higher leverage, much higher risk. And the retained cash flow, RCF to net debt ratio, the ability to pay down net debt from cash flow after dividends would likely decrease significantly, maybe from a strong 379% down to a worrying 54%. Much weaker repayment capacity.
Okay, so the numbers clearly show things getting worse. What's the bottom line for Bowstream's credit?
The conclusion is pretty clear from that scenario. Declining profitability, weaker debt coverage, sharply increased leverage. In the real world, this would almost certainly mean wider credit spreads on their bonds investors, demanding more yield for the higher risk, and a high likelihood of a ratings downgrade. Now, to figure out how much of a downgrade, analysts would compare both streams' projected ratios against its industry peers, and crucially, against the benchmarks published by rating agencies like Moody's or S&P for different rating categories. A drop like that could easily push a company from a solid A rating down to BA, or maybe even into the speculative grade territory, depending on the severity. This kind of stress testing is absolutely essential. It shows how resilient a company is. We do this in India too. If, say, Asian paints face rising raw material costs and slowing housing demand, analysts would model the hit to their EBIT margins and leverage to see the potential impact on their rating and bond prices. Same process, different context.
Okay, so we've looked inside the company qualitatively, quantitatively. But let's say, despite everything, a company does get into trouble, defaults. You mentioned earlier that not all debt is created equal in that situation. The hierarchy, the pecking order, really matters for who gets what back. And how do the rating agencies factor all this in?
That's absolutely fundamental in fixed income, and it ties directly back to that loss given default, LGD, we talked about. Seniority ranking is just that, the priority of payment. The highest ranking debt gets the first claim on cash flows and assets if the company defaults or restructures. Higher seniority generally means lower LGD. And remember, secured debt. It has specific assets pledged as collateral. That reduces the lender's loss because they have a direct claim on those assets. If the collateral isn't enough, the leftover claim usually ranks equally pari passu with other senior unsecured claims.
Right. Can you walk us through that hierarchy again, from top to bottom?
Sure. It's crucial to get this order clear. 1. First lien mortgage debt, usually at the very top, secured by specific high-value assets like a building or major equipment. 2. Second lien debt, also secured by the same assets, but explicitly ranks below the first lien. They only get paid from collateral after the first lien holders are fully satisfied. 3. Senior secured debt. Has a direct claim on certain assets, maybe a broader pool than a specific first lien. Still a strong suited position. 4. Senior unsecured debt. This is the most common type of corporate bond. It's a general claim on the company's assets, no specific collateral. Ranks below all secured debt. 5. Subordinated debt. Explicitly ranks below senior unsecured debt. Paid only after all senior creditors, secured and unsecured, are satisfied. 6. Junior subordinated debt. The lowest priority debt. Often gets little or nothing back in a default. LGD can be 100%, almost like equity in a bankruptcy. This tiered structure helps issuers. They can offer secured debt to lower borrowing costs when needed, or issue subordinated debt which costs more than senior debt but less than equity. And for investors, understanding this hierarchy is absolutely key to managing risk. It dictates who gets paid first and potentially how much. It's the critical factor for your recovery prospects.
That tiered structure makes logical sense. Let's make it concrete again. Imagine a hypothetical company, Vivivu Inc., VIVU. Say VIVU has two different bonds out there. One is a 6.5% callable note due in 7 years. The other is a 10.0% subordinated note due in 10 years. How different are these from an investor's viewpoint, especially if VIVU hits hard times?
Okay, comparing those two VIVU issues really highlights the importance of seniority. The differences are stark. The 6.5% callable notes are described as senior secured unsubordinated obligations, and they're backed by a pledge of specific assets. So in an insolvency, these notes rank highest. First dibs on the collateral value. If the collateral isn't quite enough to cover the debt, the remaining shortfall then ranks equally, pari passu, with other senior unsecured claims. That collateral gives them a strong recovery cushion. Now, contrast that with the 10.0% subordinated notes. These are explicitly unsecured and subordinated. They rank below the senior secured notes and also below any other senior unsecured debt VIVU might have. They are ahead of junior subordinated debt, if any, and way ahead of shareholders, but their recovery potential is much, much lower. They only get paid if all the senior creditors are fully satisfied first. This clearly shows how seniority and collateral drastically change a bond's standing, even from the same issuer. It directly impacts potential recovery and therefore how the bonds are priced. You'd demand a much higher yield on that subordinated note to compensate for the higher LGD risk. You see this in India too. A big developer like DLF might have secured loans tied to specific projects alongside unsecured corporate debentures. The secured project loans will have lower rates because of that collateral protection, reflecting lower LGD.
Okay, so we understand the pecking order. But what does it mean in practice? How much money do investors actually get back? This brings us to recovery rates, right? The bottom line after a default.
Exactly, the practical outcome. And when a company defaults, a key principle is pari passu treatment within the same class, meaning all creditors at the same seniority level are treated equally. A senior unsecured bond maturing in 30 years has the same pro rata claim in bankruptcy as one maturing next month. Priority is based on class, not maturity. Now, historical data clearly shows recovery rates vary a lot by seniority. Moody's data for North American non-financials in 2019, for instance, showed senior secured debt recovered about 45.9% on average, but senior unsecured debt recovered only 31.3% that year. That's a big difference in your actual recovery just based on the bond structure.
What else influences those recovery rates besides seniority?
Several things. First, industry matters a lot. Companies in industries facing long-term secular decline, think obsolete technology, usually have lower recovery rates than companies just facing a temporary cyclical downturn. Why? Because the assets in declining industries might have fewer buyers or alternative uses. Second, the timing within the credit cycle is huge. In a strong economy, asset values are higher, buyers are plentiful, collateral markets work well, leading to higher recovery rates. In weak economy or a crisis, asset values collapse, liquidation becomes harder, and recovery rates plummet. Third, the company's capital structure composition itself is critical. If a company has a ton of secured debt already piled up, there might be very few unencumbered assets left for the lower-ranked creditors. Like a waterfall, if the top buckets take almost all the water, there's little left for those below.
Okay, so this all feeds back into that expected loss idea.
Precisely. It brings us back to that fundamental calculation. Expected loss. EL equals POD ALGD. Let's run a quick example. Say an auto company has a 1-year probability of default, POD, of 0.8%. Now, based on historical data, let's assume recovery rates are 58% for senior secured, so LGD equals 1.58 will equal 0.42 or 42%. 46% for senior unsecured, LGD equals 1.46 equals 0.54 or 54%. And 23% for subordinated, LGD equals 1.23, 0.77 or 77%. Now we can calculate the expected loss for each bond type. For the senior secured bond, EL equals 0.008, POD 0.42, LGD equals 0.00616 or 0.432%. For the subordinated bond, EL 0.008, 0.77 equals 0.00616 or 0.616%. See how that works? Even with the same probability of default for the company, often triggered by cross-default clauses, the higher seniority leads to lower LGD, which directly results in a lower expected loss for the investor. That's why investors accept lower yields on more senior debt. They expect to lose less if things go wrong. One last point. While legal priorities are clear, the actual bankruptcy process can be messy, negotiations happen.
Sometimes junior creditors get a bit more than strictly entitled, just to speed things up and avoid costly legal fights that drain value. The U.S. system often favors reorganization, while others might lean towards quicker liquidation, which can affect outcomes too.
Right, so all this incredibly detailed analysis, qualitative factors, quantitative ratios, debt structure, potential recovery, it all needs to be summarized somehow. And that's where credit ratings come in, right? The shorthand. But you mentioned there's a difference between an issuer rating for the whole company and an issue rating for a specific bond. Can you clarify that? Why the two ratings?
That's a really important distinction. An issuer credit rating, Moody's, might call it a corporate family rating, CFR. S&P might call it a corporate credit rating, CCR, essentially applying to the company's senior unsecured obligations. It reflects the company's overall creditworthiness. Its main focus is on the probability of default, POD, of the company itself. How likely is this entity to fail? An issue credit rating, however, is specific to one particular bond or loan. It considers not just the issuer's POD, but also factors specific to that bond, like its seniority and potential loss given default, LGD.
Okay, so how do they get from the issuer rating to the issue rating?
Through a process called notching. Think of it as fine-tuning. The issuer rating is the baseline assessment of the company's health. Then for each specific bond, the rating agency notches that rating, adjusts it up or down based on whether that particular bond has better or worse protection, higher or lower LGD, than the baseline senior unsecured debt. Generally, for higher-rated investment-grade companies, the notching adjustments are smaller. Default is less likely, so LGD differences matter a bit less. But for lower-rated speculative-grade companies, default is a bigger risk, so LGD differences due to seniority or collateral become much more significant. That leads to larger notching adjustments, maybe several notches up for secured debt or down for subordinated debt. Another thing that causes notching is structural subordination. This happens in holding company structures. Debt at the subsidiary level gets paid first from the subsidiary's assets and cash flow, before any cash can go up to the parent company to pay its debt. So parent company debt is effectively lower priority, even if it's also called unsecured.
Let's go back to Royal Caribbean one last time to really nail this notching concept. We talked about their secured debt during the crisis. What if, as things got better, they issued new unsecured debt? How would that compare?
Perfect example to illustrate notching. So imagine in March 2021, RCL is starting to recover and issues $1.5 billion in new 7-year unsecured notes. At that time, let's say Moody's had assigned RCL a B1 corporate family rating, CFR. That B1 reflects Moody's view of the company's overall likelihood of default, typically applying to its senior unsecured status. But the new unsecured notes themselves might have been rated B2. That's one notch lower than the CFR. Why? Maybe due to structural subordination or other factors increasing their specific LGD slightly compared to a pure senior unsecured claim. Now compare that B2 unsecured rating to the senior secured notes they issued earlier. Those were rated B2. That's a full 3 notches higher than the B1 CFR. It shows notching perfectly. The new unsecured debt gets notched down 1 step due to slightly higher LGD. The older secured debt gets notched up 3 steps due to significantly lower LGD from that strong ship collateral. The rating reflects the specific risk and recovery profile of each bond.
So different agencies might approach this slightly differently.
Yes, there are nuances. While they all look at POD and LGD, Moody's explicitly defines credit risk as POD plus expected loss. So the rating scale fundamentally reflects expected loss, EL, baking recovery estimates right into the main rating, especially for speculative grades. S&P and Fitch, however, tend to say their primary credit ratings reflect probability of default, POD, first and foremost. They then often issue separate recovery ratings alongside the issue rating, explicitly grading the potential recovery, like 1 for highest, 5 for lowest. These recovery ratings then drive the notching adjustments applied to the specific issue rating. So the final issue rating might end up similar, but the methodological emphasis is slightly different. It's something sophisticated users of ratings need to be aware of.
Wow, okay. We have definitely covered a huge amount of ground today, really peeled back the layers on corporate credit analysis. You've learned about that interplay between the qualitative story business model, industry, governance, and the quantitative numbers, profitability, leverage, coverage ratios, painting that financial health picture, and then how debt seniority, recovery rates, and finally credit ratings bring it all together to show potential investor outcomes. It really is both an art and a science, isn't it?
It absolutely is. And if you connect this all to the bigger picture, what really stands out is that assessing creditworthiness isn't just about looking at numbers in a vacuum. It's about understanding the whole ecosystem. The company's operations, its industry, management integrity, the debt structure, everything is connected. Which maybe raises an interesting question for you, the listener, to think about. When you next see a major company in the headlines, maybe making a big acquisition or facing economic headwinds, what's one specific credit metric or qualitative factor you'd immediately want to check first? And why that one? What initial story would it tell you?
That's a great thought to leave everyone with. And that wraps up Module 16 of the CFA Level I 2025 Fixed Income Volume 6 course. Next time, we'll dive straight into Module 17, Fixed Income Securitization. We'll explore how individual loans, mortgages, car loans, credit cards get packaged up, sliced, diced, and sold as securities. We'll demystify how these complex structures work, how they're valued, and the unique risks and opportunities they present. We'll see the securitization machine in action. Hope you can join us then. Welcome, curious minds, to the deep dive. You know, we're often surrounded by these financial marvels that operate just out of sight, sort of silently enabling everything from the home you live in to the car you drive, maybe even the small businesses that power our local economies. But how exactly does the money flow to make all that happen? What if I told you there's this, well, powerful financial alchemy that takes thousands of individual loans, things that normally wouldn't be easy to sell, and transforms them into highly sought-after investments, fueling growth and spreading risk in ways that were, frankly, unimaginable just a few decades ago. Today, we are taking a really significant step in your CFA Level I 2025 Fixed Income Volume 6 journey. We're embarking on Module 17, Fixed Income Securitization. And our mission today, it's pretty clear. We're going to pull back the curtain on securitization. We'll demystify what it actually is, uncover its profound impact. It's really a game changer for businesses, investors, and the broader economy, and clearly define the key players in this, let's face it, intricate process. We really aim to break down this complex financial engineering into truly clear, digestible insights. The goal is to make sure you emerge not just informed, but genuinely well-versed in this critical area of modern finance. Now, just a quick heads up before we really dive in. The foundational understanding we build today in Module 17 is absolutely crucial. It's kind of the bedrock for our next deep dive, Module 18. In Module 18, we'll specifically focus on asset-backed security, ABS, instrument, and market features. We'll explore the different categories and characteristics that make these unique investment vehicles, building directly on what we discussed today. So make sure to absorb every insight. Okay, let's unpack this fascinating concept of securitization and truly understand how it creates value, reshapes risk, and, well, underpins so much of our financial world.
That's an excellent way to frame it, actually, because securitization is fundamentally about transforming and strategically redistributing value within the financial system. At its core, securitization is the process of taking assets that are typically illiquid, meaning they're not easily sold or traded in a market, and converting them into highly tradable securities. Think of things like individual mortgage loans, auto loans, credit card receivables, or even commercial real estate loans. These are assets that usually just sit on a company's balance sheet, tying up capital. Now, the securities created from this process are what we call asset-backed securities, or ABS. And the crucial detail here, the really important part, is that these ABS are directly backed by, and their repayment relies solely on, the cash flows generated from a specific, carefully pooled group of those original underlying assets. So we're not talking about a company's general creditworthiness here. We're really talking about the performance of a distinct pool of financial promises.
Okay, that concept of transforming illiquid assets into tradable securities really resonates. It makes me think of like a bustling market where individual pieces of fruit, maybe raw mortgages, single car loans, are hard to sell on their own, right? They're just sitting in baskets, maybe eventually spoiling. But somehow securitization turns them into this high-demand juice blend that's easy to package, brand, and sell. Is there a secret ingredient in that blend? Is it just the packaging, or is there like a fundamental change in the flavor profile, the risk and return characteristics that makes it so much more appealing?
That's a fantastic way to look at it, and you've absolutely hit on the core insight. The secret ingredient isn't just the blending, it's the structured redistribution of those flavors, the risks and returns. Think of it this way. Not everyone wants a whole, ripe apple, right? Some investors want apple juice, some want cider, maybe some want a fortified fruit drink. Securitization allows us to create different products from the same underlying fruit basket that cater to vastly different palates or in finance, vastly different risk appetites and return expectations. We're not just packaging. We're fundamentally altering the nature of the assets by creating new securities with really tailored characteristics. And this brings us to a really powerful aspect of securitization, the power of risk transfer and efficient capital allocation. Traditionally, a bank originating a home loan holds that loan on its balance sheet for its entire life, bearing all the credit risk and tying up capital. But through securitization, the risk associated with these underlying assets is effectively transferred from the original lender or issuer to the investors who purchased the ABS. This isn't just a simple handover, it's a strategic reallocation. For issuers, well, it frees up capital that was previously tied up in those illiquid assets, and that capital can then be used to generate more economic activity. And for investors, it grants them access to entirely new asset classes they might not otherwise be able to invest in directly, like a diverse pool of auto loans from all across the country. Ultimately, this mechanism very efficiently allocates capital across the financial system, directing it from where it's maybe less productive to where it can be used to generate more growth and foster innovation.
That makes perfect sense. And the linchpin, the crucial element that truly makes all of this transformation and redistribution possible, is something called a special purpose entity, or SPE.
Exactly. The SPE.
When you describe the SPE as this bankruptcy remote firewall, it almost sounds, I don't know, too good to be true, doesn't it? Like a magic trick where assets just disappear from one balance sheet and reappear safely behind this protective wall. But I imagine the legal and financial engineering to actually achieve that isn't simple. Can you explain what an SPE really is and why its structure is so pivotal? Maybe share a hypothetical situation where that firewall was truly put to the test.
You're absolutely right. It's definitely not magic. It's meticulous legal design. The special purpose entity, often also called a special purpose vehicle, SPV, or a special purpose company, SPC, is a legally independent entity created specifically for securitization. Its primary role is to buy and own these pooled assets from the original lender. Once it legally owns them, it then issues new securities, the ABS, that are backed by the cash flows from these assets and sells those new securities to investors. The critical term here is bankruptcy remote. This means the SPE is structured in such a way that should the original company that originated the loans, the originator, face financial distress or even bankruptcy, the assets held by the SPE are legally protected from the originator's creditors. They cannot be seized to satisfy the originator's debts. This legal separation is achieved through a very carefully structured true sale of assets from the originator to the SPE. It ensures the SPE isn't just a subsidiary, but a genuinely independent legal entity. And to illustrate your point about the firewall being tested, I recall a hypothetical scenario often discussed in distressed markets. Imagine a mortgage originator, let's call them Secure Home Loans. They've securitized a large pool of residential mortgages through an SPE called Prime Mortgage Trust. Now, if Secure Home Loans then faces severe liquidity issues, maybe due to a market downturn, and is on the verge of bankruptcy, their own creditors would aggressively try to claim any remaining assets, right?
Right, naturally.
But because the mortgages in Prime Mortgage Trust were legally sold to the SPE, those assets are completely off limits to Secure Home Loans creditors. The cash flows from those mortgages continue to flow directly to Prime Mortgage Trust, which then pays the ABS investors. This separation is absolutely paramount. It means ABS investors are shielded from the corporate credit risk of Secure Home Loans, relying instead just on the performance of the underlying mortgage pool. It's one of the most robust legal constructs in modern finance, but it also highlights the absolute necessity of getting those true sale provisions and legal independence ironclad from the outset. That's really what gives investors the confidence to buy these securities.
That's a powerful illustration of the SPE's protective power and why that meticulous legal structuring is so vital. Okay, so with that foundational understanding, let's explore the immense benefits that securitization brings. It really can be a win-win-win situation across different parts of the financial world. Let's start with the substantial benefits for the issuers, the original companies or banks, often referred to as originators. What's in it for them?
Oh, for originators, the advantages are genuinely significant and multifaceted. They profoundly impact their operational capacity and financial health. First, securitization allows them to remove assets and their associated risks from their balance sheet. Think about it. When a bank or a company makes thousands of car loans, or say millions of microfinance loans, those loans are assets that tie up capital and expose the company to credit risk, prepayment risk, interest rate risk, all sorts of things. By selling these illiquid assets to an SPE, the originator effectively cleans up its balance sheet. This reduces their leverage, lowers the amount of regulatory capital they need to hold against those assets, and crucially, frees up valuable capital that was previously locked away. It transforms long-term assets into immediate cash, making them much more capital efficient.
Wow, so that really frees them up then.
Exactly. And secondly, this freed-up capital directly translates into an expanded lending capacity. With less capital tied up than existing loans, the issuer now has the financial room to originate new loans. This is a huge driver for growth, especially for institutions that might be capital constrained or operating in really high-demand sectors. They can leverage their existing capital base much more effectively to serve more customers or even expand into new markets. Thirdly, and this is a big one, originators can often achieve lower funding costs. This is a critical economic benefit. Because the ABS issued by the SPE are backed by a segregated pool of assets and are bankruptcy remote from the originator, their credit risk is often viewed as distinct from and potentially superior to the overall credit risk of the original issuer. So if the underlying loan pool is strong and structured well, the ABS can actually command a higher credit rating than the originator's own corporate bonds. This isolation of risk can mean the ABS command a lower interest rate, resulting in cheaper funding for the originator compared to issuing traditional corporate debt or raising equity. And finally, issuers can also generate significant fee income from the securitization process. They earn fees for originating these loans in the first place, of course. But moreover, they often continue to service the loans even after selling them to the SPE, collecting payments, handling delinquencies, managing customer relations. This generates an ongoing stream of servicing fees, turn an asset that was once maybe a capital drain into a profitable, recurring revenue stream, but without the associated balance sheet risk.
That's where it gets really interesting for companies looking to grow or manage their balance sheets more effectively. Let's look at some real-life examples that bring these issuer benefits to life. In the Indian context, maybe consider HDFC Ltd, Housing Development Finance Corporation Ltd. They're a massive player in housing finance, right? A prime example of an originator. How do they leverage securitization?
Absolutely. HDFC Ltd, being a leading housing finance company in India, faces this constant demand for capital to fund new home loans in a rapidly growing real estate market. It's huge. So when HDFC securitizes a large pool of its home loans, it's transferring these long-term, relatively illiquid assets off its balance sheet to a special purpose entity. What HDFC gets in return is immediate cash. They can then take that cash and use it to originate more new home loans, satisfying the immense demand for housing finance across India. This process is critical because it allows HDFC to, well, recycle its capital efficiently without having to constantly raise new equity or issue more traditional, potentially more expensive debt. It effectively expands their lending capacity and reach, directly contributing to India's housing sector growth, all while managing their capital requirements more effectively.
That makes perfect sense. And in the U.S. context, we can probably see similar dynamics at play with a major captive finance company like, say, Ford Motor Credit Company.
Right. Ford Motor Credit provides financing for millions of cars every single year. They accumulate an enormous portfolio of auto loan receivables. Now, these loans, if held on their balance sheet, would tie up a significant amount of capital and expose them to considerable credit risk. So, by regularly securitizing pools of these receivables through an SPE, maybe something called a Ford Credit Auto Owner Trust, they essentially convert future cash flows from those car payments into immediate usable cash. This capital is then instantly available to be redeployed. Maybe that means offering more competitive financing rates to new car buyers, which in turn boosts vehicle sales for Ford Motor Company itself. It also significantly reduces the amount of regulatory capital that Ford Credit needs to hold against these loans, making their operations much more capital efficient and allowing them to support a much larger volume of car sales than they could otherwise. These examples really illustrate how securitization empowers companies to become more agile, more responsive to market demands, and expand their core business.
It's clear how much benefit issuers derive. Okay, but what about the investors? How does securitization benefit them, especially when they could just buy corporate bonds or other traditional fixed income products? What's the distinct appeal there?
That's a crucial question. And if we connect this to the bigger picture for investors, it's really about providing a more granular, a more customized way to participate in various credit markets. It offers both diversification and potentially attractive returns that wouldn't otherwise be available. One of the primary benefits is the ability to obtain tailored risk, return, and maturity exposures. Investors can choose from different tranches of ABS, maybe a senior tranche, a mezzanine tranche, or a junior equity tranche. Each is meticulously structured to offer varying levels of risk and expected return.
So they can really pick their spot on the risk spectrum.
It's exactly. This level of customization allows them to precisely match their specific investment goals and, importantly, their liability profiles. For instance, a pension fund with long-term liabilities might need very stable, predictable cash flows and low risk, whereas a hedge fund might be seeking higher, albeit riskier, returns. Securitization structures allow for this kind of fine-tuning. Secondly, securitization provides access to diversified asset classes that might otherwise be completely out of reach. I mean, think about it. How would a typical institutional investor directly invest in a pool of thousands of individual auto loans or credit card receivables from various borrowers spread across an entire country?
Yeah, that sounds incredibly complex.
It would be incredibly difficult and impractical, right? Due to the expertise needed, the scale, the liquidity constraints. ABS packages these into tradable, understandable securities, granting investors exposure to these underlying assets. This allows them to diversify their portfolios beyond just traditional corporate or government bonds, accessing new sources of yield and credit exposure, potentially enhancing overall portfolio resilience. And thirdly, through various structural and credit enhancements, which we'll get into in more detail later modules, ABS can offer enhanced predictability and risk reduction compared to trying to invest in the underlying individual assets directly. These enhancements, things like over-collateralization or subordination, help stabilize cash flows and mitigate credit risk. This makes the investment more appealing to a broader range of investors, often translating into higher credit ratings for the senior tranches than the underlying assets might individually imply.
Those benefits sound very appealing to a wide range of investors. Let's put that into perspective with some examples. For a large institutional investor in the U.S., maybe like the California Public Employees Retirement System, CalPERS, they're a massive pension fund with long-term liabilities to meet. How might they leverage securitized debt to achieve their investment objectives?
Right, CalPERS, like any large pension fund with multi-decade obligations, is keenly focused on stable, predictable income streams. They need cash flows that can match their future pension payout requirements while also seeking adequate risk-adjusted returns. So they might strategically invest in highly rated senior tranches of residential mortgage-backed securities, RMBS, perhaps those issued by U.S. government-sponsored enterprises like Fannie Mae or Freddie Mac. These RMBS are backed by a diverse pool of home mortgages and are typically seen as having lower credit risk, especially those backed by GSEs. For CalPERS, this provides a relatively stable, long-term income stream that helps them match their pension payout obligations. Crucially, these often offer a yield that's slightly higher than what they might get from, say, U.S. Treasury bonds, but without taking on excessive credit risk. so it enhances their returns while maintaining a prudent risk profile. It's a very efficient way for them to get exposure to the vast U.S. mortgage market.
Okay. And on the other side of the world, for an Indian institutional investor, maybe an entity like SBI Mutual Fund, how might they utilize ABS to diversify their portfolio within the Indian market?
An Indian mutual fund like SBI Mutual Fund might actively seek out opportunities to invest in ABS backed by, say, commercial vehicle loans. These could be originated by a non-banking financial company, NBFC, like Shriram Finance Ltd, for example. This allows a mutual fund to gain exposure to the credit market of India's rapidly growing logistics and transportation sector, which is a really significant engine of economic activity there. Investing in this type of ABS diversifies their portfolio away from just traditional corporate bonds, which might be concentrated in other sectors like manufacturing or IT. Moreover, these ABS might offer higher yields compared to some other fixed income options available in the Indian market, and all while benefiting from the structured nature of the ABS, which can include various credit enhancements to manage risk effectively. It's really about broadening investment horizons, enhancing diversification, and optimizing risk-adjusted returns within the dynamic Indian financial market.
So we've seen how securitization profoundly benefits individual companies as issuers and specific types of investors. What does this all mean for the broader economy and financial markets as a whole? It sounds like it's about greasing the gears of commerce, isn't it? What's the systemic impact here?
Precisely. That's a good way to put it. For economies and financial markets, securitization delivers several profound macro-level benefits that extend far beyond individual transactions. First, it significantly leads to improved liquidity and efficiency. By taking illiquid loans, assets that are typically difficult to sell quickly without a significant price discount, and transforming them into standardized tradable securities, securitization dramatically enhances overall liquidity in the financial system. These securities can then be actively traded in robust secondary markets, which helps in establishing fair and transparent prices. This increased liquidity means capital isn't just sitting idle in illiquid assets. It can be redeployed swiftly, making the entire financial system more dynamic and, well, efficient. Secondly, it provides a crucial alternative funding source for businesses and institutions. Beyond traditional corporate bonds or equity issuance, securitization offers another powerful avenue for companies to raise capital. This is particularly vital for non-bank lenders or specialized finance companies that might not have direct access to traditional capital markets. This alternative funding mechanism fosters innovation and supports economic growth by allowing a wider range of businesses to access financing, often on more favorable terms, encouraging investment and job creation. Thirdly, and relatedly, it significantly reduces liquidity risk for financial institutions. The ability for banks and other lenders to sell and transfer assets off their balance sheets, essentially converting long-term illiquid assets into immediate cash, dramatically reduces the risk that they will face a shortage of cash when unexpected demands arise. This ability to manage liquidity more effectively strengthens the stability of individual financial institutions and, by extension, the financial system as a whole, making it potentially more resilient to market shocks.
These are profound impacts on the overall financial landscape. Can you give us some real-life examples of how this plays out in the Indian and U.S. economies, specifically demonstrating this kind of systemic benefit?
Certainly. In the Indian context, think about the securitization market for microfinance loans. These loans, often quite small in value, are originated by specialized small finance banks or microfinance institutions, MFIs, like Bandhan Bank or Suryodaya Small Finance Bank. These institutions are dedicated to lending to a wider base of underserved populations, often in rural and semi-urban areas, who typically lack access to traditional banking services. When these MFIs securitize their pooled microloans, it attracts funding from larger commercial banks and institutional investors. These larger players might otherwise find it impractical, too costly, or just too complex to directly lend to millions of microborrowers. This process significantly increases the flow of credit to areas that traditionally lack access to formal financing. It fosters genuine financial inclusion, stimulates local entrepreneurial activity, and enhances the overall efficiency of credit allocation across India. It's directly supporting grassroots economic development and poverty alleviation.
That's a fantastic example of financial inclusion.
It really is. Now, turning to the U.S., the securitization of student loans through entities like Sallie Mae or, more recently, government-backed programs has been absolutely instrumental in providing widespread access to higher education. By packaging these individual student loans into ABS, it allows a broad range of investors, from pension funds to asset managers, to essentially fund education. This injects massive liquidity into the student loan market. Without securitization, the sheer volume of loans required to support millions of students would likely overwhelm the balance sheets of traditional lenders, severely limiting access to higher education. This availability of capital makes it possible for students who might otherwise struggle to finance their degrees to pursue higher education. This supports human capital development on a national scale, fostering a more educated workforce and contributing significantly to long-term economic productivity and innovation. These examples really highlight how securitization underpins vital, socially impactful sectors of our economies.
Fascinating stuff. So we've covered the what and the why of securitization and its widespread benefits. Now, let's get into the how. The securitization process isn't just a simple transaction. It's a carefully orchestrated dance, like you said, moving assets and cash through a new legal structure to serve different financial needs. Can you walk us through the simplified flow, maybe using an example like Brightwheel Automotive or BRWA, that hypothetical car manufacturer, and really elaborate on each step?
Yes, let's definitely use the BRWA example to illustrate the typical securitization process. It helps to have a concrete case. We can break it down into a clear linear sequence, detailing the intricacies of each step. Okay, step 1, loan origination. It all starts with an entity, like BRWA's financing subsidiary, extending credit directly to customers. So a customer walks into a BRWA dealership, buys a car, and takes out a car loan from BRWA's financing arm. These individual car loans are the seed assets, the raw materials, if you will, that will eventually be securitized. At this stage, BRWA's financing subsidiary holds these loans on its own balance sheet, incurring the associated credit risk and tying up its capital. Step 2, asset pooling. The originator, BRWA's financing subsidiary in this case, then pools these assets together. And this isn't just a random collection. They meticulously gather a large number of car loans that share similar characteristics. Maybe they're all 4-year fixed-rate car loans with similar borrower credit scores, or perhaps loans originating from a specific geographic region. This pooling is really crucial because it helps in standardizing the collateral, making it easier for investors to understand and analyze the aggregated risk profile, and it achieves diversification across a large number of smaller individual risks. Step 3, asset transfer to SPE. Now, this is arguably the most critical legal and financial step. The originator, BRWA's financing subsidiary, sells these pooled assets to a newly established bankruptcy-remote special-purpose entity. Let's call this SPE Car Loan Trust, or CLT for short. BRWA receives cash for these loans, effectively monetizing its future cash flows immediately. This transaction is specifically structured as a true sale. This means the ownership of the loans irrevocably and legally transfers from BRWA to CLT. It's not just a pledge of collateral. BRWA no longer owns these loans. This is absolutely essential for the bankruptcy remoteness we discussed earlier, ensuring that if BRWA faces financial trouble, the assets held in CLT are protected.
So that true sale is the key legal maneuver.
It's the absolute key. Step 4, ABS issuance. With the pooled car loans now legally owned by CLT, the SPE, CLT then issues and sells new securities, the asset-backed securities, to investors in the capital markets. These securities are directly backed by the future cash flows that will be generated from that purchased car loan pool. Investors, maybe ranging from pension funds to asset managers, pay cash to CLT for these ABS. This is how the SPE raises the money it needed to pay BRWA for the initial assets, completing the funding cycle. And the ABS are often divided into different classes or tranches, which we'll discuss shortly, to appeal to different investor appetites. Step 5, cash flow payments. Finally, over time, the car loan borrowers make their regular monthly payments, principal and interest on their original loans. These payments typically go to a servicer. Often this is the original originator, so BRWA's financing subsidiary again. The servicer collects these payments, handles any delinquencies, manages the customer relationship, basically. The servicer then forwards these collected cash flows, minus any agreed-upon servicing fees, to the SPE CLT. And finally, CLT uses these cash flows to pay interest and principal to the ABS investors according to a predetermined schedule and payment priority. This completes the cycle. Money flowing from borrowers through the servicer and SPE, ultimately to the investors, all while the SPE legally stands as the independent owner of the assets.
That's a very clear and detailed breakdown of the process, highlighting the layers of legal and financial engineering involved. And within that flow, you mentioned several key parties, each with a very specific and crucial role. Let's maybe detail those, as they seem integral to the integrity and functioning of any securitization deal.
Absolutely. Beyond the underlying borrowers, the 3 main parties we've touched upon are really fundamental. First, there's the seller of collateral, also known as the originator or sometimes the depositor. In our BRWA example, this is BRWA's financing subsidiary. This entity is the original source of the assets, the loans. Its primary goal is usually to free up capital, reduce balance sheet risk, and gain liquidity by selling these assets. They are the initial spark, responsible for originating the loans and gathering them into suitable pools. Second is the Special Purpose Entity, SPE, which is also the legal issuer of the ABS. In our example, this is the Car Loan Trust, CLT. This entity buys the assets from the originator and then issues the ABS backed by those assets to investors. As we emphasized, its legal independence and bankruptcy remoteness are its defining features. These are crucial for protecting investors from the originator's financial troubles and ensuring that the securities get rated based on the quality of the collateral, not the originator's overall credit rating. Third is the servicer. This party is responsible for administering the loans throughout their entire life cycle. This includes all the day-to-day operations, collecting payments from borrowers, handling any delinquencies or defaults, managing customer inquiries, processing prepayments, and, if necessary, recovering and disposing of collateral, like repossessing a car if a borrower unfortunately defaults.
And the servicer can be the originator or someone else entirely.
Exactly. In our BRWA example, BRWA's financing subsidiary often continues to act as the servicer, even though it no longer owns the loans. This makes sense given its existing infrastructure and a relationship with the borrowers. But it's important to note that while the servicer can be the originator, it can also be a completely independent third party hired specifically for its expertise in loan servicing. The servicer's efficiency and diligence are absolutely paramount, as their performance directly impacts the cash flows that are ultimately available to the ABS investors. And beyond these main three, there are also several important third parties that play crucial supporting roles, ensuring the process is robust, transparent, and legally sound. These include underwriters, typically investment banks, who facilitate the issuance and sale of the ABS to investors. They help structure the deal, market it, and often guarantee a price. Then there are rating agencies, like S&P, Moody's, Fitch. They assign credit ratings to the different tranches of the ABS, helping investors assess risk independently. Their role is critical for market confidence, although, as we know, their performance was heavily scrutinized during the 2007-2009 financial crisis. You also have trustees, typically financial institutions, acting on behalf of the ABS holders. They safeguard the assets after they're transferred to the SPE, hold funds, provide reports to ABS holders, and generally ensure that the SPE and servicer adhere to the terms of the securitization agreement. And of course, attorneys and accountants are indispensable. They ensure legal compliance, tax efficiency, and accurate financial reporting throughout this whole complex process. It truly takes a village of experts, as you said.
It really sounds like a highly coordinated village is needed to make this happen, given the intricate layers of financial and legal structures. And with so many parties involved in such a complex structure, there must be some crucial legal documents that govern everything, right? Ensuring all parties know their roles and responsibilities, and, critically, protecting investor interests.
Indeed, the legal documentation is absolutely the backbone of any securitization. Two legal documents are particularly important, maybe beyond standard bond indentures you might see elsewhere. First, there's the purchase agreement. This is between the seller of the collateral, the originator like BRWA, and the SPE like CLT. This document is vital because it outlines critical representations and warranties that the seller makes about the quality, characteristics, and legal status of the transferred assets. For example, it might state that all loans are current, not in default, and meet specific underwriting criteria that were agreed upon. This is vital for assuring investors about the underlying collateral, which is, after all, their ultimate source of repayment, and it provides a basis for recourse if those representations prove false down the line. Second, and perhaps even more comprehensive, is the prospectus, or sometimes called an offering circular. This detailed document is provided to potential investors and is essentially the Bible of the securitization. It describes the entire securitization structure, including the specific characteristics of the underlying asset pool, the priority of payments to various tranches, how much various parties, like the servicer, administrators, and the ABS holders themselves, will receive in fees or payments, and any credit enhancements that are being used to protect investors. It's the go-to document for understanding the specifics of the deal, its risks, and its potential returns. Thorough review of the prospectus is absolutely non-negotiable for any serious investor.
Okay. Now, you mentioned earlier that there's a spectrum of securitized products moving from simpler structures to increasingly complex ones. Can you walk us through that progression, highlighting how these different structures might address various risk and return profiles for investors?
Absolutely. Understanding this spectrum is really key to grasping the evolution and versatility of securitization. We can sort of categorize securitized products by their increasing complexity and, importantly, the degree to which they truly transfer risk off the originator's balance sheet. So at the simplest end of the spectrum, we have covered bonds. These are predominantly issued by European banks, historically. What makes them unique and distinct from true securitization is that the issuer of the bank actually retains the underlying assets, typically a specific pool of high-quality mortgage loans or public sector loans, on its balance sheet. However, it segregates these assets legally as specific collateral for the bonds it issues. Investors are paid by the issuing bank itself, not directly from the cash flows of that specific asset pool. This means covered bonds are not considered a full securitization because the assets are not transferred off balance sheet to an independent SPE.
So why do them then?
Well, the bank often benefits from a lower funding cost because investors have what's called dual recourse. If the issuing bank defaults, investors have recourse to both the bank's general assets and that segregated collateral pool. For investors, this offers a relatively low risk, albeit typically lower yielding, investment compared to other options. Okay, moving up in complexity and into what we consider true securitization, we get to pass-through securities. Here, the underlying assets are transferred to an independent SPE, taking them off the originator's balance sheet. Investors in pass-through securities then receive proportional principal and interest payments directly from the pooled assets, as those payments are literally passed through the SPE after deducting servicing fees. The payments investors receive can vary directly, depending on the overall credit risk and payment patterns of the underlying pool. Things like early prepayments or defaults really hit home immediately. This direct link means investors bear the full brunt of the timing and credit risk of the underlying pool. These are suitable for investors comfortable with less structural protection, but desiring that direct exposure to the performance of the collateral. Next, we have bonds with structural enhancements. These build significantly on pass-through securities by adding a layer of quite sophisticated design. The aim here is to make cash flows more predictable and reduce risk for certain investors. They enhance payment predictability by redistributing cash flows from the underlying pool across different tranches according to a preset schedule or rule set. This structure is specifically designed to mitigate the impact of unexpected changes in payment patterns, like defaults, early prepayments, or extensions in repayment periods. These enhancements can also include various forms of credit enhancement, further reducing the credit risk, especially for the senior tranches.
Tranches. This is where that redistributing the flavors analogy we talked about becomes particularly clear, isn't it? It sounds like the real financial wizardry happens here. How does this tranching, or subordination as it's called, actually work? What does it achieve in terms of risk and return for different investors?
That's absolutely right. Tranching, or subordination, is an incredibly clever and powerful mechanism. It allows a single pool of assets to be effectively sliced and diced to cater to vastly different risk appetites. It involves creating more than one bond class or tranche from the exact same pool of assets. These bond classes, often labeled senior, mezzanine, and equity, sometimes junior, differ significantly in how they receive cash flows and, crucially, how they absorb losses from the underlying pool of assets. To make it really concrete, let's refer to that classic example you often see in the CFA materials. Imagine an asset pool with a total value of $100 million. This could be split into, say, a senior tranche of $70 million, a mezzanine tranche of $20 million, and an equity or junior tranche of $10 million. The key here is the waterfall structure for payments and loss absorption.
A waterfall, okay.
Exactly. Think of it like water flowing down. The senior tranche gets paid first from the available cash flows coming from the assets. These are considered the safest bonds. They receive their payments before any other tranches get a dime. In return for this superior payment priority and lower risk, they typically offer the lowest interest rate. Now, if there are any losses from defaults in the underlying loans, the equity or junior tranche absorbs those losses first. It acts as the first line of defense, like a shock absorber for the tranches above it. This means the junior tranche bears the highest risk. If the losses from the underlying pool exceed $10 million in our example, the equity tranche investors could potentially lose their entire investment. Because of this high risk, they demand the highest potential returns as compensation. Only once the equity tranche is completely wiped out, meaning losses have exceeded that $10 million, then the mezzanine tranche starts absorbing losses. It sits in the middle. It's riskier than the senior tranche, obviously, but more protected than the equity tranche. It offers a yield that's higher than the senior tranche, but lower than the equity tranche, reflecting its intermediate risk profile. And only after both the equity and mezzanine tranches are completely exhausted, meaning losses have exceeded $30 million in our example, $10 million from equity plus $20 million from mezzanine, only then would the senior tranche begin to incur any losses. This structural protection makes the senior tranche much, much safer, often allowing it to earn a high credit rating, even if the underlying asset pool contains some lower quality loans.
That's fascinating how they carve up the risk like that.
It really is incredibly clever, because it allows that single pool of assets to be carved up into securities that cater to vastly different risk appetites. A conservative institutional investor, like our pension fund example, CalPERS, might buy the highly rated, lower-risk senior tranche, accepting a lower yield for that safety and predictability. Conversely, a more aggressive hedge fund or a specialized ABS investor might target the equity tranche, which has the highest risk and absorbs losses first, but compensates with the highest potential returns if the underlying assets perform well. This structure essentially allows for the efficient distribution of risk and return based on investor preferences, significantly expanding the potential investor base for the underlying assets. And finally, just to round this out, we often distinguish broadly between mortgage-backed securities, MBS, and non-MBS ABS. MBS are, well, as the name suggests, ABS primarily backed by a pool of mortgages. This distinction is quite common, especially in the U.S. market. Examples include residential mortgage-backed securities, or MBS, backed by home mortgages, commercial mortgage-backed securities, DMBS, backed by commercial property mortgages, and collateralized mortgage obligations, CMO, which are often multi-tranche MBS with complex payment rules. Non-MBS ABS, on the other hand, are backed by other types of assets, things like auto loans, credit card receivables, student loans, equipment leases, or even esoteric things like music royalties. Examples here include collateralized debt obligations, CDO, collateralized loan obligations, CDO, and collateralized bond obligations, CBO, each backed by different types of debt obligations.
Okay, that gives us a really comprehensive picture of the securitization process and the diverse structures it can take, from simpler covered bonds all the way to complex multi-tranche ABS. But, even with all this brilliant engineering, all this legal structuring, there's no such thing as a free lunch in finance, right? What are the shadows in this bright picture? What are the inherent risks that investors and market participants really need to be acutely aware of, even in the most carefully structured securitization deals?
That's a crucial point, absolutely. Despite the sophisticated structuring and legal protections, securitization is certainly not without its inherent risks, and understanding them is paramount. Broadly, these fall into a few key categories. First, we have timing risks. These relate to the unpredictability of when cash flows from the underlying asset pool will actually be received by the investor. These include contraction risk. This occurs when borrowers pay off their loans earlier than expected. This often happens when general interest rates fall significantly, making it attractive for borrowers to refinance their existing loans at a lower rate. Or maybe when housing prices rise rapidly, enabling homeowners to sell their properties and pay off their mortgages early. For ABS investors, particularly those holding higher-yielding tranches, this means receiving their principal back sooner than anticipated. The problem is, this forces them to reinvest that capital at potentially lower prevailing interest rates, which can reduce their overall expected return over the life of the investment. It's essentially the risk of having to reinvest at a lower rate than you expected.
So you get your money back too soon, basically.
Exactly, and can't earn the same return elsewhere. The flip side is extension risk. This is the opposite scenario when borrowers pay off their loans slower than expected or even default, leading to delayed principal payments. This typically occurs during economic downturns when unemployment rises or perhaps property values decline, making refinancing difficult and increasing the likelihood of defaults. For ABS investors, this means their principal is returned over a longer period than originally expected. This lengthens their exposure to market risks, such as rising interest rates, potentially reduces their overall yield if they could have reinvested sooner at higher rates. Both contraction and extension risk fundamentally alter the expected cash flow timing, which can be really detrimental to an investor's cash flow planning and overall investment strategy. The second major risk category is the fundamental credit risk of the underlying assets themselves. Despite the SBE's bankruptcy remoteness shielding investors from the originator's corporate credit risk, investors ultimately face the risk that the individual borrowers whose loans are in the pooled collateral will default on their payments. While credit enhancements, like the subordination we just discussed, or over-collateralization, where the value of collateral exceeds the value of the ABS issued, are designed to absorb some of these losses. Significant defaults across the underlying pool can still impact even senior tranches, potentially leading to losses for investors. So the quality of the underlying loans, the underwriting standards used when they were originated, remains absolutely paramount. Assessing that quality accurately can be quite challenging, especially for highly diversified pools.
And some of these risks, particularly those related to underlying asset quality and maybe the opaque complexity of certain structures have had pretty significant historical consequences, haven't they? It definitely brings to mind the global financial crisis of 2007-2009.
They certainly have, and the 2007-2009 global financial crisis serves as a stark, really indelible reminder of securitization's vulnerabilities when it's not properly managed or regulated. While securitization itself isn't inherently flawed, a confluence of factors amplified its inherent risks to catastrophic levels back then. We saw serious issues like misaligned incentives. For example, mortgage originators were often paid simply to make loans, regardless of the borrower's actual ability to repay, because they knew they could quickly sell these loans off into securitization vehicles and transfer the risk. This led to what some called a race to the bottom in lending standards, creating vast pools of increasingly risky subprime mortgages. Then there was the profound challenge of complexity and opacity. These securitization structures became incredibly intricate, especially with products like collateralized debt obligations, CDOs, that often contain tranches of other ADS, creating CDO squared, even cubed. This meant even sophisticated investors sometimes struggled to fully understand the underlying risks of what they were actually buying. It was like a black box for many participants. And crucially, the rating agencies, whose role it was to independently assess risk, often failed to adequately account for the correlation risk within these pools, essentially. The risk that many loans would default all at the same time if economic conditions soured. They assigned high ratings, AAA even, to what turned out to be very risky instruments, which unfortunately misled many investors. All these factors combined meant that when the U.S. housing market turned sour, the losses cascaded through the financial system in unexpected and devastating ways. It exposed the systemic risks that can arise when securitization lacks transparency, proper risk assessment, and robust regulation. It really highlighted that while securitization can efficiently transfer risk, it also requires rigorous oversight and transparent processes to prevent such crises. And importantly, later modules will delve into how regulations and structures have evolved since then, specifically to address these shortcomings. One final critical consideration, especially for global investors, is jurisdictional differences. The legal frameworks and market practices for securitization can vary significantly from country to country. For example, the presence and development of trust law, specific tax regulations, and bankruptcy codes can all impact how effectively an SPE can be established as truly bankruptcy remote and how true sales are recognized legally. What constitutes a valid true sale in the U.S. might differ significantly in India or a European country. This is a crucial consideration for global investors because the legal protections they might expect and the enforceability of contractual terms might differ significantly depending on where an ABS is actually issued. This complexity adds another layer of necessary due diligence for anyone involved in cross-border securitization investments.
And a really important point about global finance, reminding us that finance doesn't operate in a vacuum, but within these distinct legal and regulatory landscapes. Well, we've covered a tremendous amount of ground today in Module 17, from the foundational definition to the profound impacts and the inherent risks. We began by demystifying securitization as the process of transforming illiquid assets into tradable asset-backed securities, or ABS, directly backed by pooled loans and receivables. We highlighted the indispensable special-purpose entity acting as that crucial bankruptcy remote firewall. We then detailed the multifaceted benefits it offers, from freeing up capital, expanding lending capacity, lowering funding costs, and generating fee income for issuers, to providing tailored risk exposures, diversified asset access, and enhanced predictability for investors. Ultimately, improving liquidity and efficiency for economies and financial markets, which we saw exemplified by housing finance in India and student loans in the U.S. We meticulously walked through the step-by-step securitization process using the BRWA example, identifying the key parties involved: the originator, SPE, servicer, and others, and the critical legal documents like the purchase agreement and prospectus that govern these complex deals. We then explored the spectrum of securitized products, from simpler covered bonds to the more complex, risk-redistributing tranches of bonds with structural enhancements, really digging into how tranching works. And of course, we thoroughly acknowledged the inherent risks, like timing risks, contraction and extension, and the fundamental credit risk, concluding with the critical lessons learned from the 2007-2009 financial crisis and the importance of jurisdictional differences.
So, what does this all mean for you, the aspiring CFA? Fundamentally, securitization is a powerful, yet, as we've seen, double-edged financial innovation. It has profoundly reshaped how credit flows through our economies. Despite its complexities and inherent risks, it enables capital to be raised and deployed far more efficiently than ever before. It connects borrowers with a diverse range of investors who can accept different levels of risk. This process empowers both those who need capital for growth and those who supply it seeking returns, opening up entirely new avenues for investment, diversification, and economic development. It really underpins much of our modern financial system. Understanding its mechanics isn't just academic. It's about understanding the very arteries of global finance. And maybe to leave you with a thought-provoking idea to consider. Think about the pervasive role of credit in our lives, from a small business loan allowing a local startup to flourish to the massive financing behind the latest infrastructure project you see being built. How much of that economic activity might actually grind to a halt without the efficient, albeit complex, capital allocation made possible by securitization? And how does understanding that often invisible financial plumbing beneath our modern world change your perspective on both its resilience and its potential vulnerabilities?
That truly wraps up Module 17, a comprehensive deep dive into fixed income securitization. We've laid the essential groundwork for understanding this fundamental concept and its massive impact. Next time, in Module 18, we'll dive deeper into the specifics of asset-backed security, ABS instrument, and market features. We'll explore the different categories, characteristics, and nuances that make them unique investment vehicles. You won't want to miss it as we build directly on today's insights.
Okay, let's unpack this. Welcome back to the deep dive. Today, we're diving into Module 18 of the CFA Level I-2025 Fixed Income Volume 6 course. The topic: asset-backed security instrument and market features.
That's right.
This is where finance gets pretty creative, turning things like credit card debt, even solar panel loans, into actual investment opportunities.
Exactly. Sophisticated ones, too.
We'll be looking at covered bonds, different kinds of non-mortgage ABS, and the often talked about, sometimes misunderstood world of collateralized debt obligations, CDOs. Our mission today is really to cut through some of that complexity, show how these instruments actually work, and hopefully give you those aha moments about reconfiguring cash flows and reallocating risk.
Indeed. And understanding securitization, it's not just, helpful, it's really foundational if you're navigating modern financial markets.
Right.
It's not just about knowing the names of the instruments, it's about grasping the mechanics underneath, how risk gets shifted around, how capital efficiency is boosted, how new funding channels are opened up. We'll connect the dots on how they work, why they exist, and crucially, what you as potential investors or issuers really need to know. It's quite fascinating how these sort of disparate, sometimes hard-to-sell assets get pooled and repackaged.
Into something entirely different, almost.
Precisely, into liquid, marketable securities that can meet a whole range of investor needs for risk and return.
Exactly, like financial alchemy. And just a quick note for everyone following the full CFA curriculum. After this deep dive into ABS, our very next module, Module 19, gets specific. It's mortgage-backed security, MBS, instrument, and market features.
Which builds directly on today's concepts.
Absolutely. So think of today as laying some really important groundwork for understanding that huge MBS market. So let's start right at the beginning. What is securitization really at its heart, and why is it so, indispensable now?
Good place to start.
Basically, you take a whole bunch of individual assets, could be loans, could be receivables, even future revenues. You group them all together.
The pooling stage?
Right. And then you slice up the future cash flows from that big tool into different pieces. Tranches, they call them.
Tranches.
And you sell those pieces to investors. It's kind of like baking a big, maybe complicated cake and then creating different layers, different flavors of risk and returns, something for everyone. It's all about reconfiguring those underlying cash flows.
That's a great analogy. Reconfiguring cash flows is spot on. The unifying principle here is transforming assets that might be illiquid, hard to value individually.
Like thousands of car lots.
Exactly. Transforming them into liquid, tradable securities. Imagine that bank with thousands of car loans. Each one has its own specific risk, right? Default risk, prepayment risk.
Yeah.
Pooling them helps diversify that instantly.
Okay, diversification.
But the real sort of magic of securitization is how it then partitions or slices those diversified cash flows into these distinct tranches.
The layers of the cake.
Precisely. Each tranche is engineered really to have a specific payment pattern and a specific risk level. This lets issuers cater to a much wider range of investors. You've got some looking for safety, lower risk, lower returns.
Like pension funds, maybe.
Often, yes. And others who are willing to take on more risk, hoping for higher returns.
So it's a powerful tool for risk management, financial engineering for risk almost.
That's a good way to put it. The main advantage of securitization, fundamentally, is reducing that cash flow variability for the originator, the issuer.
Feeding that off their books sometimes.
Often, yes.
Yeah.
And skillfully reallocating specific risks like default risk or the chance people pay back their loans early, prepayment risk across those different tranches. Each tranche gets a return that matches its risk level. This lets the original lender, say the bank, transfer these risks, which raises a key question. How do they actually create these different risk profiles from the exact same pool of assets? It's quite clever, but the overall benefits are clear. Effective risk transfer, huge flexibility for both issuers and investors customizing risk and return, and much better efficiency of capital allocation across the whole financial system. It unlocks liquidity.
That flexibility point is interesting, especially when you see how structures adapt. But what if a bank, say, wants to use securitization for funding, but also wants to give investors an extra layer of comfort, sort of a belt and suspenders approach, keeping the assets on their own books?
Good question. That leads us perfectly into a very unique and historically very robust type of securitization. Covered bonds.
Excellent point. Covered bonds, yes, they are unique, and they are a very senior form of debt obligation, typically issued directly by financial institutions, banks, mostly.
Not an SPV thing usually. Generally not. That's a key difference. What's fundamentally distinctive is they're backed by a specific, segregated, ring-fenced pool of assets. Usually high-quality stuff, commercial mortgages, residential mortgages, sometimes public sector loans.
You mentioned mortgages mostly, but are there others?
Oh, yes. Depending on the country's rules, you might see pools backed by ship finance loans, aircraft leases, though mortgages are definitely the most common globally.
And this isn't exactly a new idea, is it? Feels like I've heard of these before.
Oh, far from new. The original concept, the fan brief, goes back over 250 years. Prussia, actually.
Wow.
It was designed to let landowners raise long-term money using their property as collateral, but with that extra layer of issuer guarantee. That model proved incredibly successful and has been adopted widely: Europe, Asia, Australia. Each place has its own specific rules, eligible collateral, legal frameworks.
So give us an example, maybe.
Sure. Imagine a firm, let's call them Commercial Finance Partners, AG, issues, say, EUR 30 million in 2.00% covered bonds. The backing: a pool of prime, fully amortizing residential mortgages. And maybe they have a strict rule, like an 80% loan-to-value cutoff.
Meaning homeowners have at least 20% equity.
Exactly. A good equity cushion.
Now, here's what I find really interesting and honestly critical for understanding why they're considered so safe. Unlike typical ABS, where the assets are sold off to a special purpose vehicle, an SPV, and vanish from the bank's balance sheet.
Right, the off-balance sheet treatment for most ABS.
With covered bonds, the underlying assets stay on the issuer's balance sheet. That's a huge difference. And then there's the dual recourse nature. What exactly does that mean for the investor?
It means if the issuing bank, let's say a big European bank, were to actually go bankrupt, a severe scenario, obviously the investors in those covered bonds have two separate claims, not just one.
Okay, two claims. What are they?
First, they have a direct preferential claim on the ring-fenced loans within that specific cover pool set aside for their bond.
So the mortgage pool in our example.
Correct. But second, and this is the real game changer, the belt and suspenders part, they also have a claim, alongside other senior unsecured creditors, on the general unencumbered assets of the issuing bank itself.
Whoa, okay, so that dual recourse is a massive selling point, isn't it? Like having a double safety net. If the mortgages go bad, you still have a claim on the bank. That's significantly different from other securitized stuff.
Absolutely. It's fundamental. This structural feature dramatically enhances the credit quality, makes them incredibly reliable, resilient funding sources. It's precisely why they often carry lower credit risk and therefore offer lower yields compared to similar ABS, or even compared to the bank's own senior unsecured debt.
It's just they're safer.
Exactly. This robust framework, keeping assets on the balance sheet, lets the bank raise long-term funds more cheaply than issuing unsecured debt. Those assets truly stand behind the bank's promise to pay. It's a pillar of stability, especially in shaky markets.
So it's not like they just create this pool of mortgages and forget about it, right? You mentioned it's a dynamic cover pool. Sounds like it's actively managed or monitored.
Precisely. That dynamic nature is another key safeguard. The assets in that pool aren't static. They're continuously monitored, usually by an independent third party, checking performance, making sure they still meet strict criteria like those LTV ratios.
And if something goes wrong, like a loan defaults,
If assets get prepaid early by borrowers, or if they become non-performing, the issuer is legally obligated to replace them. They have to swap in new qualifying assets.
Oh, okay.
This ensures there's always a sufficient stream of high-quality cash flows to meet the covered bond payments right up to maturity. On top of that, there's often over-collateralization.
We talked about that concept earlier. More collateral than bonds issued.
Exactly the same principle here. The total value of the collateral pool must exceed the face value of the bonds. In Germany, for their Pfandbrief, the legal minimum might be low, like 2%, but in practice, market pressure often demands much higher levels, maybe 10%, 15% or more. These features, dynamic management, over-collateralization, are powerful, ongoing risk mitigators.
Makes sense. And you also mentioned managing risks around maturity, different redemption regimes, especially if the bank itself gets into trouble.
Yeah.
Sounds like ways to handle the end game for the bond. Can you walk us through those?
Certainly, these regimes are critical fail-safes. They're designed to try and align the bond's cash flows with its original maturity schedule, even if the sponsoring bank defaults. There are three main types.
Okay.
First, hard bullet covered bonds. These are the strictest. If the payment isn't made exactly on the scheduled maturity date, bang, it's an immediate bond default. Payments are accelerated, clean, but potentially harsh.
Right. No wiggle room.
None. Second, soft bullet covered bonds. These are quite common and offer a bit more flexibility. They build in a grace period. If the issuer can't pay on the original date, it doesn't immediately trigger default. Instead, the final maturity date gets extended, often by up to a year.
Giving them time to sort things out.
Exactly. It gives the issuer, or maybe an administrator if the bank failed, time to manage the assets, maybe sell them in an orderly way without a fire sale, hopefully preserving more value.
Okay, makes sense. And the third?
Finally, conditional pass-through covered bonds. These are the most, let's say, adaptable. If the issuer fails to pay everything by the original maturity date, the bond converts into a pass-through security.
Indeed.
Meaning instead of getting a lump sum repayment, the bondholders then just receive the principal and interest payments as they are collected from the underlying mortgage pool whenever they come in. The maturity effectively extends until everything's paid off.
So no technical default, but
Yeah.
you might wait longer for your money.
Correct. Your expected return profile changes.
Yeah.
The upside for the issuer is this structure often helps achieve a higher credit rating at issuance because of that built-in flexibility.
Okay, so let's quickly recap the key differences because this is fundamental. Covered bonds, on balance sheet, dual recourse, pool plus issuer, typically fixed interest, fixed maturity with those redemption regimes.
Correct.
Traditional ABS, on the other hand, generally off balance sheet, sold to an SPV, single recourse, just the asset pool, often floating interest rates, and potentially pass-through payments, meaning principal comes back as it's collected, not necessarily on a fixed date.
That sums it up perfectly, a fundamental distinction in risk and structure.
Okay, let's ground this with some examples. Imagine, say, State Bank of India, SBI, a huge player in India. They decide to issue covered bonds.
Okay.
They could ring-fence a big pool of their high-quality home loans, maybe even some originated by HDFC, which they acquired. They issue covered bonds against that pool.
Right.
That dual recourse nature, the quality of the housing loans plus the backing of SBI itself, would be very attractive to Indian institutional investors, like insurance funds or pension funds. It lets SBI raise long-term money more cheaply.
Makes perfect sense. Leveraging their own creditworthiness combined with specific collateral.
Exactly, and maybe channeling that cheaper funding into more home loans.
And similarly, in the U.S., you could see a large commercial bank issuing covered bonds to fund, say, green initiatives.
Oh, interesting angle.
Yeah, maybe a portfolio of loans for energy-efficient commercial buildings or renewable energy projects. They issue green-covered bonds, they stay on the bank's balance sheet, offer dual recourse.
The stable senior debt.
Exactly. But with that specific ESG label appealing directly to that rapidly growing pool of investors looking for both safety and sustainable impact, it's a powerful combination in today's market.
That focus on safety really brings us to the next crucial topic: credit enhancement structures. These seem like the secret sauce, the structural engineering that makes many ABS investment grade, right? Fortifying them against defaults.
Indeed. Secret sauce isn't far off. The whole point of credit enhancement is to proactively absorb losses if defaults happen in the underlying loan pool.
Okay.
By doing that, they cushion the blow for investors, making the whole deal more attractive, often boosting ratings significantly higher than the underlying assets could ever get on their own. This usually involves creating those multiple classes or tranches of debt with different levels of protection.
And you mentioned internal versus external enhancements.
That's right. We can group them broadly. Internal enhancements are built right into the securitization structure itself. External ones involve a third party adding protection. Let's focus on the internal ones first. They're the most common and arguably the most fundamental.
Okay, internal enhancements. First up, over-collateralization. This sounds pretty straightforward, just having more collateral than you need.
That's precisely it. Over-collateralization, or OC, means the total value of the asset pool, the loans, is deliberately set higher than the total face value of the bonds issued against it.
Creating a buffer.
Exactly, a cushion, an equity buffer. If some loans default, there's still enough value left in the pool to keep paying the bondholders. Let's use that car loan trust example again. Say they issue EUR 1 billion in bonds, but they back it with EUR 1.2 billion in actual car loans. That extra EUR 200 million is the over-collateralization.
Right.
Now imagine 10% of those car loans default. That's EUR 120 million in losses, 10% of 1.2 BN. But you still have EUR 1.08 billion in remaining collateral, 1.2 BN 120 meters, which is more than enough to cover the EUR 1 billion in bonds. The OC absorbed the loss.
Okay, that makes sense. Now here's where it gets really interesting with a real-world example and a pretty famous one. Solar City. Before Tesla bought them, they did this public solar ABS deal, ACTY 2013-1.
Ah, yes, the first public solar ABS in the U.S. Groundbreaking.
Exactly. The bonds issued were backed by about USD 54.4 million in expected cash payments from customer solar leases. But get this. The assets backing those bonds, the solar systems and contracts, had a carrying value of almost USD 144 million.
Wow, that's huge over-collateralization.
Nearly 2.7 times. That massive cushion was absolutely critical for Solar City. It helped them get an investment-grade rating, BBB+, from S&P, which meant they could borrow money much more cheaply. For a new kind of unproven asset class at the time, that was essential to get institutional investors comfortable.
Absolutely. That level of OC signals serious protection and was key to market acceptance. Now, another vital internal enhancement is excess spread.
Excess spread. Okay, what's that?
It's simply the difference between the average interest rate, the coupon, being earned on the underlying assets.
Like the interest on the car loans or credit card debt.
Correct. And the average coupon being paid out to the investors holding the different tranches of the ABS bonds.
Oh.
So if the pool of loans generates, say, 8% interest on average, but the bonds issued only pay out an average of, say, 6% across all tranches.
That 2% difference.
That 2% is the excess spread. It's extra income generated by the pool. This excess cash flow can be used first to cover any losses from defaults or pay administrative fees or even build up a reserve fund. It acts as a dynamic, ongoing buffer.
It's like having a built-in, self-renewing shock absorber. If your income is higher than your expenses, that extra bit can soak up losses before they even touch the principal owed to investors, a first line of defense.
Exactly. And then we come to subordination, also called credit tranching or the waterfall structure. This is probably the most sophisticated way risk gets reallocated within an ABS.
Okay, the waterfall. How does it work?
It involves creating multiple bond classes or tranches. Typically, you'll see senior, mezzanine, and junior tranches. The junior tranche is sometimes called subordinated or even the equity piece. They differ fundamentally in their priority of payment and, crucially, how they absorb losses.
Priority matters.
Absolutely. The waterfall structure dictates the exact pecking order. Cash flows from the asset pool come in at the top of the waterfall. Senior tranches get paid their interest and principal first. They're the most protected.
Safest, lowest yields usually.
Correct. Any losses from defaults in the asset pool are absorbed starting from the bottom up. The most junior or subordinated classes take the first hit. They absorb losses before the mezzanine tranches are affected, and the mezzanine tranches absorb losses before the senior tranches feel any pain. This creates that clear hierarchy of risk and return.
This is a perfect illustration of redistributing risk. Let's use that car loan trust CLT example again to make it concrete. Remember, they issued 4 tranches. Tranche A, senior, EUR 825M. Tranche B, mezzanine, EUR 100M. Tranche C, junior, EUR 50M. And Tranche D, the most junior equity piece, EUR 25M.
Exactly. The spreads over the reference rate increase as you go down the capital structure.
Okay, so let's run a scenario. What if the total losses on the underlying car loans turn out to be, say, EUR 20 million? What happens?
Okay, EUR 20 million loss. In that case, bond class D, the most junior tranche with a face value of EUR 25 million, absorbs the entire EUR 20 million loss. Investors in tranche D would only get back EUR 5 million of their initial EUR 25 million investment. But, crucially,
What about A, B, and C?
tranches A, B, and C remain completely untouched. They continue to receive their full principal and interest payments as scheduled. The loss was fully contained within the first loss piece.
Okay, now let's make it worse. What if the total losses are EUR 70 million?
All right, EUR 70 million loss. Now it gets more interesting. First, tranche D absorbs the initial EUR 25 million of loss. Poof, it's wiped out. Investors lose their entire investment in D.
Okay, so D is gone. We still have 45 million in losses to account for 70-25.
Correct. So the loss then moves up the waterfall to the next tranche, which is Class C, with its EUR 50 million face value. Class C absorbs that remaining EUR 45 million loss.
So Class C investors only get back 5 million, 50-45.
Exactly. They lose most of their investment. But again, what's critical here?
A and B are still okay.
Bond Class A and Bond Class B are still completely unaffected. They continue to receive their payments as agreed. The losses were fully absorbed by the combined EUR 75 million buffer provided by tranches D and C. Senior tranches only take a hit if total losses exceed the value of all the tranches below them.
Wow. That really shows how the structure protects the senior investors. It allows people to choose exactly how much risk they want.
Precisely. You pick your spot in the waterfall.
Now, connecting this to the bigger picture. In India, imagine an asset manager securitizing a pool of, say, corporate non-convertible debentures, NCDs, basically corporate bonds, or maybe diversified loans to big Indian companies like Infosys or Reliance.
Okay, a pool of Indian corporate debt.
They would absolutely use this kind of waterfall structure. It allows different types of Indian investors, maybe conservative insurance funds, wanting the senior AAA tranche, versus more aggressive hedge funds or wealthy individuals willing to buy the junior, higher-yielding tranches to participate based on their own risk appetite. It's key for developing the corporate bond market there.
Makes sense. And just briefly, besides these internal methods, there are also external credit enhancements.
Right, you mentioned those. Less common now.
Generally less common and more scrutinized post-GFC, yes. These involve a third party stepping in. Think financial guarantees from a highly rated bank or insurance company like bond insurance, or letters of credit, or maybe a cash collateral account funded by a third party.
Like an extra safety net from outside.
Exactly. They supplement the internal structure, but they also introduce counterparty risk. What if the guarantor fails? So the market tends to rely more heavily on robust internal enhancements these days.
Okay, so we've got the mechanics of how these things are structured and protected. Now let's shift focus to the actual assets being securitized, specifically non-mortgage asset-backed securities. This covers a huge range beyond just home loans, right?
Oh, absolutely. A vast and diverse universe.
Yeah.
We can broadly categorize them based on the type of underlying loan, amortizing or non-amortizing.
Okay, what's the difference in how they're securitized?
Amortizing loans are the ones you typically think of, where each payment includes both principal and interest, gradually paying down the loan balance. Classic examples are auto loans, equipment leases, even standard personal loans.
So the loan balance shrinks over time.
Exactly. In ABS, backed by these, as borrowers make their payments, investors receive both scheduled principal and interest. Any prepayments people paying off their car loan early also get passed through to the bondholders according to the waterfall. The pool naturally shrinks. Key risks here are often default rates and how fast people prepay.
Right. Now, non-amortizing loans are different, like credit card debt.
Precisely. Or home equity lines of credit, HELOCs. With these, borrowers might just pay interest or a minimum amount, and the principal balance can fluctuate or stay level for a long time. This requires a different structure for securitization.
How so?
For non-amortizing assets like credit cards, the ABS typically has two distinct phases. First, there's a revolving period, or sometimes called a lockout period. This can last several years.
Okay, revolving period, what happens then?
During this time, when cardholders pay back principal on their balances, that money is not passed through to the ABS investors. Instead, the issuer uses that principal cash flow to buy new credit card receivables, essentially replenishing the pool.
So they keep the pool size roughly constant.
Exactly. It maintains the collateral balance. Then, after the revolving period ends, the amortization period begins.
And then the principal starts flowing to investors.
Correct. From that point on, any principal repayments collected from cardholders are no longer reinvested. They are paid out directly to the ABS holders, usually starting with the senior tranches, following the waterfall rules. Understanding these two periods is vital for grasping their cash flow patterns.
Let's zoom in on probably the most common type here, credit card receivable ABS. Banks bundle up huge amounts of outstanding credit card debt for these.
Absolutely. It's a massive market. The collateral is that constantly changing pool of credit card balances. The cash flows feeding the ABS come from three main sources: finance charges, interest paid by cardholders, various fees, late fees, annual fees, etc., and the principal repayments themselves.
And during that revolving period, investors just get the interest and fees part.
Generally, yes. The principal repayments are busy keeping the pool topped up. Once amortization starts, the principal flows through. It's a structure that worked well because you have a huge number of small, diversified borrowers.
But what if things go wrong with the pool? Are there safety valves? I think I've heard of early amortization provisions.
Yes, very important. These are basically circuit breakers. They get triggered if the performance of the underlying credit card pool starts to deteriorate significantly.
Like what? High defaults.
Exactly. Or if the finance charges and fees collected aren't enough to cover the interest payments owed on the ABS notes, or if the rate at which people are paying back principal drops too low. If any of these trigger events happen, the revolving period stops immediately. Bang. Early amortization kicks in, and all principal collections are immediately used to start paying down the ABS notes, prioritizing the senior tranches. It's designed to get investors' principal back faster if the pool looks like it's getting into trouble.
Okay, a crucial protection. So why do banks do this? It sounds complicated to set up. What's in it for them?
Several key benefits for the issuing bank, like our hypothetical commercial finance partners AG. First, it's capital efficiency. Securitizing these receivables often allows the bank to remove them from its balance sheet, which reduces the amount of regulatory capital they need to hold against them. Frees up capital.
Lowers their funding costs, potentially.
Exactly. Second, it transfers the default risk. The risk of cardholders not paying is passed on to the ABS investors, who get paid a yield for taking that risk. Third, the bank usually earns fee income for structuring the deal and servicing the receivables. So it's balance sheet management, risk transfer, and a funding source all rolled into one.
We had that example of CFP AG issuing CHF $900 million in credit card ABS, revolving period of 3 years, amortization of 6 years. Backed by CHF $925 million in receivables, there's that over-collateralization again.
Precisely. Shows how these features work together.
And what's really striking is how well these have performed, especially in the U.S. market.
It's quite remarkable, actually. U.S. credit card ABS showed incredible resilience through the global financial crisis in 08-09, and even through the COVID pandemic disruptions. Very few downgrades during the GFC, practically none during COVID.
Why so strong?
Largely due to the quality of the underlying borrowers often being prime, but also critically, those robust structural features we talked about: deep subordination, absorbing losses, excess spread acting as a buffer, and those early amortization triggers kicking in proactively. The structures really worked as designed in stress scenarios.
And we see this happening in India, too, as their credit card market grows.
Oh, definitely. Major Indian banks like SBI Card, ICICI, HDFC, they all engage in securitizing credit card receivables. It's a standard tool for them now for balance sheet management, meeting capital requirements, and diversifying how they get funding. The structures are very similar, revolving in amortization periods, early amortization triggers tailored to the Indian market context. Shows the global nature of these techniques.
Okay, let's switch gears from credit cards to something greener and increasingly important: solar ABS, tapping into the renewable energy trend.
Yes, a really interesting and growing segment. Solar ABS are backed by pools of loans or leases used to finance solar panel installations, usually on residential rooftops. It's essentially home improvement financing.
And they have that green bond aspect, right?
Exactly. The proceeds are specifically earmarked for financing these green, environmentally friendly projects. This makes them very attractive to ESG investors, those focused on environmental, social, and governance factors. They want a financial return, but they also want to see a positive environmental impact. Solar ABS offers both.
So for the investor, it's not just about the yield. You're funding solar panels, contributing to sustainability, often backed by pretty reliable borrowers and with strong structural protections. Sounds like a win-win.
It often is. From an investment perspective, they typically offer a good risk-reward profile. They're usually well-structured with significant credit enhancement. Over-collateralization is common. Subordinate tranches, reserve accounts, excess spread are all used.
And the borrowers?
The underlying borrowers are generally homeowners with good credit scores, prime borrowers undertaking a significant home upgrade. They have skin in the game. Plus, there's often a pre-funding period built in.
What does that allow?
It allows the issuing trust to buy more qualifying solar loans for a set period after the deal closes. This helps build up the pool size, increases diversification, and ultimately finances more solar energy systems.
And we mentioned SolarCity's AOC2Y 2013-1 deal earlier, the first big U.S. public solar ABS, backed by thousands of systems across many states. It really showed how these could offer decent spreads and fund sustainability.
Absolutely. And an important point about those underlying solar contracts, often they were secured not just by the promise to pay, but by liens on the actual solar equipment installed, or sometimes even a lien on the property itself.
Like a second mortgage almost.
Effectively, yes, a subordinated lien in many cases. This adds another layer of security for the ABS investors if the homeowner defaults. And there's a behavioral aspect, too. The solar payment often replaces what used to be a higher electricity bill. Defaulting might mean going back to higher energy costs, so there's a strong incentive to keep paying the solar loan or lease.
Okay, we've looked at pools of similar assets like car loans or solar leases. Now let's tackle the big one, often seen as more complex. Collateralized debt obligations, or CDOs. These package up diversified types of debt, right?
Yeah.
Sometimes from many different borrowers.
That's right. CDO is really an umbrella term. It describes a securitization backed by a pool of one or more different types of debt obligations. It's crucial, though, to distinguish CDOs from CMO's collateralized mortgage obligations, which are purely mortgage-backed. CDOs are broader.
What are the main types under that CDO umbrella?
Historically, you had collateralized bond obligations, CBOs, backed by portfolios of corporate bonds, maybe some emerging market bonds. But today, the dominant form by far is the collateralized loan obligation, CLO.
CLOs, what are they backed by?
CLOs are specifically backed by pools of leveraged bank loans. These are typically loans made to companies that already have a lot of debt, often non-investment grade, sometimes called speculative grade or high-yield borrowers. The CLO market is huge and is the main focus when people talk about CDOs today.
Okay. And there were others less common now.
Yes, particularly post-GFC, you had structured finance CDOs, which became infamous because they were backed by tranches of other CDOs or ABS, layers upon layers of complexity.
The CDO squared type things.
Exactly. And synthetic CDOs, where the risk exposure wasn't from owning actual loans or bonds, but was created using credit derivatives, like credit default swaps, CDS. Both are much less prevalent now due to regulatory changes and investor caution.
Now, with CLOs especially, backed by these leveraged loans, you mentioned something earlier about them not being static pools. The collateral manager plays a huge role here, right? Much more active than in, say, an auto loan ABS.
Absolutely. This is a key differentiator. CLO collateral pools are actively managed. Unlike a static pool of car loans set at day one, a CLO has a dedicated collateral manager. Think of them as an active portfolio manager for that pool of leveraged loans.
What's their job exactly?
Their job is to continuously monitor the loans in the pool and actively buy and sell loans for the CLO's portfolio over its life. The goal is to manage risk, optimize the portfolio's characteristics, generate enough cash flow to pay all the CLO tranches their promised interest and principal, and ultimately maximize the return for the equity tranche holders at the bottom of the waterfall.
So their skill is absolutely critical.
Paramount. The performance of a CLO is heavily dependent on the skill and decisions of the collateral manager, which raises the question, what happens if they underperform or make bad calls? It highlights the active management risk inherent in CLOs.
And the CDO capital structure, focusing on CLOs, uses that waterfall again, but maybe with higher stakes given the active management and the leveraged nature of the underlying loans.
Yes, the waterfall principle is central. Just like in other ABS, you have senior, mezzanine, and subordinated equity tranches. The money to buy the initial pool of leveraged loans comes from selling these tranches to investors.
Senior gets paid first, lowest yield. Equity takes first loss, highest potential return.
Exactly. Senior tranches, often rated AAA or EPA, get top priority for cash flow, lowest risk, lowest yield. The equity tranche is the first to absorb losses from defaults in the loan pool, but it gets all the residual cash flow after everyone else, debt tranches, manager fees is paid. It's why CLOs are seen as leveraged investments, especially for the equity holders. They're using the debt financing from the senior and mezzanine tranches to try and earn a high equity-like return from the underlying loan portfolio spread.
Are there different types of CLOs themselves?
Yes, a few main types. The most common, by far, are cash flow CLOs. Here, the actual interest and principal payments collected from the underlying bank loans are pooled and distributed down the waterfall. Simple and transparent.
Okay.
Less common are market value CLOs, where distributions might depend partly on the mark-to-market value of the loan portfolio, introducing more volatility. And as we mentioned, synthetic CLOs use derivatives to create the exposure, much less common today.
Now, to keep that active manager in check and protect the investors, especially the senior ones, CLOs have a lot of performance tests and covenants, don't they? How do those work?
Critically important. These tests are the guardrails. They're designed to monitor the health of the collateral pool constantly and ensure it's generating enough cash flow to meet all the payment obligations. The most well-known is the over-collateralization OC test.
We saw OC earlier. How does it work in a CLO context?
Similar principle, but tested regularly, often monthly or quarterly. It checks if the total principal value of the underlying bank loans still exceeds the total principal value of the outstanding CLO debt tranches by required margin. For example, if you need a 1.20 OC ratio, you need $120 of loans for every $100 of debt tranches, excluding equity.
And if the ratio drops below the required level, if loan defaults erode the collateral value.
If the test is tripped or fails, it triggers a redirection of cash flows. Cash that would normally flow down to the equity tranche and possibly the junior debt tranches gets diverted.
Where does it go?
It's used to pay down the principal of the senior debt tranches instead. This effectively deleverages the CLO structure, building protection for the senior note holders by paying them back faster when the collateral pool shows signs of weakness. It's a key mechanism for maintaining rating stability.
So another built-in circuit breaker, redirecting cash to safety when needed. Are there other important tests?
Oh yes, several. There are tests monitoring industry diversification. You can't have too many loans concentrated in one sector, like energy or retail. There are single obligor limits capping exposure to any single company. And very importantly, there are limits on the amount of lower quality CCC-rated debt allowed in the pool. CCC loans are considered very high risk, close to default. These tests work together to manage the overall risk profile of the portfolio and prevent the manager from taking excessive risks, especially risks that could harm the debt investors.
It sounds like CLOs have a definite life cycle, reflecting that active management.
They absolutely do. Typically, there's an initial ramp-up period right after the deal closes, maybe 3-6 months, where the manager buys the initial portfolio of loans. Then there's a reinvestment period, often several years, where the manager can actively trade, sell loans, buy new ones as long as they meet the portfolio criteria and pass all those tests.
Yep.
Eventually, the reinvestment period ends and the CLO enters its amortization phase, where principal payments received are used to pay down the tranches sequentially according to the waterfall. And importantly, for CLO investors, their recourse is generally limited only to the assets in the collateral pool. They can't go after the original bank that made the loan, or usually even the collateral manager if things go bad. Performance rests entirely on the pool and the manager's skill.
Now, the global financial crisis really tarnished the image of CDOs. How have CLOs specifically evolved since the GFC? Have they cleaned up their act? And who's buying them now?
That's a crucial point. The CLO market underwent a major reset and has come back much stronger and arguably much safer. There's been a definite shift towards simpler structures. The focus now is almost exclusively on CLOs backed by first-lane, senior secured, leveraged bank loans. Those complex CDO squared structures are largely gone.
More transparency.
Much more transparency, yes. And significantly increased scrutiny on the underlying loan quality and the experience and track record of the collateral managers. Today's buyers are mainly sophisticated institutional investors. You see banks buying the highest-rated AAA tranches, partly for regulatory capital reasons. Insurance companies are big buyers across the senior and mezzanine parts of the structure. Hedge funds, mutual funds, pension plans, they all participate, picking the tranche that fits their specific risk-return profile and regulatory needs. The market is institutional, more transparent, and focused on a more understandable underlying asset class.
Let's put this in context again. Imagine in India, maybe a consortium of banks has made significant loans to various infrastructure project manufacturing firms.
Okay, leveraged loans in an Indian context.
Those loans could theoretically be pooled into an Indian-focused CLO. You'd have an Indian collateral manager actively trading those loans, managing the portfolio, and distributing cash flows down the waterfall to different tranches bought by Indian institutional investors, maybe foreign ones too. It could be another way to develop the corporate loan market and provide risk transfer options for banks.
It's certainly plausible as the market develops, and in the U.S., CLOs are absolutely a cornerstone of the leveraged finance market. They provide a huge amount of funding for companies undertaking buyouts or needing growth capital. You have that whole ecosystem of investors, from the most conservative banks buying AAA to specialized credit funds and hedge funds seeking higher yields in the mezzanine or equity tranches. The manager's skill in navigating the complex U.S. corporate loan market is really what drives performance. It truly highlights that active portfolio management aspect. Hashtag tag tag outro.
Wow, okay. That was an incredibly thorough deep dive into the world of asset-backed securities. We really covered a lot of ground, from the unique dual recourse and dynamic pools of covered bonds to the clever internal credit enhancements like over-collateralization, excess spread, and that crucial subordination waterfall structure.
Key concepts.
Then we explored the diversity of non-mortgage ABS, the resilience of credit card deals, the ESG appeal of solar ABS. And finally, we unpacked the actively managed world of CDOs, especially CLOs, understanding that critical role of the collateral manager and how they've evolved since the crisis.
Indeed. We've seen how securitization is this powerful tool for transforming cash flows, reallocating risk very precisely, and providing vital funding across different sectors, both in mature markets like the US and growing ones like India. The key takeaway, I think, is that while these instruments are complex and definitely require careful analysis,
No doubt about that.
when they're structured well and properly understood, they offer incredible flexibility and efficiency for both issuers needing capital and investors looking for specific risk-return profiles. Which kind of leads to a final thought, maybe a question for you, our listener. As financial innovation keeps charging ahead, think about digital assets, tokenization, new ways of financing things. What new, maybe unconventional types of assets do you think might be the next frontier for securitization? How could these structures we've discussed today adapt to a world that's increasingly digital, maybe even intangible?
That's a fantastic question to ponder. Really highlights how dynamic this whole area is.
Okay.
That wraps up our exploration of Module 18, Asset-Backed Security Instrument and Market Features. Next time, we'll dive straight into Module 19, focusing specifically on mortgage-backed security, MBS, instrument and market features, building directly on everything we've learned today about securitization.
Looking forward to it.
See you then.
All right, welcome back to the deep dive. If you're looking to cut through the jargon and really get how the financial world ticks, well, you're definitely in the right place. Today, we're zeroing in on a cornerstone of the CFA Level I 2025 Fixed Income Volume 6 curriculum. And it's a big one. We're tackling Module 19. Mortgage-backed security, MBS instrument, and market features. You know, for most people, mortgage just means, well, the loan you take out to buy a house. Seems pretty simple, right? But what if I told you that the quiet decision of millions of homeowners deciding whether to refinance or sell can actually create a financial earthquake felt across global bond markets? That's the often underestimated power of mortgage-backed securities, or MBS. And this isn't just some niche corner of finance. It's like the largest asset-backed securities market in the entire world. Its health is directly tied to the pulse of real estate, the economy, and even, our overall financial stability. So today we're going on a pretty fascinating journey. We'll see how those seemingly straightforward mortgage lends transform into some of the most complex yet utterly captivating financial instruments out there.
That's precisely it. Our deep dive today isn't just about rattling off definitions. Our mission is really to demystify MBS. We want to pull back the curtain on how they actually work. We'll start with the fundamental elements, the humble residential mortgage loan itself, then build up to the intricate specifics of both residential and commercial mortgage-backed securities. We're going to dissect their unique cash flows, unpack their, sometimes quite sophisticated structures, and maybe most importantly, illuminate the specific risks that make them so dynamic. And look, this knowledge isn't just for an exam. It's like having X-ray vision into the heart of the economy. It's absolutely crucial for anyone looking to navigate fixed income markets, understand global finance, or even just make sense of the daily headlines about interest rates and real estate.
Okay, let's unpack this. And it's quite fitting, actually, that this particular module wraps up our entire CFA Level I 2025 Fixed Income Volume 6 journey. So by the end of this deep dive, you should have a truly comprehensive and, dare I say, robust understanding of this critical asset class. Every time someone takes out a home loan, it sets in motion this chain of events, eventually touching some of the world's largest investment portfolios. At its heart, it's just a simple promise, right, to repay a loan. But then financial engineering enters the picture, transforming those individual promises into something far more complex, far more powerful, mortgage-backed securities. So what's this financial alchemy all about? What exactly are MBS?
Well, at its core, MBS are essentially bonds. Bonds that have been created by taking thousands, sometimes tens of thousands of individual mortgage loans and bundling them together. This process, as we've touched on in previous modules, is called securitization. Think of it like this. A borrower gets funds for a property, agrees to a repayment schedule. That property serves as collateral, meaning the lender has a claim on it if payments aren't made. And MBS is simply an investment vehicle that derives its value and its cash flows from these underlying loans. But here's where it gets really fascinating and, frankly, quite challenging for investors. What's unique about MBS is the inherent uncertainty of their cash flows. Unlike, say, a standard corporate bond, where you generally know exactly when and how much interest and principal you'll receive, assuming no default, of course, the cash flow from a pool of mortgages is constantly in flux. It's unpredictable. This uncertainty, primarily driven by the behavior of individual borrowers, is the central challenge. It gives rise to what we call prepayment risk.
Prepayment risk, okay.
Yeah, prepayment risk is simply the risk that a borrower repays principal, either a portion or the full amount, at a different pace than what was originally scheduled on the loan documents. It's not about them not paying necessarily, it's about when they pay, faster or slower than expected.
So it's a timing issue, a kind of constant dynamic flow. And if I remember correctly, this prepayment risk isn't just one single thing. It actually has two distinct sides, almost like two blades of a financial scissor. Is that right?
Exactly. You've hit on a crucial point there. It's absolutely a two-sided coin. The first side is contraction risk. This is when borrowers pay down their principal faster than anticipated. Imagine a scenario where interest rates suddenly decline significantly. What's the first thing on many homeowners' minds?
Refinancing. Get that lower rate.
Exactly. Refinancing their mortgage at a lower rate to save money. Or maybe the real estate market is booming. Their property value skyrockets, gives them loads of equity. Maybe they sell and pay off the loan entirely. Now, for an investor holding an MBS backed by these loans, this means they receive their principal back much sooner than they expected. And what's the catch?
Uh-oh. They have to reinvest it.
Right. They're then forced to reinvest those proceeds, often at the lower prevailing interest rates that caused the prepayments in the first place. So it reduces their potential returns. It also limits any potential price appreciation of their bond because its effective life is just cut short. It's kind of a good news, bad news situation.
Yeah.
Good to get your money back quickly, but bad if you can't put it back to work profitably. Flip side, the other blade, is extension risk. This occurs when borrowers pay down their principal slower than anticipated. Now, just reverse that interest rate scenario. What if interest rates are rising? Homeowners are far less likely to refinance into a higher rate, obviously. They might also delay selling their homes if property values are stagnant or even declining. They're sort of locked into their current mortgage for longer. For the MBS investor, this means their expected payments are stretched out over a longer period than they planned. And here's the kicker. If interest rates have risen since they bought the MBS, the value of those future cash flows they eventually receive will be discounted at a higher rate.
Reducing the present value.
Exactly. Significantly reducing the present value and thus the market value of their investment. They're stuck holding a lower yielding asset for longer in a rising rate environment. Not ideal.
That sounds like a constant battle against unpredictability, a real financial seesaw. As an investor, it must feel like you're playing a perpetual game of guess the homeowner's next move. So how do these smart financial engineers try to manage this fundamental challenge, this back and forth between contraction and expansion?
That's where clever financial structuring comes in. A key strategy to mitigate, or perhaps it's better to say redistribute, prepayment risk is called time tranching. The purpose here isn't to eliminate prepayment risk entirely. I mean, that's basically impossible given human behavior and market changes, but to carve up the cash flows from the underlying mortgage pool. You carve them into different bond classes, or tranches as they're called. Each tranche is designed with different expected maturities and critically different exposures to that prepayment risk. This allows investors to select a tranche that aligns better with their own specific investment horizons and their risk appetites. Let's consider a hypothetical example, maybe drawing from a European context. Imagine a residential loan trust, an RLT, issuing MBS. Let's say this RLT issues 4 tranches. Tranche A with an expected maturity of 1 year, Tranche B at 2 years, Tranche C at 3 years, and Tranche D at 4 years. Now, suppose something dramatic happens. Interest rates decline significantly very early on, maybe in year 2. What's the immediate effect?
Prepayment spike. Everyone refinances.
Right. Many borrowers in the underlying pool will likely jump at the chance to refinance, leading to a flood of immediate prepayments. Now, for investors who specifically bought tranche B or C, expecting a 2 or 3 year maturity, well, they might suddenly find their principal is repaid much sooner than anticipated, perhaps in less than 2 or 3 years. This isn't necessarily a bad outcome in itself, maybe they get their money back fast, but it powerfully demonstrates how time tranching redistributes that prepayment risk. The shorter tranches might get paid off rapidly, but then those investors face that reinvestment challenge at lower rates. The risk doesn't vanish, it just shifts around between the tranches. So it's not just about the big macroeconomic moves like interest rates changing. Sometimes it's the specific, seemingly isolated events that can send the most unexpected shockwaves through these securities. If we connect this back to the broader asset-backed securities market, the ABS market, MBS isn't the only securitized product facing these unique, often surprising risks, is it? Absolutely not. Beyond the systemic risks tied to broad interest rate movements, we also have to contend with idiosyncratic risks in ABS. These are risks specific to the issuer or the underlying collateral itself, almost like hidden fault lines you didn't know were there. A really potent, real-world example is the Volkswagen emissions scandal back in 2015. Remember that? Volkswagen, a giant in the auto industry, admitted to deliberately cheating on diesel emission tests. This led to colossal fines, extensive litigation, and just a massive hit to its brand reputation and market value.
Right, I remember. Huge news.
And the ripple effect was immediate and profound, even for seemingly unrelated financial products like auto ABS, which are backed by car loans and leases. Suddenly, sales of VW Auto ABS were temporarily crimped. The market value of the actual cars backing those loans fell, impacting the underlying collateral quality. What's more, bonds backed by the inventories of VW cars held by dealerships known as dealer floor plan ABS were particularly vulnerable. Dealers were stuck with unsaleable cars, inventory didn't turn over, and the stress on those securitizations became very real very quickly. While VW did offer financing assistance and promised to repurchase unsold vehicles, the scandal clearly demonstrated how a single corporate event could severely elevate the risk profile of related securitized debt. The consequence for Volkswagen was a direct hit to its borrowing costs in the ABS market. To attract investors for new auto ABS issues post-scandal, they had to offer significantly higher yield premiums. Where they might have offered just, say, 20 basis points above benchmark rates earlier that year, suddenly they were offering 60 to 65 basis points more for their top-ranking notes.
This dramatic shift powerfully illustrates that beyond broad market movements, issuer-specific or collateral-specific events can profoundly impact the value and risk of any securitized product, including MBS. It's a critical reminder that every layer of the financial structure carries its own set of potential surprises. What seems like a distant corporate scandal can actually directly affect your fixed income portfolio.
The
LTV is straightforward. It's simply the ratio of the loan amount to the property's appraised value. But its significance is huge. A lower LTV means the borrower has put more of their own money, more equity into the property. They have more skin in the game, as they say. This generally translates to a lower likelihood of default because the borrower has more to lose if they walk away. And if a default does occur, a lower LTV provides much greater protection for the lender. There's a larger equity cushion if they have to repossess and sell the property, reducing their potential loss. It's also important to remember it's a dynamic ratio, not static. As a borrower makes principal repayments, the loan balance shrinks. And as property values fluctuate with market cycles, that LTV ratio changes over time. Let's put some numbers to it, make it real. If a borrower in Europe is seeking a EUR 600,000 loan to purchase a house valued at EUR 800,000, the LTV would be 75%. That's 600K divided by 800K. In an Indian context, imagine a home buyer in Bangalore taking an INR 75 lakh home loan from a major Indian bank like, say, ICICI Bank for an apartment valued at INR 1 crore. That's an LTV of 75%, 75 lakh, 100 lakh.
Lenders will scrutinize this to understand the borrower's initial equity stake. Similarly, in the U.S., a buyer in Texas might secure a $350,000 mortgage for a $450,000 property. It gives you an LTV of approximately 77.8%, 350K, 450K. It's a key measure for any residential mortgage application. But here's a subtle danger with LTV, something we saw starkly in 2008. A healthy LTV today can become a ticking time bomb if those property valuations are inflated, if they're in a bubble. It's not just the ratio, but the sustainability of the underlying value that truly protects an investment. Another absolutely vital metric is the debt-to-income ratio, or DTI.
DTI, right.
Yeah, this ratio compares an individual's total monthly debt payments, and that includes their proposed mortgage payment, car loans, credit card minimums, student loans, everything to their monthly pre-tax gross income. It's a direct gauge of their ability to comfortably manage and repay all their debts. A low DTI signals that a borrower has sufficient disposable income relative to their obligations. It suggests they have the capacity for additional debt without being overstretched. A high DTI, conversely, might indicate they're living closer to the edge, paycheck to paycheck perhaps, making them a higher default risk. For instance, a borrower with an annual income of EUR 141,000 and a total monthly debt payment, including the new mortgage, of EUR 3,795.980 would have a DTI of about 32.31%. That's the EUR 3,795.95 monthly payment divided by their monthly gross income, which is EUR 141,000 divided by 12 months, or EUR 11,750.
So we've got these quantitative measures that paint a picture of financial health, LTV, and DTI. What about the qualitative aspects, specifically how mortgages are differentiated based on the borrower's actual credit quality? Because not all borrowers are the same, are they?
Precisely. And this is a really important distinction, especially in sophisticated markets like the U.S. We commonly categorize mortgage loans into two broad types based on borrower credit quality. First, you have prime loans. These are extended to borrowers with sterling credit quality. These individuals typically boast strong employment histories, good credit scores, low DTI ratios, substantial equity in their property, low LTV, and crucially, the loan is secured by a first lien, meaning it has priority in case of default. Think gold standard borrowers. On the other end of the spectrum are subprime loans. These are offered to borrowers with lower credit quality. This could mean they have a high DTI, maybe a higher LTV, weaker credit history, or sometimes the loan might even be secured by second liens, which are subordinated to other loans and therefore much riskier for the lender. The subprime market, as many will remember, was a significant factor in the run-up to the 2008 financial crisis. It really highlighted the inherent risks in lending to these less creditworthy segments when underwriting standards slip.
That distinction really sets the stage for when things, unfortunately, go wrong. What happens when borrowers can't make their payments? What are the implications for the lender beyond just seizing the property? Does the lender have other options?
This brings us to a crucial legal distinction that profoundly impacts lender risk and actually borrower behavior too. Recourse versus non-recourse loans. In a recourse loan, if the borrower defaults and the foreclosure sale of the property doesn't generate enough cash to cover the full outstanding balance of the loan, the lender has a legal claim against the borrower's other assets. Their savings, other investments, maybe even future wages, they can pursue those to make up the shortfall.
Wow, okay, so they can come after other stuff. It's exactly. However, with a non-recourse loan, the lender's claim is strictly limited solely to the foreclosed property. They cannot pursue the borrower's other assets to recover any deficit. The risk of loss beyond the collateral rests entirely with the lender. This distinction is incredibly significant, particularly during severe economic downturns or real estate market crashes. For instance, many U.S. states legally mandate non-recourse residential mortgages. It varies state by state, but it's common. In stark contrast, residential mortgages in most European countries, and also in India, are generally recourse loans. The global financial crisis of 2008-09 provided a really stark, painful illustration of this difference. Millions of U.S. properties became underwater, meaning the loan value exceeded the property's market value. This was largely due to loose underwriting standards and those inflated property prices we mentioned. Now, in such a scenario, with non-recourse mortgages prevalent, the incentive for something called strategic default increases dramatically.
Strategic default.
Yeah, this is where a borrower, even if they have other financial resources, might make the cold, calculated decision to simply stop paying on an underwater property. They essentially hand the keys back. They accept the damage to their credit score as the cost of walking away, knowing the lender can't pursue their other assets. It's almost a cynical cost-benefit analysis. Weigh the credit damage against losing potentially hundreds of thousands on an underwater home. Let's look at an Indian context example for recourse. If a borrower defaults on a home loan from, say, an SBI bond issuance, and the sale of the property doesn't cover the full outstanding amount, the bank does have legal recourse to pursue other assets of the borrower. This makes strategic default far less common in India, as the personal cost is much higher. Conversely, a homeowner in Arizona, where residential mortgages are often non-recourse, might choose to strategically default on an underwater mortgage. They allow the bank, which might have securitized this loan into an MBS, to foreclose, but without personal liability beyond losing the property itself. It definitely changes the dynamics.
Default is one side of the coin, but we talked about prepayment being the other major risk for MBS investors. Are there specific features built into mortgage agreements themselves that either encourage or discourage those early repayments?
Yes, absolutely. One such feature, specifically designed to reduce prepayment risk for the lender, is prepayment penalties. These are basically monetary penalties stipulated right in the loan agreement that the borrower must pay if they prepay their mortgage early, usually within a certain initial period. It's a way for lenders to recover some of the lost interest income and maybe cover the costs of originating the loan that they might not recoup if the loan pays off too quickly.
Right.
While prepayment penalty mortgages are quite common in Europe, they're seen as a crucial tool for lenders to manage cash flow uncertainty. You'll find them much less frequently in the United States, especially in the prime residential market. This is often due to consumer protection laws and regulations.
Okay, so we've broken down the fundamental mortgage loan. We understand its DNA, so to speak. Now let's step up to the next level. Residential mortgage-backed securities, or RMBS. Now, this isn't just a segment. You said earlier it's the largest part of the entire MBS market, specifically backed by residential properties like homes and apartment buildings.
That's right. And the most basic, the most fundamental type of RMBS is a mortgage pass-through security. The process is quite elegant in its simplicity, really. Multiple mortgage lenders, or originators, pull together thousands of individual residential mortgage loans. These pools can be huge. They then sell securities backed by these gigantic pools directly to investors. The name pass-through perfectly describes the cash flow mechanism. The monthly payments, which include scheduled principal, interest, and any unscheduled prepayments from homeowners refinancing or selling from that underlying mortgage pool, are literally passed through to the security holders, proportional to their ownership share in the pool.
So the cash just flows through minus some fees, I assume?
Exactly. It's not entirely free. There are administrative charges deducted along the way. These cover essential servicing fees for the pool, collecting payments from borrowers, maintaining meticulous records, initiating foreclosure proceedings if needed, providing tax information, all that stuff. There are also fees for the issuer or guarantor of the security. All these fees are taken out of the gross mortgage rate paid by the homeowners. This means the investors ultimately receive a slightly lower pass-through rate, often referred to as the net interest or net coupon. So if the average mortgage rate in the pool is, say, 4%, investors might actually receive 3.5% after all the fees are deducted. Now, these mortgage pools are rarely perfectly uniform. They're what we call heterogeneous. The individual mortgages within a single pool will naturally vary. They'll have different outstanding principal balances, different specific interest rates, and different remaining maturities. To give investors a clear, consolidated picture of the blended characteristics of such a complex pool, two key measures are universally used for pass-throughs. The first is the weighted average coupon, WAC. Think of WAC as the average interest rate heartbeat of the pool. It's the weighted average of the interest rates of all mortgages in the pool, weighted by their current outstanding balance. The second is the weighted average maturity, WAM. This tells you the average remaining lifespan of the loans in the pool. It's the weighted average of the remaining months to maturity of all mortgages in the pool, also weighted by their current outstanding balance. These aren't just abstract numbers. They're like the pool's vital signs. They quantify the overall risk and return profile for any investor looking at that pass-through security.
That's a really clear way to see how those blended characteristics are derived. WAC and WAM. It seems so neat and tidy to get these averages for the whole pool. But I can't help but wonder, for a really granular investor, does relying on these averages ever obscure underlying risks? Like, could there be a cluster of really bad loans hiding within that average?
That's a very astute question, and it highlights a crucial point. Averages can mask extremes. Absolutely. While WAC and WAM provide a valuable summary snapshot, a truly diligent investor would indeed look beyond just the average. They'd want to understand the distribution of interest rates and maturities within the pool. Are there, for example, many low-rate, high-balance loans that could prepay very quickly if rates drop? Or maybe a few very long-term, high-rate loans that introduce significant extension risk? So yes, while averages are a great starting point, they are just that, a starting point. Deeper due diligence often involves looking at the loan-level data or distribution characteristics. Let's quickly walk through an example to illustrate how WC and WAM are calculated. Imagine a small pool of just 5 mortgages. Just to keep it simple, mortgage A, 2.50% interest, EUR, $238,000 current balance, 180 months left. Mortgage B, 3.30% interest, UR, $380,000 current balance, 480 months left. Mortgage C, 2.80% interest, UR, $87,000 current balance, 240 months left. Mortgage D, 4.00% interest, UR, $132,000 current balance, 120 months left. Mortgage E, 3.70% interest, UR, $312,000 current balance, 312 months left.
The total current balance across these 5 mortgages adds up to EUR $1,149,000. Okay, to calculate the WAC, the weighted average coupon, we do this. First, for each mortgage, multiply its interest rate by its current balance. So 0.025023K plus 0.03030K plus 0.040013K plus 0.040132K plus 0.0370322K. 2, if you sum all those products up, you get 37,753. Then you divide the sum with the total current balance of the pool, which was EUR 1,149,004. So 37,750 divided by 1,149,000 equals about 0.03285, or roughly 3.29%. That's your WAC.
Okay, got it. Weighted average rate.
Exactly. Now for the WAM, the weighted average maturity, it's a very similar process, but instead of the interest rate, we use the number of remaining months to maturity. 1. For each mortgage, multiply its remaining months by its current balance. So 180, 238K plus 480, 380K plus 287K plus 132K plus 312K. 2. Summing those products gives you a big number, 359,304,000. 2. Summing those products gives you a big number. 3. Then divide this sum by the total current balance of the pool, UR 1,149,000. 2. Summing those products gives you a big number. 4. 359,304,000 divided by 1,149,000 equals about 312.71, or approximately 313 months. That's your WAM. These calculations, WC and WAM, provide that standard way to quantify the overall character of the pool for investors, keeping in mind your point about averages potentially hiding details.
Now, within the U.S. RMBS market specifically, there's a critical distinction, one that profoundly impacts investor risk and, frankly, the entire ecosystem of mortgage finance over there. Can you explain the difference between agency and non-agency RMBS?
You're absolutely right. This distinction is fundamental in the U.S. mortgage market. We primarily differentiate between agency RMBS and non-agency RMBS. Agency RMBS are securities issued either by federal government agencies, like Ginnie Mae, that's the Government National Mortgage Association, or by government-sponsored enterprises, the GSEs, which are Fannie Mae, Federal National Mortgage Association, and Freddie Mac, Federal Home Loan Mortgage Corporation. The absolute key feature here is the guarantee. Securities issued by federal agencies like Ginnie Mae carry the full faith and credit of the U.S. government for timely payment of interest and principal. It's basically a government promise. GSE-issued RMBS carry the GSE's own guarantee. Now, while this isn't explicitly the full faith and credit of the government, it's often seen as implicitly backed by the government due to the systemic importance of Fannie and Freddie. Because of this implicit or explicit government backing, agency RMBS are incredibly liquid. They're widely held by institutional investors globally, and they are considered extremely safe in the U.S. context, at least from a credit risk perspective.
They are a textbook example of U.S. agency RMBS think securities, issued by Fannie Mae or Freddie Mac.
Okay, so agency means government-backed, essentially very low credit risk. What about non-agency then?
Right. Non-agency RMBS, sometimes called private label securities, are issued by private entities, typically large banks, investment banks, or other financial institutions. Crucially, they do not carry any government guarantee. This lack of government backing means they naturally carry higher credit risk. Because of this, they rely heavily on internal credit enhancement mechanisms to mitigate that credit risk and make them more attractive to investors. These enhancements can include things like pool insurance, where an insurer covers some losses, letters of credit, external guarantees from a third party, or, very commonly, subordination. Subordination simply means creating different tiers or tranches of bonds within the securitization. The lower-rated or junior tranches act like a buffer. They absorb the initial losses if borrowers default, thereby protecting the more senior, higher-rated tranches. It's a structural safety net built in. Historically, especially before 2008, non-agency RMBS often securitized non-conforming mortgages, those that didn't meet the strict standards for agency loans, or even subprime mortgages. While their issuance plummeted after the 2008 financial crisis due to increased regulatory scrutiny and just general investor aversion, some forms, like those backed by home improvement loans or jumbo mortgages, loans too large for agency limits, are beginning to reemerge in the U.S. market, though usually with much stricter underwriting standards now.
So mortgage pass-throughs, while fundamental, are quite simple in structure, just directly passing those cash flows through. But what if investors need something more tailored, something that lets them pick and choose their precise exposure to risk, especially that tricky prepayment risk? That's where collateralized mortgage obligations, or CMOs, come into play, right? It sounds complex, but it's actually an ingenious solution, isn't it?
It truly is. CMOs represent a significant leap in financial engineering compared to simple pass-throughs. They're essentially securitizations of existing mortgage pass-through securities, or sometimes multiple pools of whole loans directly, but with a crucial twist.
Their primary purpose is to take those often unpredictable and lumpy cash flows from the underlying mortgages and completely re-engineer them. They redistribute the cash flows into different tranches or bond classes, each designed with varying exposures to prepayment risk. Now, CMOs cannot eliminate prepayment risk entirely, remember. Borrower behavior is still at the root, but they're designed to significantly reduce the uncertainty in payment size and timing for investors. They offer a much broader spectrum of risk and return profiles than a simple pass-through. And generally, the more senior a tranche is within a CMO structure, the less exposure it will have to both prepayment risk and default risk, making it attractive to more conservative investors seeking stability.
So what does this actually mean for how these tranches are paid out? How do they achieve this clever redistribution of risk? How do they turn one stream of payments into multiple, maybe more predictable ones?
A fundamental and widely used example that illustrates this is the sequential pay CMO. It's one of the most basic CMO structures. In this structure, the payment rule is simple. All principal payments, scheduled and prepayments, from the underlying collateral flows sequentially to one tranche until it has fully repaid its principal balance. Only then do principal payments begin flowing to the next tranche in the sequence. Imagine a waterfall. All principal payments cascade into, say, tranche A until its principal balance hits zero. Once tranche A is completely paid off, all subsequent principal payments then flow down to tranche B until its principal is zero, and then maybe to tranche C, and so on down the line.
Ah, like a queue, first come, first served with the principal.
Exactly like a queue. And this creates a remarkably clever redistribution of prepayment risk. Shorter-term tranches, like our hypothetical tranche A, get protection against extension risk. Why? Because their payments won't be stretched out indefinitely. The longer-term tranches, B and C, are absorbing that potential for slower prepayments, effectively waiting patiently in line behind tranche A. Conversely, the longer-term tranches B and C benefit because they receive protection against contraction risk from tranche A. That is, tranche A absorbs the brunt of any early prepayments. This makes it less likely for B and C to be paid off unexpectedly early, which would force their investors to reinvest at potentially lower rates. It's like a financial traffic controller, carefully directing the flow of principal to create different risk profiles. Let's make this concrete with a hypothetical CMO. Imagine one backed by a pool of mortgages structured with 3 sequential pay tranches. Tranche A with an expected average life or maturity of, say, 5 years, tranche B targeting 15 years, and tranche C aiming for 30 years. Different investor types would clearly gravitate towards the tranches that best match their specific needs and liabilities. A mutual fund that needs to maintain high liquidity and minimize interest rate risk, maybe seeking safe short-term returns and desperately wanting to avoid extension risk, might eagerly choose tranche A. They'd accept its likely lower yield for its earlier, more predictable payoff. An insurance company, perhaps needing to match future payouts for long-dated annuities that start coming due in about 15 years, would find tranche B particularly appealing. It offers that medium-term maturity and probably a slightly higher yield, better aligning with their liability profile. And then a pension fund, with very long-term liabilities stretching out decades, looking for higher returns over the long haul, and therefore more willing to accept duration risk and maybe some prepayment uncertainty, would likely gravitate towards tranche C. It has the longest maturity and typically offers the highest yield to compensate for that risk. Let's try an Indian context example. Imagine a hypothetical securitization of diversified housing loans originated by, say, HDFC, structured into a sequential pay CMO. An Indian provident fund with very long-term liabilities, perhaps funding retirements decades from now, might prefer the longer-term tranche C for its higher potential yield. They'd be reasonably confident that early prepayments would be absorbed by the shorter tranches A and B. Meanwhile, a corporate treasury in India managing short-term liquidity needs might opt for tranche A to minimize its interest rate exposure, knowing it will likely be paid back relatively quickly. Or in the U.S., think about a large university endowment fund. They might strategically invest in tranche B of a sequential pay CMO to specifically match expected future payouts for, say, scholarship programs starting in 10-15 years. They'd feel confident in its relative protection from both extreme contraction and extension risks because of that sequential structure. It really demonstrates the power of CMOs to slice and dice risk to cater to diverse investor needs.
It's clear that CMOs offer a significant leap in tailoring risk, providing this menu of options for investors. But I understand there are even more specialized structures available, offering very specific risk management capabilities that go beyond just simple sequential payments. What else is in the CMO toolkit? What other kinds of tranches can you find?
Absolutely. Beyond the basic sequential pay structure, CMOs can incorporate a whole variety of other, often more complex tranche structures. These are typically created through even more intricate time tranching rules or by cleverly splitting the cash flows, principal versus interest, in unique ways. Let's delve into a few of the most important ones you might encounter. First, we have Z tranches. These are sometimes called accretion bonds or accrual bonds. Imagine a Z tranche as the ultimate deferred gratification bond, or maybe the most patient investor in the CMO structure. What makes them unique is that they defer all interest payments until a preset date, or more commonly, until all the more senior tranches in the CMO structure have been fully paid off their principal. During that initial accrual period, the interest that would normally be paid out isn't distributed. Instead, it's added back to the principal balance of the Z tranche itself, causing it to accrete or grow over time. These are typically the very last tranches to receive any cash flow, effectively freeing up cash flows to help stabilize payments to the other, more senior tranches earlier on. While they can be quite risky and sometimes hard to value due to their very long average lives and high sensitivity to interest rate changes, Z tranche holders are protected from immediate reinvestment risk because their interest automatically accrues rather than being paid out and needing to be reinvested in potentially lower rate environments. It's like being last in line for the financial buffet, but then getting to pile your plate high because interest has been quietly growing onto your principal share.
Interesting. So Z is for zero coupon initially.
Sort of, yeah. Zero cash flow initially, but the principal grows. Then you have principal-only PO securities. As the name clearly suggests, these bonds pay only the principal repayments, both scheduled and prepaid, from the underlying mortgage pool. They receive absolutely no interest payments. Their value is therefore extremely sensitive to prepayment rates. Think about it. The faster the underlying mortgages prepay, the quicker PO investors get their principal back. And because they receive it sooner, the higher the present value and thus the market value of their PO security. If prepayments slow down, their value decreases significantly. It's essentially a leverage bet on prepayment speeds going up. Conversely, we have interest-only IO securities. These bonds pay only the interest payments generated by the underlying mortgage pool, and they receive no principal whatsoever. They don't even have a par value. Their entire value comes from that stream of interest payments. This means their value actually declines with faster prepayments. Why? Because if mortgages prepay faster, the outstanding principal balance shrinks faster, and the total interest paid over the life of the pool decreases.
The IO investor's income stream shortens dramatically or even evaporates. For example, if interest rates fall sharply and everyone refinances, the IO investor's income stream dries up. IOs are often used by sophisticated investors like hedge funds or banks, specifically to hedge against interest rate risk. If rates rise, prepayments slow down, the IO bond's life extends and its value might increase, offsetting losses elsewhere. If rates fall, prepayments speed up, the IO bond's value decreases, potentially offsetting gains elsewhere. Then there are floating rate tranches. The interest rates on these tranches are not fixed. Instead, they are linked to a market reference rate, such as SOFR, the Secured Overnight Financing Rate, is common today, especially after the cessation of LIBOR. These tranches can also be structured as inverse floaters, where the interest rate moves inversely to the market reference rate, for example, pays 10% minus SOFR. These floating and inverse floating structures are primarily used by investors looking to hedge against specific types of interest rate risk or express a view on future rate movements. And, often lurking at the riskiest end of the CMO capital structure, are residual tranches, sometimes called equity tranches. These absorb any remaining cash flows after all other more senior tranches have been paid their full promised principal and interest. Essentially, they get whatever's left over, if anything. They're highly speculative, can be extremely volatile, and are suitable only for the most sophisticated investors like hedge funds who understand the risks and are willing to take them on for the potential of outsized returns or total loss. Finally, a very significant and popular evolution in CMO technology are planned amortization class tranches, or PEC tranches. These are specifically designed to offer highly predictable principal payments, but only within a specified range of prepayment speeds, often called the PEC collar or PEC bands. The genius of PEC tranches is their stability, which comes from being paired with a dedicated support tranche, sometimes called a companion tranche. This support tranche acts like a shock absorber. It is specifically designed to absorb the prepayment variability if the actual prepayment rates fall outside that predefined PEC's range. If prepayments are faster than the upper PEC band, the support tranche receives the excess principal first. If prepayments are slower than the lower PEC band, the support tranche's principal payments are delayed. This means PECs themselves maintain much more stable and predictable cash flows, making them very attractive to investors who prioritize cash flow certainty, like insurance companies or pension funds managing liabilities. For example, a U.S. institutional investor looking for extremely stable cash flows might invest heavily in PAC tranches to fund predictable long-term liabilities. They gain comfort knowing that a separate support tranche will absorb most of the volatility from changing prepayment speeds, whether interest rates decline, contraction risk, or rise, extension risk. It's an incredibly effective way to manufacture a highly stable bond out of inherently unpredictable underlying mortgage cash flows.
Wow, that was truly a deep dive into the residential side and the complexities of CMOs. Now let's shift gears completely. Let's transition to a distinct but equally important segment, commercial mortgage-backed securities, or CMBS. I imagine the dynamics here are quite different given the underlying collateral isn't individual homes.
You're absolutely right. The landscape of CMBS is uniquely different from RMBS in several critical ways. CMBS are fundamentally distinct because they are backed by pools of commercial mortgages loans secured by income-producing properties. We're talking about things like office buildings, shopping centers and malls, large hotels, industrial warehouses, or big multifamily apartment complexes. Crucially, the repayment for these securities comes primarily from the revenue generated by these properties, mainly through tenant leases and rents, rather than relying on an individual homeowner's income. One of the most striking and crucial unique features of CMBS, especially when compared to the highly diversified RMBS pools, is what we call concentration risk. While an RMBS pool might consist of thousands, even tens of thousands of relatively small, geographically diversified residential loans, a CMBS pool can often be made up of just a few dozen, or sometimes even just a handful of very large commercial mortgages. This means that a single default on one large loan in a CMBS pool can have a disproportionately significant and potentially devastating impact on the investors in that pool. Therefore, investors in CMBS must perform intense, painstaking due diligence. This isn't just looking at the overall structure or the ratings. It extends to scrutinizing each individual loan within the pool, the specific properties backing those loans, location, quality, tenant mix, vacancy rates, and even the financial strength, track record, and management expertise of the property owners themselves. For instance, think about an Indian CMBS issued by a major bank. Maybe it's backed by a small pool of loans for large, prime commercial properties in Delhi and Mumbai. This could exhibit significant concentration risk. Investors would need to carefully analyze the specific rental agreements, the creditworthiness of major tenants like is a major Infosys or Reliance office building the key collateral, and the local real estate market conditions for each specific property. Why? Because the failure of just one or two large tenants or properties could seriously derail the cash flows from the entire securitization. This granular property-level analysis is far more intense than typically required for diversified RMBS.
That's a huge difference in how you approach risk assessment. It almost sounds more like analyzing individual stocks or real estate deals than traditional bond investing. What are the other key differences between CMBS and RMBS, particularly concerning the types of risks they present, especially that prepayment risk we spent so much time on earlier? Does that work the same way?
Prepayment risk in CMBS is where things get really different. Two critical features powerfully differentiate CMBS from most RMBS in this regard: call protection and the balloon maturity provision. Unlike most RMBS, where homeowners can prepay relatively freely, especially in the U.S., CMBS offer investors significant call protection. This makes them behave and trade much more like traditional high-grade corporate bonds with call protection features. This protection can be achieved at two levels. First, there's structural call protection, which is often achieved through sequential pay tranches within the CMBS structure itself, similar to CMOs we discussed. Lower-rated tranches cannot be paid down until higher-rated ones are fully retired, and these junior tranches are structured to absorb principal losses first, offering protection to seniors. Second, and perhaps more distinctive and powerful for CMBS, is individual loan-level call protection. This is implemented through various covenants written directly into the underlying commercial mortgage agreements themselves. These commonly include prepayment lockout. This is a contractual prohibition preventing any prepayments during a specified initial period of the loan, often the first several years. The borrower literally cannot prepay, regardless of interest rates. Prepayment penalty points. These are predetermined penalties the borrower must pay if they choose to refinance or repay the loan early after the lockout period expires. These penalties are often structured as a percentage of the outstanding loan balance and can be quite substantial, discouraging early repayment. Defeasance. This is probably the most sophisticated and common form of loan-level call protection in CMBS. Let's say a property owner has a commercial mortgage within a CMBS pool, but they want to sell the property or refinance early without triggering penalties or disrupting the investors who bought the CMBS bond expecting a certain stream of payments. Defezance provides an elegant solution. Instead of directly prepaying the loan with cash, the borrower uses funds to purchase a portfolio of ultra-safe government securities, like U.S. Treasury bonds or perhaps G-SECs in India, whose scheduled payments exactly replicate the remaining scheduled cash flows of the original mortgage loan, including any large balloon payment at the end. These government securities are then placed in a trust and effectively replace the original mortgage as the collateral securing that portion of the CMBS pool. This defeases the original loan, completely protecting the CMBS investors from the prepayment surprise because they continue to receive their originally expected cash flows, but now sourced from the newly acquired, essentially risk-free, government securities portfolio. For example, a CMBS backed by a portfolio including, say, some of Tesla's corporate office buildings in the U.S. might include a defezance clause. If Tesla wanted to refinance one of those buildings early, they would have to buy a basket of U.S. Treasury bonds sufficient to perfectly match the CMBS investors' original expected cash flows from that loan. This protects the investors from any prepayment disruption and makes the CMBS cash flows much more predictable, significantly reducing contraction risk compared to RMBS.
Okay, so call protection really dampens that contraction risk side. What about the other feature you mentioned, the balloon maturity?
Right. The other major difference, which introduces a very distinct type of extension risk, is the balloon maturity provision, leading to what's called balloon risk. Many commercial real estate loans are not fully amortizing over their stated term, for example, 5, 7, or 10 years. They might calculate payments based on a 25 or 30-year amortization schedule, but the loan itself comes due much sooner. This means they require a large lump sum balloon payment of the remaining unamortized principal balance at the loan's maturity date. Balloon risk is simply the risk that the borrower fails to make this substantial final balloon payment when it comes due. This is a major source of default risk in CMBS. This failure often occurs if the borrower is unable to refinance the existing mortgage, perhaps due to deteriorating property financials, like lower occupancy or rents, tighter lending standards in the market, or a challenging general economic environment, or maybe they simply can't sell the property for enough money to cover the balloon payment. Now, because a default on a balloon payment often leads the lender or the servicer acting for the CMBS trust to try and work things out, perhaps by extending the loan term or modifying the payment plan through a workout period, balloon risk is fundamentally a type of extension risk. It stretches out the life of the loan and thus the CMBS investment beyond its originally expected maturity date.
With commercial properties, the credit analysis must be very different then. It's all about the property's ability to generate income rather than just the borrower's personal income like an RMBS. What are the key credit performance indicators that lenders and investors rely on for commercial real estate lending?
Precisely. For commercial real estate lending, the primary focus shifts decisively from the individual borrower's W-2 income to the property's ability to generate sufficient cash flow to cover its operating expenses and its debt payments. A crucial, perhaps the most crucial, credit performance indicator is the debt service coverage ratio, or DSC. You'll often see it written as DSCR as well. This is really the cornerstone of commercial real estate underwriting and CMBS analysis. It's calculated by taking the property's annual net operating income, NOI, and dividing it by its annual debt service.
Okay, break those down. NOI and debt service.
Sure. Net operating income, NOI, is the property's total rental income minus its cash operating expenses. Those expenses include things like property taxes, insurance, utilities, routine maintenance, property management fees, and importantly, usually includes a replacement reserve funds set aside regularly for future major capital repairs like a new roof or age of AC system. Crucially, NOI excludes principal and interest payments on loans, one-off capital expenditures, and non-cash items like depreciation and amortization. Think of it as the property's raw operating profitability before financing costs. Debt service, on the other hand, is simply the total amount of principal and interest payments the borrower is required to make on the loan over the course of a year. So the DSC ratio, NOI debt service, tells you how many times the property's operating income covers its required loan payments. A DSC ratio greater than 1.0x indicates that the property's cash flows are theoretically sufficient to cover its debt service obligations and hopefully contribute to its ongoing maintenance and provide some profit. A higher DSC ratio signals lower default risk because the property has a larger cushion of income over its debt payments. Lenders typically want to see DSC ratios comfortably above 1.0x, maybe 1.2x or 1.25x or higher, depending on the property type and market. For example, if a commercial property generates an NOI of, say, GBP 7,590,000 and have annual debt service, principal and interest of GBP 4,770,169, its DSC ratio is 1.61x,
$7,590,000, $4,017,169. That indicates very healthy coverage, suggesting a relatively low risk of the property defaulting on its loan payments. In India, CMBS analysts would similarly scrutinize the DSE ratio for each property backing an issuance, ensuring that the rental income from, say, a premium office space in Mumbai or a shopping center in Bangalore comfortably covers its mortgage payments.
Okay, if we connect this all back to the bigger picture, it really sounds like CMBS and RMBS are almost two different species entirely, despite both being technically mortgage-backed. The risks, the analysis, the structure, it's a stark contrast. Can you give us a concise comparison, just hitting the highlights of the key distinctions in how they operate and the main risks they carry?
Absolutely. Let's try and summarize the key distinctions, because understanding these differences is really crucial for any fixed income investor looking at these markets. Underlying assets. First, the collateral. For RMBS, the assets are typically a large, highly diversified pool of individual residential mortgages on owner-occupied homes. For CMBS, it's usually a much smaller pool of significantly larger commercial mortgages on income-producing properties, offices, retail, hotels, etc. This structural difference leads directly to that much higher concentration risk in CMBS, credit risk. The credit risk profile differs dramatically. Agency RMBS have very low credit risk due to those explicit or implicit government guarantees. They're considered almost risk-free from a default perspective. Non-agency RMBS manage their higher inherent credit risk through internal enhancements like subordination. CMBS, however, can carry potentially high credit risk, primarily due to that concentration risk. If just one or two major properties in the pool default, the impact on investors can be significant. The analysis relies heavily on property-level fundamentals. Prepayment risk. This is perhaps where the contrast is strongest.
RMBS, especially in the U.S., typically face high contraction risk. Borrowers prepay quickly if rates fall, forcing reinvestment at lower rates, and also high extension risk. Borrowers prepay slowly if rates rise, trapping investors in lower-yielding assets for longer. CMBS, on the other hand, thanks to their robust call protection mechanisms, lockouts, penalties, defeasance, exhibit low contraction risk. Early prepayments are far less common and often economically unattractive for the borrower. However, CMBS faces a specific and significant type of extension risk. That balloon risk, if those large final principal payments cannot be refinanced or met at maturity. Default risk. In aggregate, RMBS generally have lower default severity risk due to the sheer diversification across many small, relatively uniform mortgages spread across a broad geography. CMBS, because of their concentration in fewer, larger, and often more complex loans, can have a higher overall default severity risk. The failure of one or a few large loans can have a much bigger impact on the pool's performance. Loan recourse. This is another key difference. Most residential mortgages underlying U.S. RMBS are non-recourse, though this varies by state.
However, residential mortgages in Europe and India are generally recourse loans. In contrast, the commercial mortgages underlying CMBS are typically non-recourse to the borrower beyond the property itself. This further emphasizes the critical importance of rigorous property-level cash flow analysis, like that DSC ratio, for CMBS lenders and investors, as they can generally only look to the property itself for recovery if things go wrong. Loan recourse. #outro.
So what does this all mean? Wow. We've just navigated a truly intricate and absolutely vital part of the financial landscape today. We started by understanding the fundamental concept of MBS and their primary challenge, that ever-present prepayment risk with its two dynamic faces, contraction and extension. Then, we really dug into the very building blocks, the individual mortgage loans themselves, exploring crucial metrics like LTV and DTI, and the significant, often overlooked implications of recourse versus non-recourse lending. Felt like we were mortgage underwriters for a bit there. From there, we soared into the sophisticated structures of RMBS and CMOs, seeing how simple pass-throughs work, and then how advanced tranching, like sequential pay and PACs, can brilliantly redistribute risk to suit different investor appetites. And finally, we explore the distinct, often high-stakes world of CMBS, grappling with its unique concentration risk, understanding its powerful call protection features, and acknowledging the ever-present balloon risk lurking at maturity.
This deep dive truly reinforces several key takeaways for you as a learner navigating the CFA curriculum. First, the inherently dynamic nature of fixed income instruments, particularly those so directly tied to real estate cycles and borrower behavior. Second, the immense power of securitization as a technology to transform diverse, often illiquid assets into tradable securities, and importantly, to redistribute risk across different investor profiles with varying needs. And third, the absolute undeniable importance of detailed, nuanced analysis for any investor venturing into these complex instruments. It's simply not enough to merely know the definitions or look at a rating.
Understanding the underlying mechanisms, the why behind the structures, and the profound implications of different risks is what truly empowers you to make informed decisions in these markets.
And with that, that wraps up Module 19, Mortgage-Backed Security, MBS Instrument and Market Features. And with it, amazingly, our entire CFA Level I 2025 Fixed Income, Volume 6, Deep Dive. You've navigated through some of the most intricate parts of the financial world over these modules, from basic bond features all the way to these highly engineered securitized products like ABS and MBS. Hopefully, you've gained a truly robust understanding of how fixed income markets function.
Absolutely. And maybe to leave you with a final thought to ponder as you continue your studies. Given the continuous evolution of financial markets and the often unpredictable dynamics of real estate, how might future innovations in securitization structures attempt to address new forms of risk? Perhaps things like cyber risk impacting commercial properties, or the financial risk associated with climate change affecting property values, or maybe even unforeseen global challenges. Much like the global financial crisis reshaped the MBS landscape just a decade and a half ago, what might the next evolution look like? It's a field that certainly never stands still.
That's a fantastic question to ponder, and one that really highlights the constant need for vigilance, adaptation, and innovation in finance. We definitely encourage you to continue exploring and applying this knowledge because the learning truly never stops in this field. Thanks for joining us on this fixed income journey. We'll be back soon with another deep dive into the CFA curriculum.